Hi, my dear friends. Hopefully all of you fine and safe. I am also be fine and safe, my dear friends. Now I am going to present in front of you amendments in indirect taxes right from 1st May 2019 to 31st October 2019, which are basically applicable for your May 2020 examination or June 2020 examinations. Since these exams of May 2020 or June 2020 merged with November 2020 examinations or December 2020 examinations of CA, CMA, CS, I am now presenting furthermore adding from 1st November 2019 to 30th April 2020 amendments. As a whole, my dear friends, I am presenting in front of you amendments in indirect taxes right from 1st May 2019 to 30th April 2020, which are applicable for your November 2020 examinations or December 2020 examinations. I am going to be present amendments in front of you like look and understandable manner, like a lollipop manner. Let us start amendments in indirect taxes applicable for CA, CMA, CS examinations of November 2020 or December 2020, as the case may be, are as follows. First and foremost, I am bringing to your notice supply. Supply excludes section 7 subsection 2. Class A, you are aware of that? Schedule 3 transactions. Class B also supply excludes. Where? Here there is an amendment taken place. For the first time they incorporated alcoholic liquor license granted by the state government. That license fee not a supply in the hands of the state government. It is an amendment in the given case. Services by way of grant of liquor license against consideration in the form of license fee or application fee or by whatever name you call it as the case may be, not a supply. However, it does not mean that, my dear sir, any other licenses like coal license or coal mining license or otherwise the natural resource oil drilling license, such a type of licenses granted by the government cannot consider under this category. That will absolutely attract the GST. That's why clarification given by CBIC after this particular notification, liquor license fee alone not taxable, which is neither supply of goods nor supply of services. Whereas in the case of other licenses granted by the government, if you refer here, other licenses granted by the government, being a supplier, granted the license like grant of license other than liquor, like mining rights, allotment of spectrum and so on and so forth to business entities, then it is a supply will attract GST in the hands of recipient under RCM, with which you already familiarized. Am I right or not? Fine. Further, referring to you here, goods sent for exhibition. As you are aware of that, my dear sir, if the goods sent for exhibition outside India, is it export of goods? Point number 1. Point number 2, whether need to execute a bond or a LUT. Point number 2 it is. Point number 3, first of all, this supply covered under zero date supply. This and all answers one by one I'm presenting here. As you are aware of that, in India itself, you consider goods supplied on sale or approval basis is absolutely not a supply, as you are aware of that, where invoice not required to issue at the time of dispatch of the goods on sale or approval basis. When you issue the invoice means invoice issued only when the buyer accept to buy that goods. Am I right or not? Yes. If that is the case, if the buyer accepted the goods to purchase within a period of 6 months from the date of dispatch, that is called as supply. That time of supply arises to issue the invoice. If the goods are returned within 6 months from the date of dispatch on sale or approval basis, which is not a supply, not at all considered for GST purpose. Now, in the given case, my dear sir, goods are sent on sale or approval basis only to outside India, also be not a supply. For example, if a goods sent for exhibition at Singapore from India, one Hewlett Packard sending the goods, their laptops to an exhibition which is held in Singapore, then it is only to display the product of the Hewlett Packard in the exhibition, not meant for sale. After exhibition is completed, the goods are returning back to India. In that case, lawmaker very clearly clarified, saying that it is not a supply, resulting that when you send the goods for exhibition outside India, one not required to execute a bond or LUT. It is not supply. Then the question of execution of LUT, execution of a bond does not arise, resulting that it won't cover under zero rated supply. If the goods are returned within 6 months, very important, within 6 months from the date of delivery challan issued for supply that goods, then which is not a supply. Where it is supply means if the goods are not returned within 6 months from the date of delivery challan issued for sending the goods outside India, in that case, the first day that occurs after expiry of 6 months from the date of delivery challan is the time of supply. That time you can raise the invoice. That time is supply, as you are aware of that. Now, assume a scenario. If the entire goods sent on exhibition purpose outside India, returning back within 6 months from the date of dispatch, in that case, there is no supply. Question of GST does not arise. And also, to clarify the doubts, in the given example, from India, the goods has been exported for exhibition purpose to USA. After completion of the exhibition, the goods are coming back to India. That is called import, but there is no import duty on that goods, since the goods are returned within 6 months from the date of dispatch, which is not a supply. Therefore, there won't be any GST under the GST law also. Got the clarity, my dear sir? Sir, it may be considered as goods sent to their parent company, or there may be head office or maybe branch office outside India, and establishment outside India, even without consideration supply. No, sir. My dear sir, CBIC very clearly clarified that if the goods are sent for exhibition or sale promotion purpose outside India, even to their other establishment outside India, also be not a supply, since the goods are returning back within 6 months from date of delivery challan issued for dispatching the goods. In that case, since not a supply, question of referring a transaction of Schedule 1 does not arise, said by CBIC. By this clarification, goods sent to related persons or distinct persons or to principal or agent for participation in exhibition which are going to return to India is not a supply. Clarification given by the CBIC in the given case. Got the clarity, sir? Further referring, my dear sir, composition scheme, composition levy. You are aware of that. A quick recapitulation on this before going for the amendment. A trader is eligible for composition scheme provided his aggregate turnover in the previous year does not exceed 1.5 crore. Excellent. If so, in the current year, he opted the composition scheme from 1st April. If so, he is eligible to pay the GST at the rate of 0.5% CGST, 0.5% SGST and dash on taxable supply of goods, taxable supply of services. You are aware of this. Now, with regard to manufacturer, previous year turnover should not exceed 1.5 crore. In the current year, he liable to pay GST, same 0.5% CGST, 0.5% GST as a composition VSSC from 1st April onwards. If so, on total turnover, which includes taxable as well as exempted supplies. For a restaurant fellow, you are aware of that, 2.5% CGST, 2.5% SGST, liable to pay on the total turnover in the current year, provided the previous year should not exceed 1.5 crores, is separate. Now, a trader manufacturer allowed to supply services, yes, up to what amount? Rupees 5 lakhs or 10% of the turnover of the agreed turnover of the previous year, whichever is higher. Up to that amount, you can provide the service also to retain your composition scheme status. Fine. Now, from 1st April 2019, the service provider like chartered accountant or a chartered engineer or a particular entry decorator or a particular security service provider, any service provider also can choose this composition scheme, provided their turnover in the previous year should not exceed 50 lakhs of rupees. If so, in the current year, they are liable to pay GST, 3% CGST, 3% SGST on the taxable supply, which taxable as well as exempted supply. But such a total turnover should not include interest earned on deposit, loans and advances. This is a clarification we have. Is clear, my dear sir? Is a recapitulation. You are aware of this. Now, what amendment taken place? Need to understand. Composition scheme where if you are a manufacturer of ice cream, a manufacturer of pan masala, a manufacturer of the tobacco substitutes, or from 1st October 2019, manufacturer of aerated water, not eligible for composition scheme irrespective of their turnover. Even their turnover rupees 0, so what? They are not eligible for composition scheme because of the manufacturer of this nature. Now, another amendment taking place here. Not only manufacturer of ice cream, not only manufacturer of pan masala, not only manufacturer of tobacco substitutes, not only manufacturer of aerated water, disqualify from composition scheme. Now, if the trader of these goods also be disqualified, this is what they mention here. A registered person making taxable supplies of the above goods is also not eligible to pay concessional rate of tax under the said notification, under the composition scheme notification. The meaning of that meaning is as follows. If you are a trader or a manufacturer of the following goods: 1, ice cream; 2, pan masala product; 3, tobacco substitutes; and 4, aerated water. These manufacturers or the traders are not eligible for composition scheme irrespective of their turnover. They have to pay normal rate of GST only. Is clear, my dear sir? Further, I am bringing to your notice one example which needs some clarification, my dear sir. This example need application with regard to supplier of service, where a supplier of service whose previous year turnover not exceed 50 lakhs, in the current year he is eligible to pay composition scheme 3% at the rate of CGST 3%, at the rate of SGST 3% on the turnover, which includes taxable as well as exempted, but does not include interest on deposit, loans, advances. There one amendment taking place for kind consideration. You are aware of that. If you are registered in that first year, from 1st of April till the date liable for registration, that turnover should not include while computing the GST. On that basis, a problem is this, we need to work out, which is We understood in the regular study differently. That's why I am referring this for a kind consideration. You follow this approach. What I am presenting now is as follows. Example, reading as follows. Chanchal started providing beauty and grooming services and inaugurated Care Beauty Center in Janakpuri, Delhi on 1st April. She opted to pay tax under notification number 2/2019 dated 7th March 2019 in the said financial year. The aggregate turnover of Care Beauty Center for the quarter ending 30th June was 20 lakhs. Further, for the half year ending 30th September, the turnover reached rupees 50 lakhs. Care Beauty Center recorded a rapid growth and turnover reached rupees 70 lakh by the end of October. Determine the total tax liability of Care Beauty Center by the end of the October. B. Care Beauty Center wishes to opt for composition scheme from the next financial year. You are required to advise it whether it can do so. Note, rate of GST applicable on such service is 18%. A normal rate of GST. As you are aware of that, GST department, namely the Institute wala, not going to be provide composition GST rates. He said, I will provide normal rate of GST. You recollect composition level GST. In the given case, Chanchal started her business in the current financial year, 1st April. With that, if so, in that case, she opted the composition scheme. Very good. In that case, what is her previous year turnover? 0. 0 less than or equal to 50 lakhs? Yes. In the current year, they are eligible for composition scheme? Yes. If so, what rate of GST they are liable to pay? Being a supplier of service, 3% CGST, 3% SGST. You should be aware of that. Recollect in the exam hall. Is it clear, my dear sir? This 3% on what? On total turnover. That total turnover includes taxable as well as exempted supply, but does not include interest earned on deposit, loans and advances. Is clear? There one more point also is there. If in the current year is the year in which you incorporated, if so, from the 1st April till the date liable for registration, that turnover should not be considered while computing 50 lakhs. Then how to answer this? Very easy, my dear sir. Working out the solution as follows. Now listen, sir. First, let us have the turnover of Chanchal. See, here they given from 1st April to 30th June. ₹20 lakh. Further, add. Also be given turnover further from 1st July to, they said 30th September, given 30 lakhs turnover. That means they reached to 50 lakhs means, which includes 20 lakhs also. Therefore, 30 lakhs. Total how much here? 50 lakhs. That means aggregate turnover as an aggregate turnover as on 30th September 50 lakhs. Is clear, my dear sir? Now tell me, to claim the benefit of composition scheme, your turnover limit should not exceed 50 lakhs. Now they touch the 50 lakhs. If so, up to that, you have to tax at the rate of 3% CGST, 3% SGST. Now the law says, while doing so, From that, deduct turnover from 1st April to 1st April, from 1st April till the date liable for registration from 1st April till the date of liable for registration. Liable for registration. See, in the state of Delhi, she incorporated Care and Care Beauty Center. Turnover limit for registration in Delhi is 20 lakhs for a service provider. Therefore, till the date of liable for registration, which is nothing but 20 lakhs. Reduce that 20 lakhs. Balance how much? 30 lakhs. This 30 lakhs will attract the GST at a composition scheme. Therefore, you have to say 3% CGST on rupees 30 lakhs. Likewise, again 3% SGST on rupees 30 lakhs, which comes rupees 90,000 and 90,000. Got the clarity, my dear sir? Any difficulty, sir? You should not go beyond 50 lakhs to charge CGST 3%. Be careful. If beyond 50 lakhs turnover there, if so, normal scheme only. In that case, from 1st October, 1st October to 31st October, 31st October, they achieved the turnover. How much here? They said here is 70 lakhs. That means they got further 20 lakhs. Is the meaning of that? That means 70 lakhs turnover they achieved. If so, minus already got how much? 50 lakhs. If so, the balance 20 lakhs you have been achieved. In that case, 20 lakhs of turnover from 1st October, normal scheme. Therefore, in the given case, interest rate supply CGST at the rate of 9% on 20 lakhs, SGST at the rate of 9% on 20 lakhs, which is over and above 50 lakhs, comes rupees 1,80,000. 1,80,000. Got the clarity, my dear sir? Now you can ask me why I refer this solution here. Because you should not charge composition scheme rate in the current year, in the year in which you incorporated, beyond 50 lakhs. That's it. That 50 lakhs includes the 1st of April to till the date of liable for registration turnover also. If so, that alone you eliminate. Balance only will attract composition rate. Don't add furthermore 20 lakhs to 30 lakhs to levy. That means what happened? 20 lakhs already deducted and claiming again 50 lakhs. Together how much? 70 lakhs benefit you are getting at composition scheme, which is not allowed. Is it right approach? You please try to follow. That is the reason I brought this to your notice, my dear sir. Please consider this as your updation. Is clear, sir? Shall I proceed, my dear friends? Good. Answer to point number B. Care and Care Beauty Center wishes to opt for composition scheme from the next financial year. You are required to advise it whether it can do so. Now you tell me, what was the turnover of the previous year? Rupees 70 lakhs. The threshold limit to go for composition scheme for a service provider, only 50 lakhs. But he crossed the limit of 50 lakhs in the previous year itself. Therefore, in the current year, Care and Care Beauty Center not eligible for composition scheme. Under section 10, subsection 2, capital A of the CGST Act. Is it clear, my dear friends? My dear friends, now I am referring to you filing of return by a composition scheme assessee. Some changes has been taken place which I am highlighting here. Sir, with regard to filing of return by a composition scheme assessee, the Government of India, upon the recommendation of GST Council, stated that you have to file the return GST CMP 08 quarterly. A payment statement details. Payment of GST, no doubt, GST or 3B. File the return GST CMP 08. Payment also quarterly. Filing the return also quarterly. Due date of filing this GST CMP 08 is 18th of the following month from the end of the relevant quarter. Got the clarity, sir? Further, they are required to file annual return also, which is GSTR 4 for every financial year or part thereof, as the case may be, on or before 30th day of April following the end of the such financial year. For example, a simple thing, financial year, let us say 1920, for which GSTR 4 annual return is 30th April 2020. Got the clarity, my dear sir? Whereas GST CMP 08 is considered is a quarterly return supposed to be by composition scheme assessee by 18th of the following month from the end of the relevant quarter for all the 4 quarters. Same date, 18th of the following month from the end of the relevant quarter. Is it clear, my dear sir? Further, referring to you from here, furthermore, exemptions, very important area, need to be understood. Very important area it is, need to be understood. Exemptions. One clarification I said to you, section 11 option 3 talks about any clarificatory nature amendment taken place which is retrospective effect. Now doubt arises here. Sir, notification, parent notification to grant the exemption issued when, for example, parent notification number 11, for example, issued on 1st July 17. After that, a new entry has been inserted, new entry, let us say 10A, on which date? From 21st September 17. This new entry, not a clarificatory nature, understand, is a new entry to grant the exemption. In that case, that is effective from 21st September 2017. Is it clear? Is that a clarificatory nature? A new entry added in the exemption parent notification, resulting that from the date of insertion, from which date is effective by notification, from that date only it is applicable, like a prospective nature but not a retrospective nature. Is clear? Fine. After that, what happened? In that new entry inserted on 21st September 2017, some omission taken place, some clarification warranted, resulting that Government of India, upon the recommendation of the GST Council, subsequently issued a notification which is a clarificatory nature to the earlier notification within 1 year from the date of earlier notification. If so, in that case, such a clarificatory nature amendment is effective with retrospective effect but not prospective effect. With retrospective effect means, is it retrospective effect of the new entry added or parent notification? The clarification given, it is from the entry, new entry added. Which date new entry added? 21st September 2017. From that date, a new clarification inserted under the new entry number 10A at a later date, maybe on 27th July 2018. If so, that clarification is effective with retrospective effect, with effect from 21st September 2017. Got the clarity? I hope you understand this. I'll also be presenting with a numeric example, one more example. Assume a scenario. Notification number 12/2017 of Central Tax CT is with effect from 1st July 2017. Is clear, sir? Under that, new entry added, let us say 9A. For example, 9A added. If so, in that case, 9A added from with effect from which date? Let us say with effect from, let us say 1st October 2018. Now tell me, this new entry 9A added with effect from 1st October 18. From that date is exemption granted. At a later date, what happened, my dear friends? There is a clarification required. Clarification notification issued on, let us say, 1st December 2018 in entry number 9A. A clarification notification issued on 1st December 2018 in entry number 9A. Now you tell me, this clarification issued from the original entry, new entry, within 1 year? Yes. From 1st October 2018 to 1st December 18, within 1 year, clarification issued. In that case, this clarification is with effect from which date? This clarification, tell me, yes, perfectly correct. With effect from 1st October 2018 is applicable, not from the 1st December 2018. Got the clarity? This is what I want to try to say by way of amendment under section 11, subsection 3 of the CGST. Furthermore, exemptions. Entry number 7. As you are aware of that, my dear sir, supplier of service is government, supplier of service is local authority, where it is not covered under Article 243G or Article 243W of the Constitution of India, is taxable if not qualify from exemption. Is clear, sir? If so, there we referred, other than the forward charge, attract the GST under RCM, provided the exemption not applicable. Assume a scenario, supplier is a government, supplier is a local authority, supplied the security services to business entity. It is not a forward charge, reverse charge, correct? In such reverse charge, Who liable to pay GST? Recipient liable to pay GST. Now the recipient says, my turnover in the previous year not exceeded threshold limit for registration. Then under entry number 7, it is qualified from exemption. Earlier, we had registration purpose, threshold limit 10 lakhs or 20 lakhs only. Now, in the case where for few states, exclusively supplier of the goods, the turnover limit for registration enhanced to 40 lakhs, as you are aware of that. Other than MMNT, Manipur, Mizoram, Nagaland, Tripura. Other than PT UMAS, P for Pondicherry, T for Telangana, U for Uttarakhand, M for Meghalaya, A for Arunachal Pradesh, S for Sikkim. Other than these states, if you are a supplier of goods, exclusively supplier of the goods, in that case, for you, registration limit is 40 lakhs. That amendment taken place under the registration, consequent amendment here also taken place, saying that if the business entity turnover not exceeded the threshold limit for registration, then they are not liable to pay GST under RCM, is the point of this. Got the clarity, my dear sir? Further, from 1st October 19, entry number 9AA, services provided by and to Federation International the Football Association, namely FIFA, and its subsidiaries directly or indirectly related to any of the event under the FIFA Under 17 Women World Cup 2020 to be hosted in India is exempted from GST, provided such exemption will be granted only when the certificate granted by Director Sports, Ministry of Youth Affairs and Sports certifies that the services are directly or indirectly related to the event of FIFA Under 17 Women's World Cup 2020, then only exempted. Whether you provide services to them or FIFA provides services to you, as the case may be, exemption only. Is clear, my dear sir? Further referring to you, page number 11 of your amendment material. From 1st October to 19, it is also be very clearly clarified that earlier we had some problem when in the case where a short-term accommodation services are considered, where the per day per room less than 1,000 only qualify exemption, equal to 1,000 and above will attract the GST, like that. Now it and all made a full stop. GST Council very clearly says, hey industry, don't get confused. If a short-term accommodation service provider provides the short-term accommodation services like hotel, inn, guest house, campsite, whatnot, per day per room, the value charged less than or equal to rupees 1,000 qualify from exemption. Further, 19A and 19B of entries of notification number 12/2017 of the central tax exempted supply of services, where transportation of goods by aircraft from custom station India to a place outside India, such a air freight free from GST, now that is exempted, granted till 30th September 2020. Same way, transportation of goods in a vessel from Indian customs station to a place outside India also be granted the exemption up to 30th September 2020. The sea freight qualify from exemption if the goods are transported in a vessel from Indian customs station, maybe customs port from India to a place outside India, up to 30th September 2020 qualify from exemption. Further, a new entry, my dear sir, my regular class I have not referred for kind consideration, which I am updating now. Entry number 22 of the note number 12/2017 speaks what? You are aware of that. When we talk about hiring of vehicle, a transportation of passengers more than 12 to a state transport undertaking exempted. Is clear? Second point, the transportation of goods vehicle given to a GTA on hire basis exempted. And there also I referred to you the transportation of a staff, a faculty, students of a school or preschool exempted. If so, one is given on hire basis to other to carry this activity of transportation of students, faculty, staff of a preschool or higher secondary school also be exempted. Is clear, sir? There, this one of the amendment has been taken place, saying that by giving a boom to the electrical vehicles as follows. Services by way of giving on hire to local authority, an electrically operated vehicle, EOV, electrically operating vehicle meant to carry more than 12 passengers qualify from exemption. This electrical vehicle carry more than 12 passengers given on a hire basis to local authority. Such EOV, electrically operating vehicle on hire basis to local authority qualify from exemption. Condition should be recipient should be a local authority, the vehicle should be electrically operating vehicle and the capacity to carry more than 12 passengers. More than 12, equal to 12 also be not qualify from exemption. Careful. Further, my dear sir, shall proceed, ma'am. Further referring to you here, exemptions. Sir, these exemptions are really warranted to clarify for many doubts. When we talk about warehouse, the loading, unloading, packing, warehousing of rice was exempted. What about pulses? What about moong, dal, or what about the type of like this fruits or cereals and all? There the difficulty arises, some of the products here not covered under agriculture produce category. If so, taxable or exempted. Earlier we have some difficulty and we simply taxing also. Now the clarification given by saying that by notification given by way of a clear cut manner exemption. Which one is exempted? Services provided by way of storage or warehousing. Only storage or warehousing, but not the packing, not the loading, unloading. So, services provided by way of storage or warehousing of the following are exempted. What are they? Cereals, pulses exempted. Fruits are exempted. Nuts are exempted. Vegetables are exempted. Storage or warehousing of nuts exempted. Storage or warehouse spices exempted. Copra exempted. Sugar cane is exempted. Storage or warehouse of jaggery exempted. Storage or warehousing of raw vegetables fiber exempted. Indigo is this. Also be exempted. Unmanufactured tobacco storage or warehousing exempted. Warehousing of betel leaves exempted, but not the betel nuts. Careful. Further, warehousing of tea exempted, coffee exempted in raw form, warehousing of tendu leaves are exempted, or storage or warehousing are exempted of these goods. Further referring, my dear sir, new entries are given under the note number 12/2017 central tax exempted supply of services. Further, 29B has been added by saying that, sir, exemption is given to whom here means earlier Navy, Air Force, thereafter military, group insurance premium exempted, thereafter added coastal guard group insurance added. Now furthermore our heroes also be added here, saying that Central Armed Police Force, Central Armed Police Force, which is coming under the Ministry of Home Affairs. If so, their group insurance policy also be exempted, like the BSF, CISF or CRPF, these and all. These police forces group insurance premium also be exempted, like Army, Navy, military, coastal guards. For them also exemption, group insurance. Further, entry number 35 here, one particular entry added from 1st October 2019. Premium paid for the benefit of the farmers under the scheme of Bangla Sasya Bhima scheme qualify from exemption. The premium qualify from exemption. Further, dear friends, furthermore amendment here under the entry number 41, minute amendment taken place. As you are aware of that, state government, industrial development corporations or undertakings allotting the plots to industrial units under the lease for a period more than or equal to 30 years, as a result collecting the premium, salami or upfront charges unconditionally exempted. Is it clear? Now there are so many conditional aspects has been brought into force. And moreover, a minute amendment taken place here. State government, industrial development corporation or state government undertaking here, meaning they brought into force. Prior to the 1st October 2019, if the central government or state government or union territory holding not less than 50% or more ownership in the entity directly or through an entity which is wholly owned by the central government, state government or unitary, treated as state government industrial development corporation or undertakings. Now this 50% of stakeholding is not warranted. It is sufficient to hold by central, state or unitary 20% in a particular industrial development corporation or the industrial undertaking, then such industrial undertaking in which not less than 20% of shares or ownership held by the central or state or unitary is sufficient. Such industrial development corporation or undertaking collecting the upfront fees, salami, qualify from exemption by allotting industrial plots for a period more than or equal to 30 years of lease. Here furthermore they are presented by saying that some conditions. Proviso 1 they brought into force here, saying that provided that leased plots shall be used for the purpose for which they are allotted. You cannot use for any other purpose. If you allotted for the industrial incorporation, you have to install for industrial incorporation. Allotted for financial development corporation purpose, for that purpose only you have to use that plot allotted by state industrial development corporation or undertakings. Furthermore, proviso, state government should monitor the project after allotment of the plot. State government should monitor whether the industry is going to be installed. Their operation means they're commencing the operations by installing the particular project in place in time or not, monitored by state government. Furthermore, there any deviation, suppose a company came to state government, let us say Andhra Pradesh, where the Andhra Pradesh state government allotted industrial plot for manufacturing of steel. For that purpose only they have to be manufactured. If they are going to be used for any other purpose as their branch office, as a stock or as a godown unit, not allowed. If they come to know if that particular lessee using that industrial plot for any other purpose other than the purpose for which allotted, then there must be levy of GST on such transaction and collecting the GST with the interest penalties. Further, if that lessee subsequently subleasing to somebody else and clearly mentioned in the agreement, this plot has been allotted by the government, state government, for the purpose of so and so industry purpose, and the operation should be commenced from so and so date or from within so and so period, and like that the detailed information should be mentioned when the lessee going for sublease, and so on. These are the points has been incorporated as amended provision from 1st October 2019 onwards. So summarizing quickly, Industrial Development Corporation, namely State Government Industrial Development Corporation or state undertaking, means the undertaking in which not less than 20% of the stakeholding held by the central, state or UT is sufficient. And further, the allotment of the plot once taken place, and that plot should be used only for the purpose for which it has been allotted. Further, state government should monitor that particular project of the industrial unit, whether they are going to be installed or not. Further, the lessee using that plot for any other purpose other than the purpose for which has been allotted, then in that case, recovery of GST with the interest penalty takes place. Further, if there is furthermore sublease taken place by the lessee, and incorporate clearly the terms and conditions for which the industrial plot allotted by the State Industrial Development Corporation are undertaking to lessee, and it should be clearly mentioned in the sublease also. Is it clearer, my dear sir? Furthermore, referring to you, here need to understand, because of the threshold limit has been changed, this amendment taken place. If your supplier of service being a arbiter tribunal or maybe a advocate or maybe a senior advocate provide these services to business entity is liable to pay GST provided the business entity turnover in the previous year exceeds the limit for registration. Correct? That time 10 lakhs, 20 lakhs was there. Now, if the business turnover not exceed 40 lakhs, where they are the supplier of goods in the state of Tamil Nadu, for example, are they liable to pay GST? Therefore, the amendment taken place by saying that supplier of services being an arbiter tribunal or the advocate or the senior advocate to business entity, where business entity turnover in the previous year exceeds 10 lakhs or 20 lakhs, then business entity being a recipient liable to pay GST. It was the law, now also same law. But that 10 lakhs, 20 lakhs now also be enhanced to 40 lakhs only for few states where the turnover not exceed rupees 40 lakhs, being a supplier of the goods not required for registration. If a business entity is located in the given state, the state limit for registration for the person is 40 lakhs. If the turnover not exceeds 40 lakhs, such a business entity receives the services from these professionals not liable to pay GST. That exemption is presented here. So I mentioned here, aggregate turnover up to such amount in the preceding financial year as makes it eligible for exemption from registration under GST if that business entity receives the services from arbiter tribunal, from advocate, from senior advocate, no one liable to pay GST, exempted. Amendment taken place in registration, causing furthermore amendments are warranted in other places wherever the threshold limit was earlier 10-20 lakhs. Now it has been added 40 lakhs also. That's all, as simple as that. Further, admission to FIFA Under 17 Women's World Cup to be hosted in India, admission fee, irrespective of the fee, qualify from exemption. Got the clarity, my dear sir? Further referring, my dear sir, exempted supply of services where some clarification is warranted. Now if you refer on the screen, Maritime Training Institute. Look here, one of the training institute is here. Let us say here, Delhi Maritime Academy. Such Delhi Maritime Academy providing services to their students, which is in fact run by private people? If so, is it recognized degree providing institution? This point referred by the CBIC and given a clarification saying that maritime courses offered by the private institutions which are approved by Director General of Shipping, which comes under Merchant Shipping Act 1958, under their license, institution providing maritime courses obviously treat as providing recognized degree, resulting that such institution provide these services to their students, staff, faculty qualify from exemption. As you are aware of that, entry number 66 of the notification number 12/2017 of the central tax, where the exemption is given to the following education institutions. 1, the preschool. Tell me sir. 2, the higher secondary school up to 12th standard. Third one, recognized degree providing institution. Further, fourth one, vocational training institutions. If they provide these services to their student, to their staff, to their faculty, qualify from exemption. In this category, maritime training institutes which are recognized by the Director General of Shipping, coming under Merchant Shipping Act 1958, then such maritime training institutions treat as recognized degree providing institution qualify from exemption. Further, my dear sir, referring to you, exemptions. First of all, to have this exemption, you should know place of supply concept. We have section 13, subsection 8, clause B of the IGST Act 2017, where intermediary provide these services, place of supply is location of supplier. Now, in the given case, exemption why warranted is as follows. Services provided by an intermediary when the location of both supplier and recipient of goods are outside the taxable territory. Example, A Incorporation appointed Mr. C as their agent to procure the orders. Mr. C being an intermediary from Chennai, procuring the order from outside India and informing to A Incorporation of USA to supply the goods directly to the buyers. Where goods are moved from USA to, in the given example, on the screen if you refer, Singapore. From non-taxable territory to non-taxable territory, goods has been supplied. From non-taxable territory to non-taxable territory, goods has been supplied, where the intermediary and the commission in India, where the place of supply is in India. In spite of that, under the integrated tax, blessed with exemption, with the condition that goods are moved from outside India to outside India, where intermediate located in India for getting the commission qualify from exemption, even though the place of supply may be landed on taxable territory. Got the clarity, my dear sir? With this exemptions, their new entries as well as the clarifications is concluded. Further referring to you, page number 17 of your amendments material, reverse charge mechanism, where the amended provisions are as follows. As you are aware of that, copyrights temporarily given by author on the book or a music director on the composing of music, or a particular artist or a particular choreographer holding the rights, copyrights on choreography and given to a particular cinema photographic producer, temporary basis, supply of services. Here amendment taking place. Actually, music director, like this, composer of a music, followed by photographer, artist, along with that author was there. From 1st October 2019, the author name has been omitted, remaining as such. If the composer of a music supply the music copyrights to a music company on temporary basis, supply of services, music company being a recipient liable to pay GST if the music company located in the taxable territory. You are aware of that. Am I right, sir? Now, amendment taking place here by removing the author name from that particular list, separately given a provision for the author. The idea behind this is author want to avail the ITC. That's why this provision has been given. Author of a particular original work literary is considered supplier of service by an author by way of transferring or permitting the use or enjoyment of copyright relating to original literary work to a publisher. Supplier is an author, recipient is a publisher located in the taxable territory. Even today, on or after 1st October 2019, it falls under RCM only. However, this provision of RCM not applicable in the given case where author himself undertaken responsibility to pay the GST on the copyright temporarily transferred to the publisher, where he exercises the option by declaring declaration by taking separate registration to GST as a supplier of service and declared in a declaration form Annexer 1 to pay the GST by him. The author he exercises this option to pay the GST and copyright spontaneously. Once accepted or option exercised, then for a period of 1 year, such option should not be withdrawn, and the author makes a declaration as prescribed in Annexer 2 on the invoice issued by him, stating that the invoice GST, INV, invoice 1 to the publisher. Then the moment the invoice received from author by the publisher, is it form GST INV 01? Fine. Then in that case, this invoice supplier author liable to pay GST. It is an intimation to the publisher, and the author being a supplier can mention in the invoice separately the GST amount, and in that case publisher being a recipient discharged from his liability to pay GST and RCM. So author of a original literary given copyright to publisher as such under reverse charge. However, reverse charge not applicable in the case where author spontaneously accepted to pay forward charge by him by registering under CGST and paying the GST under forward charge by declaring a declaration, and exercise the option to pay forward charge should not be withdrawn for a period of 1 year from the date of exercising the option. In that case, issue form GST INV 1, namely called as a invoice forward charge applied by showing the tax amount, publisher being a recipient not liable to pay GST. Further, my dear sir, reverse charge categories, very important. Renting of motor vehicle, is exempt supply. Where? No, can you tell me please, where exempt supply, please sir? Renting of motor vehicle, exempted supply if it is rented to a school, namely preschool or a school education up to 12th standard for carrying the students, staff, faculty, and raise the bill to the school or preschool, qualify from exemption. Further, if it is a taxable supply, generally forward charge. From 1st October 2019, the law made amended here by saying that if any person supplied renting of motor vehicle being other than body corporate, supplier should be other than body corporate, and such a supplier opted to pay the GST 2.5%, CGST 2.5%, SGST where input tax credit not availing on input goods, input services and capital goods except input services from similar line of business. In such case, Recipient should be a body corporate. Recipient should be a body corporate incorporated in the taxable territory. You get my point, sir? Supplier should be other than body corporate, opted to pay GST 2.5% CGST, 2.5% GST, where he cannot avail ITC except input services on similar line of business. Recipient should be body corporate, incorporated in the taxable territory, then only reverse charge applies. Otherwise, forward charge only. Is clear, my dear sir? Here, one should understand that renting of motor vehicle which is designed to carry passengers, that is very important. Further, supplier other than body corporate charging the rental charges should include cost of fuel. Cost of fuel is included in the consideration, namely rental charges, where the motor vehicle designed to carry passengers given on rental basis by a person other than body corporate to a person, namely body corporate, then it falls under reverse charge provided supplier paying the GST 2.5% CGST, 2.5% SGST. He should not opt 6% CGST, 6% SGST. Then is a reverse charge. Is clear, my dear sir? Further, my dear friends, under reverse charge, securities lending services. Generally, securities market, transactions of securities including derivatives is neither goods nor services. But CBIC very clearly clarified by giving explanation, securities lending services, it is not come under the category of securities market. It is maybe in relation to securities but not securities transaction. Like a stockbroker buying and selling the securities for their clients, earning the brokerage, will attract the GST or not? Yes. So in relation to securities, brokerage commission will attract the GST in the hands of stockbroker. Similar to this, a securities lending services, how it takes place. First, I will give some information about the securities lending market. Now look on the screen, my dear. Owner of securities. Assume a scenario. I am Mr. Rafi. Being an individual, owned certain securities which are trading in secondary market, Bombay Stock Exchange or maybe NSE, National Stock Exchange, as the case may be. Mr. Rafi owned securities. How many shares? 1 lakh shares of a reputed company. 1 lakh shares whose worth almost all at par 1 crore rupee, for example. Mr. Rafi owned 1 lakh shares worth 1 crore. But today, due to the corona COVID-19 virus, stock market, as you are aware of that, not doing well. Mr. Rafi wanted to sell, but very, very less price. If I sell, I may get hardly 30 lakhs. That means what? Almost all 1 crore worth of my shares. If I want to sell it today at 30 lakhs, I am booking the loss of 70 lakhs. So I am not willing to sell the shares. Mr. Rafi, being a owner of shares, not willing to sell the shares because the market not so good. At the same time, entire 1 lakh shares, almost his investment 1 crore rupees is lying in my hands idly. There is no much productivity from this. So I got a thought. I am not willing to sell, but I can lend my securities to some borrowers. Therefore, I approached in BSc or NSC, who are the intermediaries for lending my securities. I came to know that intermediary and in the Bombay Stock Exchange or National Stock Exchange, intermediary nothing but broker. Let us say a high net worth institution, let us say LIC, Life Insurance Corporation, is a high net worth broker, one of the wing of LIC, in particular Bombay Stock Exchange, acting as intermediary. Let us say we can also call broker, who are none other than intermediaries under Bombay Stock Exchange or National Stock Exchange, who deals with borrowing and lending of securities business. So Mr. Rafi approached broker, one of the wing of LIC acting as a broker in the BSc, approached the LIC saying that, hey Mr. Intermediary, I have 1 lakh shares. I am willing to lend for a period of, let us say, 60 days. I am depositing with you. I am depositing securities with you for lending purpose. Then the intermediary said, yes, please give your securities, which is in demat format. We will consider for lending purpose. So this particular owner of the securities deposit with intermediary his securities. Here another person, let us say NBFC, which is one of the financial institution, let us say such a NBFC being a borrower, approached broker intermediary for the want of borrowing my shares from such intermediary for 60 days. Thereby such intermediary agreed to provide my shares for 60 days to such NBFC by charging per month, let us say 2 lakh rupees rental charges. So in this case what happened, NBFC being a borrower of my shares of 1 lakh shares agreed to pay per month 2 lakh rupees, for 2 months 4 lakh rupees. NBFC came to know my shares are available for borrowing from intermediary. Therefore NBFC received my shares to trade in the share market. Arbitrage, it is one way or the other. NBFC trading my shares in the particular share market, namely forward contracts, where put option, call option, willing to sell but not to sell, such things are there. So trading, in that case what happened, during that 60 days period, if my shares price gone up extremely more than my investment, but this particular Rafi who owned the 1 lakh shares cannot able to sell because it is lended, it is lended deposit with the security market, namely with the intermediary. During that period of 60 days, Mr. Rafi cannot touch his shares. He is not the seller of the shares, but he given this to intermediary for borrowing by others. So others are borrowed my shares for 60 days, which is lock-in period. I will get only the particular rent, rupees 2 lakhs per month. For 2 months, 4 lakhs. But I cannot sell during the period. So borrower, NBFC, trading in the market, buying and selling, creating the artificial price for that and gaining some money. At the end, 60th day, that particular NBFC handing over those shares to the intermediary, and intermediary calling Mr. Rafi, hey Mr. Rafi, take your rental charges of rupees 4 lakhs for 60 days and take your shares back. Here, there is no sale of securities. So rental charges earned by Mr. Rafi, being a supplier of service, lender here, supplier of service. Who is the recipient? The borrower is the recipient. And intermediary, being a broker, whatever commission he charged from the borrower as well as lender, that is obviously taxable forward charge. But the rental charges paid by the borrower of the shares to Mr. Rafi, in our given example, to lender, is taxable supply. Under RCM, recipient only liable to pay GST on such 4 lakh rupees rental charges paid by borrower to lender. Is it clear, my dear sir? Which is RCM. So, recipient being a NBFC, in our given example, should pay the GST under RCM. Commission earned by the intermediary from this lender as well as borrower will be attract the GST forward charge in the hands of broker. But Rafi got 2 lakh rupees for 30 days, for 60 days 4 lakh rupees commission or rental charges, whatever earned by Mr. Rafi, in the given case being a lender, taxable in the hands of recipient, namely in our given example, NBFC being a recipient liable to pay GST. Got the clarity, my dear sir? Any difficulty in the given case? Securities, borrowing and lending services. In the given case of securities, borrowing and lending services, borrower only liable to pay GST under RCM being a recipient of service. Got the clarity, my dear sir? I also explained to you simultaneously how the securities lending services takes place, which is taxable services under GST. Is clear, my dear? Time of supply. Here, what is the amendment by way of clarification? This clarification speaks, sir, time of supply for builders or promoters separately drafted. What is the time of supply in the case of a joint development contract where the builder is received the TDR, transfer development rights, FSI, floor space index, or long-term lease more than or equal to 30 years lease from the owner of the property? In that case, that supply is exempted provided the builder is going to pay the GST under construction supply. If not going to pay the GST under construction supply, the transfer of a TDR, FSI, long-term lease is under RCM. Who liable to pay GST from 1st April 2019? Builder or promoter liable to pay. What is the time of supply in the given case? Time of supply in the given case is simple. The issuance of completion certificate or first occupation of the project, whichever is earlier. Even tomorrow the builder allotted the plots to the owner of the land. For that also the time of supply is first occupation of the project or the issuance of completion certificate by the competent authority, whichever is earlier, is a time of supply. But don't forget, if the builder allotted the plot to the prospective buyers, outsiders, for them time of supply, you are aware of that, as per continuous supply of service. More than 3 months time taking to complete accordingly. Is clear, my dear sir? Further, referring to you from here. Place of supply amendments, in the sense clarification by CBIC, which is really warranted. Sir, where in India, Indian software companies, Indian software companies, providing multiple services to the client who are outside India, like 1. Software development and design services for integrated circuits electronically, testing software on sample prototype hardware, and like so on and so forth. All put together, we are today called as composite supply. Its principal supply is software development services. Where it falls, it is going to be fall under section 13 subsection 2 of IGST, because location of supplier from India, location of recipient from outside India, section 13.2 says that recipient identifiable in the ordinary course of business is the place of supply. Obviously, recipient is from outside India, resulting that place of supply is outside India, location of supplier in India, payment received in the foreign currency or in INR, wherever permitted by the Reserve Bank of India, will be called as export of services, falls under section 2, subsection 6 of the IGST, resulting that clarification very clearly says that it should be referred only from 13.2 point of view, not from any other section point of view. Section 13 subsection 2 of the IGST speaks the place of supply where the location of recipient is the place of supply. In the case of composite supply of this type of nature. Got the clarity, my dear sir? Further, referring to you, one more important area. You know, section 13 subsection 3 of the section 13 subsection 13 of the IGST. Section 13 subsection 13 of the IGST, where power to notify circumstances thereby to decide the place of supply for taxing non-taxation cases or to avoid double taxation cases. In such case, using such a power, Government of India upon the recommendation of GST Council said that in the given case where research and development activity carried out in India on the products, research and development activity carried out on the product in the pharmaceutical sector. Important point is research and development in pharmaceutical sector in India carried out for the companies located outside India. One of the example, Reddy Labs in India conducting the research and development in pharmaceutical sector for a foreign company. Let us say for a South African company, Phoenix Limited. For them in India, Ram Pharmaceuticals, one of the example, carried out recent development activities in Hyderabad, services carried out in the pharmaceutical sector. One is, it should be a pharmaceutical sector, research and development carried out in India by Indian companies to foreign company. In that case, generally it is supply of services and tangible goods. It falls under section 13, subsection 3, clause A, where performance performed is a place of supply, which goes in India. To avoid this taxation, the Government of India upon the recommendation of GST Council said, sorry, it falls under section 13, subsection 2 only, not under section 13, subsection 3. Resulting that what happened, effective use or enjoyment of this output is by the foreign company, therefore place supply goes to foreign company, place supply is outside India. Like that, decided by the CBIC by issuing the circular in this regard. Government of India said it is to be followed like this upon the recommendation of GST Council. That means research and development in relation to pharmaceutical sector carried out in India for foreign companies, place of supply goes to outside India. Now what happened here? In that given case, location of supplier is recipient, is as referred under section 13, subsection 2 of IGST. Got the clarity, my dear sir? Section 13, subsection 2 of IGST. Location of recipient identifiable in the ordinary course of business, yes, Phoenix Limited, South Africa identifiable, goes to outside India. Thereby what is to be satisfied here is section 2 subsection 6 of the IGST, export of service, all conditions should be satisfied except place of supply. Though it may be in India, which is shifted to outside India by using the power by the government of India upon the recommendation of GST Council under section 13 subsection 13 of the CGST. I mean to say IGST. No CGST place of supply. Only IGST refers here. Has notified the place of supply. Got the clarity, sir? Location of the recipient is the place of supply in the given case, using the power of section 13, section 13 of the IGST Act. Further, my dear sir, referring to you further, place of supply with regard to various services carried out at port by Port Trust Authority of India. Port Trust Authority of India carrying out various activities like permitting to store the goods of imported goods or before exporting the goods on their docks, and security providing services to that goods like that. In that case, is it section 12 subsection 3 of IGST, service related to immovable property? Because using the port, they are providing services. Is it so? Because Port Trust Authority of India providing various services to the customers, storing, halting, hooking the langar for the vessel, and storing the goods, providing security of the goods, cleaning that, and all activities. Many activities are providing, multiple activities. Is it under what category of place of supply can be decided? For the service rendered by Port Trust Authority of various ports in India, means clarification given by CBIC, it should be as per section 12 subsection 2, namely default provision, where the location of supplier and location of recipient from India, place of goes where if the recipient is registered person, location of the recipient. If the recipient is registered person, the recipient address available with the location of the supplier, recipient address is the place of supply. If that is also not available, location of supplier is the place of supply. In the case of section 13, section 2 of IGST, where location of supplier or location of recipient from outside India, place of supply goes location of recipient if the recipient location is identifiable. If not, location of supplier is the place of supply. Accordingly, you should decide, but not as per section 12 subsection 3. Various service rendered by port to the customers should be section 12 2 of IGST or section 13 subsection 2 of IGST to decide the place of supply. Is clear, my dear sir? Further, very important, not a new thing but a very important thing to note, sir. This particular page number 24, place of supply important. Sir, first of all, what happened here, to identify this you should know one thing. You are aware of that section 13 subsection 3 clause A of IGST. Services supply are provided on tangible goods, where the performance actually performed is a place of supply. Correct, brothers? You are aware of that. Fine. In that given case, my dear sir, what happened? If you imported motor temporarily to repair in India and exporting back after repair without being put to in use, there you are aware of that it should not be as per section 13(3)(a). It should be section 13(2). Is clear? If that is the case, if I imported diamonds, like supply of services on unpolished diamonds, such as cutting and polishing activity, which have been temporarily imported into India and are not put to any use in India. Repeating, supply of various services on unpolished diamonds, such as cutting and polishing activities, which have been temporarily imported into India and are not put to use That means I imported diamonds to carry out in India polishing activity, cutting activity. After did so, exporting back without use in India. So here such a polished diamonds and cutted diamonds after polishing in India, exporting back without being put to use. In that case, is it section 13(3)(a) where the place of goes in India, or section 13(2) where the place of supply is location of recipient outside India? Clarification given by CBIC, it should be as per section 13(2) of IGST. But one should ensure that goods should be exported back after polishing and cutting without being put to use in India. Obviously, it is not going to be put to use in India because it is a machinery to test is a diamond by looking and understand. Again, using, wearing and enjoying quite some time exporting back, not possible. Not allowed. Is clear, my dear sir? Further, I mean to say that unpolished diamonds are imported for polishing, cutting in India and exported back after polishing as well as cutting the diamonds without being put to use. The place of supply goes outside India as per section 13 subsection 2 of IGST, which is export of services, obviously. Similar to unpolished diamonds where cutting, polishing taken place in India, place of supply is location of recipient. Similar way, one more amendment taking place here in the recent past with regard to transaction business to business. From 1st April 2020, maintenance, repair and overhaul services have been notified as the services for which the place of supply shall be the place of effective use and enjoyment of a service as given under. How to understand this? Similar way of the unpolished diamonds, polishing in India, cutting in India and sending back to outside India to the recipient, where the place of supply goes to location of recipient. Similar way, here also drafted by saying that supply of maintenance, repair or overhaul services in respect of aircraft, aircraft engines and other aircraft components or parts thereof supplied to a person for use in the course or furtherance of business after carrying out these services on such aircraft, aircraft engines and other parts of the aircraft, the place of supply shall be the location of recipient. Location of recipient. How to understand? With the example. Look here, my dear sir. Assume a scenario, C Limited in India, a registered person received this type of aircraft, aircraft engines, spare parts for, let us say, overhauling purpose. For, let us say, overhauling purpose. Imported for overhauling purpose. After completion of the services in India on such aircraft, aircraft engines, exporting back to A of incorporation from whom it was imported earlier for overhauling purpose. If so, effective use or enjoyment of this particular given service goes to the recipient place. Thereby, place of supply is the location of recipient, namely USA, in the given example. Understand, my dear sir? Furthermore, sir, points to be referred here. Value of supply. Clarifications are issued by CBIC in the recent past by way of separate circular. So donation, especially. What type of donation? Donation is given out of love and affection. without expecting anything in return, without having symptoms of quid pro quo, in that case, that is not a consideration for the recipient. Example, good wishes from Mr. Rajesh, printed underneath a digital backboard donated by Rajesh to charitable yoga institution. Charitable yoga institution is eligible to claim donation, is eligible to receive a donation. To them, Mr. Rajesh donated by providing, saying that donated by Rajesh, a particular digital backboard has been donated. Is a consideration for the charitable yoga institution? Obviously not, because by doing so, Mr. Rajesh not getting any direct or indirect benefit. Same manner, example 2, donated by Srimati Malati Devi in the memory of her father, written on the door or floor of room or any part of a temple complex which was constructed from such donation. So Malati donated some money by memory of her father, just mentioned, donated by Srimati Malati Devi, that's all. Who is she? Nobody knows. Malati Devi donated. There is no undue benefit getting by Malati Devi from the particular temple. Thereby, there is no quid pro quo, resulting that such a donation not a consideration. However, if any donation given like this, Mr. Rafi given donation to a particular charitable institution, saying that Rafi Academy, IDT classes, commencing from 1st April, fee just rupees, call cell number. Like that, printed on a particular door of a charitable institution where I donated. That is not a donation, is a consideration. Will attract GST because undue benefit I am getting in return. That means to say there is a quid pro quo is there. Meaning of that. That is called supply. Got the clarity, my dear sir? So this is a way in which clarification given by CBIC. Further, value of supply where rule number 33, you are aware of that. Pure agent services. If a supplier of goods or services provided services in relation to pure agent nature and reimburse that expenditure, obviously not form part of value of supply. In the given case also, my dear sir, CBIC given clarification. Look here. Here, airport operator. Assume a scenario, Mumbai International Airport Limited, operating Mumbai Airport. Passengers coming inside, see, look like 7-star hotel. Luxurious of treatment inside. In the sense, if you go to hall for sitting, luxurious manner, you can sit in the chairs, full centralized AC, well maintained restrooms, drinking water, hot, cool, normal water, like that. There are so many facilities are providing by airport operators to the customers. Is it free of cost? Obviously not. Airport operator telling, hey Mr. Air travel operators, SpiceJet, Indigo, so on. Your customers are coming to my airport. I am giving high-tech services to them, for which I want charges. Collect from your customers and pay to me. Then air travel operator says, yes sir, we collect for that. How much sir? Say 100 rupees per passengers. Per passenger 100 rupees. Fine. These air travel operators collecting 100 rupees from the passengers towards user development fee or passenger service fee. Collecting from passengers 100 rupees, that 100 rupees paying to airport operators. Here, air travel operators acted as a pure agent that 100 rupees towards user development fee or passenger service fee absolutely not taxable in the hands of air travel operator, but it is taxable in the hands of airport operator, which is inclusive of GST, which is inclusive of GST. For example, I said 100 rupees is inclusive of GST, airport operator paying the GST. Now, collecting the passenger service fee or user development fee from their customers and paying to airport operators. For doing such service, air travel operators asking, hey Mr. Airport Operator, for you I am doing the service, collecting from my customers, your charges and paying to you. For doing so, could you pay some fees to me? That fees is taxable in the hands of air travel operator. Got the clarity, sir? Is the way in which clarification given by the CBIC I mentioned here with the ITC credit allowed to them. Got the clarity, sir? Any difficulty, my dear sir, in the given case? So I am referring here. Passenger service fee or user development fee not taxable in the hands of airlines is a pure agent. However, airport operator paying the GST inclusive basis on such passenger fee or user development fee. Moreover, collection charges paid by the airport operator to airlines or consideration for the service provided by the airlines to the airport operator, and airlines shall be liable to pay GST on the same under forward charge. Airlines operators liable to pay GST. ITC of the same will be available with airport operators, obviously. Got the clarity, sir? Any difficulty, my dear sir? Further, under value of supply, very important clarification is this. Delay payment charges like interest, penalty or penal interest and all is taxable, form part of the value of supply or not value of supply, beautifully clarified by the CBIC in the recent past, saying that, look here, value of supply excludes, which one excludes? Interest, late fee, penalty, penal interest excludes, not form part of value of supply. When there is a supply in the form of loan by bank, which is not taxable, interest on the bank loan also be not taxable, penal interest for delay payment of the loan also be not taxable. This is an exemption granted. Like interest, penal interest also, since it is a money transaction. However, if there is a supply of goods, supply of services, where it is given on credit basis, is taxable supply. At the same time, while repaying the while repaying interest also paid, that interest also be attract GST because it is forbearance to do an act, tolerating an act like that character is a consideration liable for GST. Penal interest thereon also be attract GST because it is not a money transaction. How to understand this particular thing alone? Very simple. I sold laptop for rupees 40,000 on credit basis for 4 installments. You have to pay 11,000 per installment. That means I am collecting 44,000. In the given case, cost of the goods how much comes here? 40,000. Interest I am collecting how much here? Almost or how much? 11,000 means 4 installments, 4,000 interest. Thereafter, delay happened to pay, where I am charging delay payment charges, penal interest 2,000. Is it taxable? Yes, taxable. While repaying the interest taxable? Yes, taxable, because supply of goods, supply of services, not the money. Then delay happened to repay the installments, penal interest also taxable, is taxable. Got the clarity, my dear sir? Understand the difference between this and this. Here, money transaction. It is supply of goods, supply of service transaction. Is it clear, my dear sir? Further, another important clarification given by CBIC. Very important to note here. Sir, Residential Welfare Association, which is unincorporated body or a non-profit entity registered under any law for the time being. This is a point already referred by me in regular class. Again, I am referring in a beautiful diagrammatic presentation. That's it. For a revision purpose. Yes, my dear sir. Shall I proceed, Amma? Fine. In that case, GST on Residential Welfare Association, where they are collecting the monthly maintenance less than or equal to rupees 7,500 per member per flat, fully exempted. Is clear, my dear sir? If such a Residential Welfare Association collected the monthly maintenance more than rupees 7,500 per month per flat per member, then in that case, entire value whatever collected will attract GST. One clarification. Further, attract the GST in the hands of Residential Welfare Association provided Residential Welfare Association is a taxable person. Their turnover should might have been exceed 10 lakhs threshold limit for registration. In the case of MMNT or other states, they should have been exceed the turnover of rupees 20 lakhs. They should be taxable person. RWA is liable to pay GST only when they are taxable person. Their turnover exceeds the threshold limit for registration, then the amount collected per month, per member, per flat exceeds rupees 7,500. Whatever they collected, the entire value attract GST, not worried about rupees 7,500. For example, if they collected 8,000 rupees per member for plot, entire rupees 8,000 is attract GST in the hands of Residential Welfare Association, provided Residential Welfare Association is a taxable person. Means the turnover for registration should have been exceeded the threshold limit. Got the clarity, my dear sir? Is the way in which clarification given. Now here, one more clarification here. For example, Mr. A own 2 flats. He paid monthly maintenance rupees 4,200 per flat. Therefore, here he has 2 flats, no, multiply by 2. He paid rupees 8,400 to the association, taxable. Though the entire value might be exceed rupees 7,500 per member, per flat, per month. How much? 4,200 only. Therefore, which is less than equal to 7,500. Entire value qualify from exemption. Entire 8,400 not taxable because monthly maintenance per month, per member, per flat is not exceed rupees 7,500. Got the clarity, sir? This is the way in which clarification given by the CBIC. Furthermore, amendment in the value of supply with effect from 1st March 2020 onwards. 1st March 2020 onwards. In case of lottery, as you are aware of that, the state government is authorized to sell the lotteries as supply of lottery run by the state government or the lottery authorized by the state government. Earlier, in case of lottery run by the state government is considered, the valuation will be 100 divided by 112 multiplied by the value of the ticket, which is MRP value. For the authorized by the state government lotteries, 100 by 128 multiplied by the MRP value of the lottery. It was. Now, with effect from 1st March 2020 onwards, whether it may be state run lottery or state authorized lottery, as the case may be, the MRP value of ticket multiplied by 100 by 128, 28% is the GST, 14% CGST, 14% GST. That gives you value of taxable supply, value of taxable supply. So the amendment here is that 12% of GST has been removed and now uniformly applicable 28% GST for the lottery run by the state government or lottery authorized by the state government. GST, CGST 14%, SGST 14%, thereby 28%. So to find out the value of taxable supply in the case of lottery, which is in the MRP value of lottery ticket multiplied by 100 divided by 100 plus GST, namely 28%. So 100 plus 128 is equal to value of taxable supply, or the 100 divided by 128 of the price as notified in the official gazette by the organizing state. Among the two, whichever is higher is the value of taxable supply on which liable to pay GST by the seller of lottery agent under RCM. You are already aware of that. Is clear, sir? The GST rate has been uniformly applicable now for lottery run by the state government, lottery authorized by the state government. Is it clear, my dear sir? Then how to arrive the value of taxable supply? 100 by 128 multiplied by MRP value of ticket, compare with 100 by 128 multiplied by the price notified by the state organizing lottery state organizing state notified the price in the official gazette. Among the two, whichever is higher is the value of supply. Is it clear, my dear friends? The same has been highlighted in a simplified lollipop manner. Look and understand. In the given case, 100 by 128 multiplied by face value of lottery ticket, it may be state run, state authorized, as the case may be, compared with 100 by 128 of the price notified by the in the official gazette by the state government of organizing the lottery. Among the two, whichever is higher is the value of taxable supply on which pay GST by selling agent of lottery ticket under RCM. Got the clarity? Furthermore, my dear friends, what is the provision of this? A facility is given. When I made an application for registration GST RAG 1, I may not be in a position to provide my bank details, but I got registered. GST RAG 6 certificate of registration has been granted to me. In that case, such assessee should inform the department their bank account details, where they have the bank account, each bank, what is the account number, IFSC code, that and this branch of the bank, where I have the branch, my account, in which branch of the bank I have. These details should be submitted. The time limit has been mentioned. Facility is granted to the taxpayer. A registered person who obtains form GST RAG 06, namely certificate of registration, has the option to give his bank account details after obtaining registration within 45 days from the date of grant of registration or the due date for furnishing the return, whichever is earlier, within which I have to be submit my bank details to the Department of GST. However, if a person violated this, not furnishing the return, the bank details within a period of 45 days from date of registration or the due date of furnishing the return, whichever is earlier, within which if I have not submitted, violated the provision, my registration liable for cancellation. However, this facility to provide bank details within a period of 45 days from date of registration or filing the return for the given period, due date of the return, whichever is earlier, facility not granted for the person who registered under GST as TDS deductor or as TCS collector. For them is considered this option to submit the bank details within a period of 45 days from registration or due date of furnishing the return, whichever is earlier, such option not given for the assessees who registered under the GST as a TDS deductor or as a TCS deductors. For them, at the time of registration, they have to provide the bank details. further. And one more point, sir, here. Such an option of providing bank details within a period of 45 days from the date of registration or the due date of furnishing the return, whichever is earlier, also be not given. Who obtain the registration so moto, means, listen here. So moto registration, rule number 16 of the CA GST rules deals with this, my dear. Further, look here. During any survey, inquiry, inspection, search or any other proceedings, the proper officer finds that a person liable to registration but not registered, such officer may register the said person on temporary basis. Important to note, on temporary basis, and issue an order in form GST REG 12. Got the clarity, my dear sir? Further, the person to whom temporary registration is granted has to apply for normal registration. Here, person to whom a temporary registration has been granted shall, within 90 days from the date of grant of such temporary registration, submit an application for registration, namely normal registration. Form GST REG 1 for normal registration, GST REG 07 for application for registration by TDS deductor or application for registration by a TCS, namely tax collected source person. They have to submit GST REG 07 for application for registration as a TDS deductor, as a TCS deductor, GST REG 07. They have to apply. Normal SSC, normal other than the TDS, TCS, apply GST REG 01. 90 days time period from the date of granting GST REG 12, namely temporary registration from that date to 90 days. If I went for appeal, if the said person has filed an appeal against the grant of temporary registration, in such case, the application for registration shall be submitted within 30 days from the date of the issuance of the order upholding, confirming the liability to registration by the appellate authority. Then from the date of the order of the appellate authority, within 30 days, I have to apply for normal registration. Got the clarity, my dear sir? What is my effective date of registration? Effective date of registration is the date on which order of granting temporary registration to me, namely GST REG 12. From that date is effective date of registration for me. That's very important. Effective date, registration is effective from the date of such order granting registration in form GST REG 12. Got the clarity, my dear sir? As per section 25, subsection 6 of the CA GST Act, which very clearly says that a person who making the application for registration should have to have a valid PAN number issued by the Income Tax Department. Now, a case where the person liable to deduct TDS under section 51 of the CA GST. For them, if they not possess the PAN number, in that case, law permit for them to have a registration under GST as a TDS deductor by providing tax deduction and collection account number. Tax deduction and collection account number issued by the Income Tax Department is highly valid and sufficient to get registered under the GST law as a TDS deductors. But for others, PAN number is must. Is clear, my dear sir? Further, authentication or furnish of proof of Aadhaar number now made mandatory, my dear sir. Every registered person who already got registered without holding the Aadhaar number, now they should be provide their Aadhaar number and authenticate it. If you not submit the Aadhaar number, being the registered person under GST, and you not authenticated that Aadhaar number, yes, is a valid Aadhaar number. If you not prove that, your registration stands cancelled only. Therefore, Aadhaar number is must today to authenticate. Even for a registered person already got registered in GST law, now they should be authenticate their Aadhaar number. If already authenticated at the time of registration, very good. At the time of registration earlier, Aadhaar number was not warranted earlier. In that case, that Aadhaar you are not owned. In that case, now ensure that you have to have a Aadhaar with you and authenticate it by providing such a valid number to the GST portal, and they will provide you OTP and authenticate it by providing that OTP number in the system network portal. Further, if it is not authenticated by the registered person, Aadhaar is not owned, in that case, any other proof recommended by the government also be not owned. In that case, your registration treated as cancelled only. This is what they says here. Provide further that in case of failure to undergo authentication, then the lawmaker says that as if this particular registration provision not applicable for you, it means registration allotted to such person shall be deemed to be invalid, as if you are not a valid registered person of GST law if you are not able to authenticate your Aadhaar number. Further, the assessees who are coming forward for registration now, even from 1st April 2020 onwards, must authenticate their Aadhaar number at the time of registration itself. This point number 6A is referred to you for a registered person already under GST. I refer 6B for the person who are applying for the want of registration, and at the time of registration making the application, you should have to have a valid Aadhaar number also. Further, if you are not an individual, then you may be a HUF. Karta Aadhaar number is valid. In the case of partnership firm, partner's Aadhaar number is to be authenticated. In the case of corporate company, managing director, whole-time director, or the person authorized by the company, his Aadhaar number should be authenticated. If not, as if you are not applying for registration. Further, such a Aadhaar number not warranted if the government of India, upon the recommendation of the GST Council, notify certain class of persons, for them Aadhaar number not required, which is yet to be notified by the government. Is clear, my dear sir? Further referring from here, as you are aware of that, from 1st April 2020 onwards, applicant who made application, who submit the application form GST RAG01 for the want of registration should possess valid Aadhaar, and it should be authenticated through GST network portal. Now, a case where if such applicant not in a position to authenticate his Aadhaar, or he may not be own the Aadhaar for the time being, in that case, department says, we will come to your premises for having physical verification in your presence, not later than 60 days from the date of making the application for registration. Once they are satisfied, they will grant the registration and they will ask you to apply for Aadhaar and submit it by authenticating through GST network portal. Thereby what happened, rather than to reject application for registration just because of the Aadhaar not there, then the department may be loser of the revenue. Therefore, department says, hey Mr. Applicant, you are not authenticated your Aadhaar. No problem, we will come to your premises, will verify whether you are properly existing in the same place or not, being a supplier of the goods, supplier of services, within 60 days from the date of your application. That means not later than 60 days, the department will verify the physical premises of the applicant in the presence of the applicant. Once the department is satisfied, they will grant you certificate of registration and ensure that in the meantime you apply for the want of Aadhaar and authenticate it, is the meaning of that. Got the clarity, my dear sir? Further, here important point, if the department coming not later than 60 days from the date of application for physical verification purpose of the premises of the applicant should not say, I got deemed to be registered. You cannot say. Where you are not in a position to authenticate your Aadhaar, department will come to your place, physically verify whether you are a genuine person or not. Not later than 60 days from the date of application. In the meantime, you should not say that I am deemed to be registered. You cannot say. Got the clarity, my dear sir? Further referring to you, my dear sir, the case of this, what is this provision speaks? Already we have a particular existing provision with regard to registration to collect tax at source, TCS, for e-commerce operator. A e-commerce operator basically incorporated having the principal place of business in the state of Tamil Nadu. E-commerce operator has place of business in the state of Tamil Nadu. In the rest of the states, he has no place of business. But he is liable with the TCS, even for the supplies made in the other state. Therefore, this e-commerce operator who is mandatorily to register under GST as a collector of TCS, as referred in section 52 of the CGST, he made an application for the want of registration as a TCS deductor. There, in that application, such e-commerce operator should also disclose in Part A the states in which that e-commerce operator has no place of business. It is already existing provision for e-commerce operator who is a deductor of TCS. This provision now extended to even deductor of TDS, tax deducted at source. Corporation of Chennai is wanted to make application for the want of registration as a TDS deductor as referred under section 51 of the CGST. Such a corporation of Chennai is basically incorporated principal place of business Tamil Nadu. In the rest of the states, they won't have the place of business. Therefore, while making the application to the department for the want of TDS registration, in that registration application, Part A, that Corporation of Chennai should disclose that the rest of the states where they have no place of business should also be mentioned. Part B, when they are submitting for the want of registration as a TDS deductor, there they should disclose their principal place of business where they exist. So, the provision so far applicable to TCS now also be extended to a person who required to register under GST law as TDS deductor. Got the clarity? Where the TDS deductor should disclose in the registration application the state in which he has no place of business in Part A. Part B, the TDS deductor where he has place of business, principal place of business in which state he has, that should be disclosed in Part B. As simple as that requirement while making application for the want of registration. Got the clarity, my dear sir? Further referring to you here, the furthermore provision here, a registered person required to issue revised tax invoice and file first return for supplies during the suspension period. This is important provision. I already explained to you with the help of an example. What example I explained to you, my dear? I said to you, a person liable for registration, within 30 days he made application for the want of registration, he obtained the registration. Effective date of registration, the liable for registration is affidavit of registration. From the date till the date of obtaining certificate of registration, whatever he made supplies, he called those supplies invoices and revise it and issue with the tax. We call revised tax invoice. Am I right or not? For that mean period, that person should be submit dash first return. You also recorded example. Am I right? Now, that concept is mutatis is applicable in the given case where a registered assessee whose registration suspended temporarily, for example, 3 months suspended. Thereafter, revocation taken place. Now, a registered assessee whose registration is under suspension for a period of 3 months. Thereafter, suspension revoked. In that case, for the 3 months period, under the suspension, that supplier supply the goods or services should not be taxed with any tax amount because his restriction under suspension. He will supply the goods or services without taxing such supplies. After 3 months, what happened? Suspension has been revoked, lifted. In that case, for the 3 months period, whatever supplies he made, those invoices he can call back, revise that invoices with tax portion, resulting that he can do so as per the provision of section 31, subsection 3, clause A. Such revising of tax invoices is within 1 month from the date of lifting the suspension of his registration. That means to say that during the suspension period, the invoice what he issued without tax portion, call back, revise it. Say revise tax invoices. Within which period how to issue such a revised tax invoice means within a period of 1 month as referred under section 31, subsection 3, clause A. Within 1 month from the date of lifting of suspension here. You can revise it within 1 month from the date of lifting of suspension. Now, for the 3 month period, whatever you revise the invoices, called revised tax invoices, that data you should be submit to the department in the name of first return as referred under section 41 of the CGST. That means what I referred earlier, mutandi is applicable for the given case where there is temporarily a registration has been suspended for a person. During the suspension period, invoices since not taxed, therefore those invoices you call now you tax it, call as revised tax invoices that can be due within 1 month from the date of lifting suspension of registration. Got the clarity, my dear sir? And for that mean period of 3 months in our given example, you should submit dash first return. Got the clarity, my dear sir? This is what this provision says. Continuation of the amended provisions of input tax credit. Sir, annual return should be filed as per section 44 by 31st of the December of the succeeding financial year. For example, 1920 financial year, I should submit 31st December 2020. Is it clear, my dear sir? Where that time limit can be extended upon the recommendation of the GST Council by the Commissioner. Yes. If so, whether the state or UT Commissioner can do so? Yes. If they do so, is as equal as Commissioner of Central Tax has been granted extension. But it should be upon the recommendation of the GST Council. Due date of filing the annual return as referred under section 44 can be extended by the Commissioner at the central or state or UT level, provided it should be recommended by GST Council to do so. Is clear, my dear sir? Advanced concept of section 16. Where we have amendments here. Section 16, as you are aware of that, eligibility and conditions for taking input tax credit. There I am bringing to your notice a new rule, rule number 36, sub-rule number 4 of the CGST, which talks about restriction while availing ITC for those invoices which has not been uploaded in the GSTR1 return by supplier of goods or supplier of services or both. If so, for a recipient of that goods or services, input tax rate is restricted to 20% of those invoices which has been uploaded in the GSTR1 return by the suppliers. Here we got one amendment. This 20% restriction to avail ITC now further reduced to 10%. This 20% further reduced to 10% with effect from 1st January 2020 onwards. Be careful. You don't worry, I will take care with the help of illustrative example. I will explain to you, don't worry at all. For the time being, you understand here, my dear, restrictions on availment of ITC. What is restriction? For whom? Invoice or debit note has been uploaded by the supplier in his GSTR1 return. If the supplier uploaded his output tax liability in the GSTR1 return, that will be credit for the recipient under the GSTR2A return. Input tax credit. You don't worry at all. Just relax and listen. You will understand. Whether the supplier of the goods or services who supply to the recipient, where the recipient want to avail the ITC, supplier uploaded his output supply of invoices in the GSTR1 return, all are uploaded, sir. Then that entire credit on that inward supply to recipient is well allowed. If yes, you say full ITC is allowed to the recipient. No problem. Both are good buys. Supplier and recipient are good buys. Suppose if the supplier of the goods or services not uploaded in his output tax liability GSTR1 return that invoices, supplies, to that extent input tax rate for this particular recipient is not allowed by following the procedure where on those not uploaded invoices input tax credit compare with from 1st January 2020 10% of those invoices which are uploaded on total basis. Among the two, whichever is less, that much ITC allowed to the recipient for those invoices which has not been uploaded in the GSTR1 return by suppliers. Don't worry, listen here. If answer to this supplier not uploaded in the GSTR1 return, if that is the case, 10% of the eligible ITC available in respect of the uploaded invoices or debit notes. However, the ITC so claimed should not exceed the actual eligible ITC available in respect of the invoices not uploaded. That's what I said to you. The ITC on those invoices which is not uploaded, compare with the 10% of those invoices on which ITC among the two, whichever is lesser value allowed as a ITC for the invoices which are not uploaded. Now I am going to bring to your notice illustrative example. Neatly listen, you will understand. Sir, in your material 20% is there. Don't strike it out. This 20% well valid. This 20% well valid, my dear. For which period it is valid? I will tell you here. This is valid from 9th October 2019 to 31st December 2019, it was that time. This period is this particular period from 9th October 2019 to 31st December 2019. For that period, invoices which is not uploaded by the supplier, in that case you have to take 20%. You have to take 20% as a base. You have to take 20% as a base. From 1st January 2020 onwards, this 20% further reduced to 10%. It is one of the advanced concept because I am referring section 16, eligibility and conditions for taking the input as credit. Read with rule number 36, sub-rule number 4 of CGST, where this restriction has been imposed. I am bringing to a notice now with the help of examples for a kind consideration. In your material, this example is there, my dear. Page number 158, it is there with case 1, case 2 example, correct? Now you please add case 3 as one of the example. Case 3, this case 3 not there, you have to add. I will give you sufficient time to record. For the time being, let me speak the provision, the example. First let me read the example. I will give the time to record this case 3 alone. Then we'll go with explaining the provisions with applications. What this 10% speaks here. Reading as follows. One example, reading as follows. There in the material, sir. Mr. Vijay, a registered supplier, receives 100 invoices for inward supply of goods or services involving the GST of rupees 10 lakh from various suppliers during the month of October. Compute the ITC that can be claimed by Mr. Vijay in his GST or 3B for the month of October to be filled by 20th November in the following independent cases, assuming that GST of rupees 10 lakhs is otherwise eligible for ITC. Case 1, out of 100 invoices, 80 invoices involving the GST of rupees 6 lakhs have been uploaded by the suppliers in their respective GSTR 1 returns filed on the prescribed due date. Therefore, case 2, out of 100 invoices, 75 invoices involving the GST of 8.5 lakhs have been uploaded by the suppliers in their respective GSTR 1 returns filed on the prescribed due date. Therefore, case 3 not there in the material. In the page number 158, you have to record this. Reading as follows. Out of 100 invoices, 95 invoices involving the GST of 9,50,000 have been uploaded by the suppliers in their respective GSTR 1 returns filed on the prescribed due date. Therefore, so in 3 cases, what is the eligibility amount of ITC? Restrictions. Eligibility and restrictions. Section 16. Read with section rule number 36, sub number 4 is as follows. You first record this point, my dear. Case 3 point you please record, my dear. Case 3 record, amma. In the given example, case 3 please record. In our course material itself, you record, my dear. Yes, all of you recorded, my dear. Out of 100 invoices, 95 invoices involving GST of rupees 9,50,000 have been uploaded by the suppliers in their respective GSTR1 returns filed on the prescribed due date, therefore. Fine. Referring to you, case 1, where out of 100 invoices, 80 invoices only uploaded in the GSTR1 return by supplier of goods or services or both. On those invoices, GST suffered by Mr. Vijay want to avail ITC 6 lakhs. That entire 6 lakhs, ITC, entire 6 lakhs qualify for ITC. Fully, 6 lakhs fully allowed as ITC. No problem, because supplier of those goods, of those invoices uploaded in their respective GSTR1 return by suppliers. That credit fully allowed. Balance credit how much? Total 10 lakh credit. 6 lakhs credit, invoice uploaded. Balance 4 lakhs credit, respective invoices not uploaded by supplier of goods or services or both. If so, here the credit of 4 lakhs fully not allowed, which is restricted. How much? From 1st January 2020 onwards, 10% of those invoices on which ITC fully allowed, because suppliers uploaded the invoices, is how much ITC? 6 lakhs. On 6 lakhs, 10%. 10% of the ITC for those invoices which has been uploaded, or rupees so much of ITC for which invoice is not uploaded. Among the two, whichever is less. Invoice is not uploaded, how much? 4 lakhs. Invoices not uploaded in the GSTR1 return on which ITC 4 lakhs. Or 10% of ITC for those invoices uploaded. How much? 10% of 6 lakhs, 60,000. 60,000 or 4 lakhs, or 4 lakhs. Among the two, whichever is less. How much? 60,000. Therefore, in the first case, ITC allowed rupees 6 lakh 60,000. Got the clarity, my dear sir? Any difficulty? You can record neatly, no problem. For the time being, 10% of 6 lakhs is equal to 60,000 or rupees 4 lakhs, whichever is less. Which is less? 60,000. Add to 6 lakhs. Total credit allowed how much? 6 lakh 60,000. First case. Coming to case 2. Take into account case 2. Out of 100 invoices, 75 invoices involving the GST of rupees 8.5 lakhs have been uploaded by the suppliers in their respective GSTR1 return filed by the respective due dates. Fine. In that case, ITC, this particular amount of 8,50,000 input tax credit for those invoices which has been uploaded, fully allowed. Fully allowed as ITC. Further, out of 10 lakhs, 8.5 lakhs, 8 lakh 50 rupees ITC invoices uploaded. Balance 1,50,000 rupees of invoices, of which ITC not uploaded. That means invoices which has not been uploaded into the GSTR1 return, on which ITC 1,50,000. Fully not allowed. Restricted to 10%. 10% of input tax credit for those invoices which has been uploaded. Which come here how much? On 8,50,000 rupees, 10%, 85,000. Rupees 85,000 are not uploaded invoices on which ITC 1,50,000. Whichever is less, which is less? 85,000. Therefore, for case 2, ITC allowed how much means 8,50,000 plus 85,000. Got the clarity, my dear friends? Total allowed how much here? 9,35,000. 9,35,000 ITC allowed in the case 2. Coming to case 3, which you recorded, where out of 100 invoices, 95 invoices involving the GST 9,50,000 have been uploaded in the GST1 return, meaning balance 50,000 rupees of ITC of those invoices not uploaded. In that case, this is fully allowed now, my dear. This is fully allowed. Fully allowed. 9,50,000 for credit is fully allowed because their invoice is uploaded. Fully allowed as ITC. Further, 10% of 9,50,000. How much comes? 95,000 are invoices which is not uploaded, on which ITC. Here 50,000. Among the two, you know that whichever is less, which is less? 50,000. That means in that case of third case, ITC, how much allowed means 9,50,000 plus 50,000, whichever is less. So at any cost, you should not claim ITC more than what is available for claiming ITC. Therefore, the lawmaker said here, maximum ITC here is, in the given case, 10 lakhs. Third case, how much I said? 10 lakhs. If we add 95,000, what happened? It is more than the 10 lakhs. Available ITC of 10 lakhs. Therefore, whichever is less concept we follow. 10% of input tax credit for those invoices which has been uploaded, or rupees input tax credit of those invoices not uploaded. Among the two, whichever is less. Got the clarity, my dear sir? Now neatly record answer to this case 1, case 2, case 3 is as follows for your kind consideration. Case 1, total ITC allowed 6,60,000. Please make a note of this, my dear. Quickly record. Case 1. Quickly make a note of this. Yes, all of you got it, my dear? Yes, all of you got it? Now, referring to case 2, please neatly record. All of you record now, my dear, case 1, case 2. Answer to case 2. Please kindly record, my dear friends. Please make a note quickly. All of you got it, my dear? Further, once you recorded this, presenting here, case 3 solution is as follows. Please neatly record, my dear. Case 3. Please record. Yes, sir. All of you recorded, my dear friends? Yes, my dear sir. Once you completed this, I am bringing to a notice here at another important concept to conclude this restrictions in availing ITC. Not applicable cases. Restriction to avail ITC for those invoices which has not been uploaded into the GSTR 1 return, not applicable cases. These are the cases where ITC fully allowed. What are they? 1. GST paid on import of goods, where the importer is going to file the bill of entry to clear the goods. Department of Customs will process to give the credit of ITC, namely IGST as ITC. So GST 1 return not required to submit by supplier who is a outsider outside India. So IGST paid on import of goods, ITC fully allowed. It is not fall under the restriction category. 2. IGST paid on import of services, RCM, recipient is going to pay GST and he claim ITC fully. 3. Input service distributor who may be a registered person of GST as referred in section 20 of the CGST, once he got registered, mandatory as per referring section 24 of the CGST, manner of distribution of credit as referred in section 20 of the CGST, where the input service distributor distributes the credit to other units having the same PAN number, where such input service distributor who got registered compulsorily under section 24 of the CGST not required to submit GSTR1 return, resulting that those units received the input service tax credit from ISD allowed to avail fully, no restriction. Further, point number 4, inward supplies received from non-resident taxable person who can pass the credit. He is not eligible to claim ITC, but he can pass the credit. If I purchase the goods or service received from a non-resident taxable person from whom if I received input services by payment of the GST as a registered person, recipient can avail the ITC fully. As a non-resident taxable person who is not required to submit the GST1 return, his output tax liability. Got the clarity, my dear sir? In spite of that, GST paid on those supplies received from non-resident taxable person, ITC fully allowed. Got the clarity, my dear sir? Therefore, this is important area, not there in the material. Please kindly record in the notebook. One can expect in the examination, in which circumstances restriction to avail the ITC as referred in section 16, read with rule number 36, sub-rule number 4 of the CGST rules is not applicable. Restrictions not applicable cases on the screen. One can expect in the examination. Please record, my dear. Yes, my dear sir, all of you recorded? Good. So, now you got the clarity. Advanced concept of section 16, which talks about eligibility and conditions for taking input tax credit, is concluded at this point of time. Is clear, my dear sir? Furthermore, here one example to bring into your notice. Considering the example 1, in that case 1, when can Mr. Vijay avail balance ITC? Actual balance ITC, how much left over to avail? I will tell you. Refer here, case 1 of the example 1. Case 1, where 6 lakhs ITC already availed, 6 lakhs ITC already availed, plus 10% of 6 lakhs, 60,000, or 4 lakhs, whichever is less basis concept, you are aware of that. We availed 60,000. Totally how much availed? 6 lakhs 60,000 credit has been availed. Now balance credit how much is yet to be availed means take rupees 10 lakhs minus 6 lakhs 60,000 already availed. The balance yet to avail is 3 lakh 40,000 credit. When you can avail? This is what the question here. Only when the supplier of those goods or services uploaded their output tax liability invoices in the GST1 return. That time I can avail. For which they said in a simplified manner, look here, balance ITC of 3.4 lakh can be availed by the Mr. Vijay if suppliers uploaded details of the sum of the invoices for the month of October involving the ITC of 3 lakhs 9,100 out of outstanding invoices involving ITC of 4 lakh. How you got this 3 lakh 9,100 means very simple. They said here, if you take into account, my dear, total is 10 lakhs ITC divided by 1.1, that is 10% by adding. You will get a value here, rupees 9 lakh 9,100. From that deduct the ITC already availed by you. If you deduct ITC already availed for which invoice has been uploaded, then you will get the balance 3 lakhs 9,100. For example, I am telling you, rounding off the value. If that is the case, out of 4 lakh rupees of ITC, if those invoices uploaded by suppliers in the GST1 return to the extent of 3,91,000, then this 4 lakhs ITC is allowed. That means they said here, by taking into account, for example, supplier of goods and services to Mr. Vijay uploaded the balance 15 invoices where ITC 3,09,100 in the month of, for example, December. In such scenario, ITC that can be claimed by Mr. Vijay in the month of December is as follows. 100% of 3,09,100 allowed plus not uploaded invoices ITC, where 10% of uploaded invoices ITC or not uploaded invoices on which ITC, whichever is less. If you take here 10% of uploaded invoices 3,09,100 comes 30,900, or not upload invoices. Here not upload invoices, for example, you take into account the 3,09,100, deduct that value from 4 lakhs. 4 lakhs minus 3,09,100, you will get 90,000 or rupees 90,000. Among the two, whichever is less, 30,900 less. Therefore, if you add these two values, you will get 3,40,000 to claim the invoice, to claim the ITC on those invoices which has been uploaded where the ITC credit is 3,91,000. Is it clear, my dear sir? Very simple, my dear sir. They are asking when you are going to claim the ITC for those invoices which is not uploaded, which is not available by you, except 10% of that particular upload invoices. In that case, the solution is this. Gather clarity, my dear sir? Dear friends, now we have a very clear clarity circular of CBIC with regard to restriction of availing ITC for those invoices which has not been uploaded by suppliers. The 10% restriction, how we have to understand, detailed manner is given, saying that, first point, sir, whatever the 10% of upload invoices, compare with the invoices which is not uploaded on which ITC, among the two, whichever is lesser value should be considered for availing ITC is not specifically given as a column nor in the returns. It is a bookkeeping in your books of accounts. You have to have proper clarity of bookkeeping with regard to this restriction set by CBIC, followed by this restriction shall be applied only on the invoices, debit note, details of which are required by supplier to be uploaded under section 37(1) of the CGST. Therefore, taxpayer may avail full ITC in respect of IGST paid on imports. This point I already referred. Documents issued under the RCM, ITC fully can be availed. Credit received from input service distributor, ITC fully allowed. Where this restriction of 10%, earlier 20% is not applicable in the given cases. This point I already referred to you, my dear sir, you recall it also. Further, point number 3 here, clarification by CBIC. How we should consider 10% of the invoices ITC which is uploaded, means on total you have to consider, not invoice wise. Further, the point number 4, they said that here calculation will be based on those invoices which are eligible for ITC but invoice is not uploaded. So the 10% of ITC uploaded or ITC of those invoices not uploaded, among the two, whichever is lesser value should be considered by not considering blocked credit concept. Further, here very clear clarity is given, my dear sir. This 10% restriction now, earlier 20%, 10% restriction of ITC of those invoices which is not uploaded, how we should consider means, up to what date means, clarification given very clearly. For example, my dear, due date of filing the GST 1 return for the month of January is 11th February. Is it clear? If so, ITC in respect of invoices, debit note which have not been uploaded by supplier shall be maximum of now 10% of total ITC reflecting the GST 2A of the recipient as on 11th February should be considered. A very good proactive amended provision in favor of the assessee. I will give with example this. Listen here. Consider here January. I am talking about from the recipient point of view. Who is eligible to claim ITC? January month, ITC, let us say 6 lakh, where invoices uploaded. Invoices uploaded by suppliers. ITC for the recipient 6 lakhs. Further, ITC let us say 4 lakhs. ITC let us say 4 lakhs for which invoices not uploaded. Now, not uploaded by suppliers. Is clear, my dear sir? Now what happened? Generally we consider how the solution for this is as follows. We will consider solution in the following manner. Correct? What we will do generally, we will take here this 6 lakhs plus 10% of 6 lakhs, 60,000 or 4 lakh. Whichever is less, we will take here 60,000. Total eligible 6 lakhs, 60,000 we will say. Correct? Here clarification is given. For example, this particular January month return, the recipient of these goods or services going to be submit. His return is going to submit, no sir? The what we can call it as 3B. Now, supplier of these goods to the recipient of this particular 4 lakhs credit invoice not uploaded till 31st January 2020, may be uploading on 1st February 2020, 2nd February 2020, like that. So like that, further what happened, luckily the supplies has been uploaded. I can say that from 1st February 2020 to 11th February 2020, suppliers uploaded the invoices on which ITC, let us say 2 lakhs. Out of 4 lakhs, invoices were not uploaded earlier, now uploaded. Invoices uploaded in GSTR 1 by suppliers. Now what happened? I can take 6 lakhs credit plus till filing of the return by suppliers GSTR 1, they uploaded invoices on which GST credit 2 lakhs. Now how much for the recipient ITC means, clarification given by CBS is saying that not this one, you have to go with this. Upload invoices already 6 lakhs plus now till the point of loading the submitting the GST 1 return by suppliers 11th February 2020, upload invoices on which ITC 2 lakhs. This 2 lakhs totally 8 lakhs credit fully allowed plus not uploaded invoices. How much then left over out of 4 lakhs? 2 lakhs uploaded. Balance 2 lakhs only left over. Therefore, this 2 lakhs on which 2 lakhs are 10% of upload invoices. 10% of rupees 8 lakhs. How much comes? Rupees 80,000. If that is the case, you can take here 80,000. Now credit is allowed how much? Credit is allowed here is this much, 8 lakhs, 80,000 rupees credit is allowed. Because a facility given for a recipient, how much credit allowed means 8,80,000, because supplier of goods or services, they have not uploaded in the return GSTR 1 till 31st of January 2020, but subsequently they are going to file the return by 11th February. They uploaded those invoices on which ITC 2 lakhs, reflecting as a credit in the GSTR 2A of the recipient. If so, take that full amount of credit, 2 lakhs. Totally 8 lakhs. Then 10% of 8 lakhs, 80,000 or rupees 2 lakhs invoices on which GST credit not uploaded. Whichever is less, 80,000. Then by adding that 8 lakh, 80,000 rupees credit is allowed. This is what very important clarification of the CBIC one can expect in the examination. From this example, this illustration is so much warranted to understand from the exam point of view. Got the clarity, my dear friends? Further referring to you. Furthermore, restriction on utilization of ITC, rule number 86A, where if the assessee avail the ITC, like where there is issued by non-existent supplier, a tax invoice issued by non-existent supplier, or a valid document are issued by a non-existing supplier, or by a person not conducting any business from the registered premises, or ITC has been availed without receipt of the goods or services or both, or ITC has been availed where the tax in relation to which has not been paid to the government by supplier. In all these cases, ITC utilization can be restricted by the Commissioner of Central Tax. Registered person availing the ITC has been found non-existent or not to be conducting any business from the registered premises, or a registered person availing ITC is not in a possession of any tax invoice or valid document. In that cases is a wrong availment of ITC. ITC is not allowed. In that case, the proper officer of central tax or state tax, as the case may be, ITC so availed, the restriction can be imposed, not allowing such ITC to be used for discharging any tax liability under section 49 of the CGST Act, or not allowing refund of any unutilized input tax credit of such amount. Such restriction is valid for a period of 1 year from the date of imposing restriction of utilization of such wrongly availed ITC. If the Commissioner tomorrow feels is appropriate, assess is satisfied to the satisfaction of the officer where there is no revenue loss has been caused, in that case, Commissioner may permit to utilize such ITC by taking into account interest of the revenue. Is clear, my dear sir? Further, my dear friends, very important amendment taken place under rule number 43 of the CGST rules, which generally talks about capital goods commonly used for taxable supply of output as well as exempted supply of output exempted supply as well as output taxable supply, where I am using capital goods commonly, ITC credit thereon proportionately allowed. Here, amendments taken place by saying that, first and foremost, from 1st April 2020 onwards, if the invoice of such capital goods is available, from the date of invoice, treat the capital goods asset life as 5 years. Actual life of capital goods may be any number of years, but under the rule number 43 it says that actual life of the asset which is commonly used for taxable output as well as exempt output supply. Exempt output supply includes non-business purpose also. If so, declared such life of the asset is 5 years, reckoned from the date of invoice. That is important. And also be given here very clearly stating that elaborative manner they give an example by example, which I presented here for your kind consideration. Just look and understand in a diagrammatic presentation I given to you, saying that if the capital goods are used commonly for taxable as well as exempt supply, where with effect from 1st April 2020, if the capital goods purchased in the current tax period, yes means declare the life of the asset as 5 years and proportionately reverse the credit. Proportionally reverse, you are aware of that? In common credit on capital goods multiplied by exempted turnover of the tax period divided by total turnover of the tax period. You are aware of that? So, if it is purchased earlier, previous period, exclusively used for exempted supply, now you are going to convert for taxable supply also. In that case, ITC fully allowed on such capital goods now, provided you treat that from the day one you use that asset till the date of common use, 5% per quarter, part of the full quarter, reduce the credit from the capital goods earlier concept. Now such credit pertaining to the period from the date of purchase till the date of using common use, that particular mean period, GST on such capital goods will be treated as your output tax liability, calculating 5% per quarter basis. Don't worry at all. I am here to explain to you with illustrative example. Example 1, example 2, example 3. I will explain this, don't worry at all. For the timing I am telling you, my dear, 2 years before I purchase capital goods, my dear, that capital goods I use so far exempt supply. From today onwards, I am going to use taxable supply as well. In that case, for the past 2 years, since I use that asset only for exempted supply, ITC not availed. If so, today I can avail the ITC. How much? Full ITC avail. Provided the period from the day 1 of purchase till the date of common use, since you use only for exempt supply, for that period per quarter 5%, part of the full quarter, compute on the GST amount of such capital goods, how much comes, that much of GST out of the total GST of ITC of that particular capital asset, treat it as output tax liability. 5% per quarter, part of the quarter thereof, also be full quarter. For the period prior to the common use, how much credit is attributable, treat as output tax liability. However, today you can avail ITC fully on that particular capital goods. Effectively, I am using the net credit only, my dear. Don't worry, I will explain to you the example. In the case where the capital goods purchased earlier, exclusively used only for taxable supply, from today I am going to use for exempted supply as well, commonly. If so, ITC again today not allowed because I availed. Now, that capital goods ITC will be considered for proportionate of reversal purpose is as follows. And useful life of any such capital goods shall be considered as 5 years from the date of invoice. The said formula can be used, namely common credit multiplied by exempt supply by total supply shall be applicable for the remaining useful life of the capital asset. For example, 2 years before I purchase the asset, now the left over 3 years. So for the 3 years commonly I am using, for the 3 years apply the formula for proportionate reversal purpose. Example by example I am explaining to you now in a detailed manner is as follows. Now look on the screen, my dear sir. Capital goods as defined under section 2 subsection 19 of the CGST. You are aware of that. Capital goods means the value of which is capitalized in the books of accounts of the person who is claiming input tax credit and which is used or intended to be used in the course or furtherance of his business. Good. If that is the case, such capital goods, let us say, here machine A purchased. Machine A which is purchased, let us say, on 1st April, for example, my dear, 2018. Exclusively used for exempted supply, which also including non-business purpose, for example, exempted supply. If that is the case, you tell me, input tax credit allowed? No, they have not availed input tax credit. So value of purchase how much? Value of CG. CG means capital goods of machine A. For example, my dear, 1 lakh. Then GST paid thereon when they purchase. Let us say 18%, my dear, 18,000. Total invoice value 1,18,000. ITC allowed, not allowed, a question mark, not allowed. Reason, exclusively used for non-taxable purpose. means exempted purpose or non-business purpose, ITC not allowed. But rightly, the person who purchased this capital goods, let us say Mr. A, I will say here Mr. A registered person in Chennai. I will say also here one simplified example. Example 1. Mr. A, registered person in Chennai. Machine A purchased on 1st of April 2018, exclusively used for exempted supply. Value of capital goods 1 lakh, GST paid 18,000. That time they capitalized only this value. 1 lakh rupee only capitalized. For depreciation. For depreciation under section 32 of the Income Tax Act. Income Tax Act. Only 1 lakh they capitalize, but 18,000 rupees GST paid on such capital goods, they have not availed the ITC. They have not utilized the ITC. They kept as a receivable, but they have not utilized the ITC. They not confirm to department as their credit. It is not credited to electronic credit ledger, but shows as a receivable. Value of capital goods 1 lakh only capitalized for depreciation under the Income Tax Act. Thereby they satisfied section 16 subsection 3 of the CGST by not capitalizing along with the GST. Fine. Now what happened? That time when they was purchased in the year 1819, are they eligible to avail the ITC? No, they have not availed the ITC. I also can say that Mr. A not availed ITC on machine A. Not availed the ITC on machine A. Is it clear, my dear sir? Any difficulty up to this, my dear? Not avail the ITC. Good. What happened today? Today means what? Today, let us say for example, 29th July 2020, what happened? Need arises to use this machine A by Mr. A even for taxable supply as well, resulting that from today onwards machine A using for taxable supply of output as well as exempt supply of output. Thereby what happened? Machine A became commonly used for the purpose of taxable as well as exempt supply. Thereby, from today onwards, the person who using that machine for taxable supply as well eligible to claim ITC, but not full amount of ITC. Therefore, the lawmaker said here, Mr. A, we are giving the credit on machine A to you by following the rule number 43 of the CGST rules, which has been now got amended from 1st April 2020 onwards. So, in the given example, my dear sir, Mr. A using machine A from 29th July 2020 onwards for taxable supply. So, I will say that here, Mr. A using machine A machine A for taxable as well as exempted output supplies with effect from 29th July 2020. So what happened here? Machine A earlier exclusively used for exempted supply, ITC not availed in the electronic credit ledger. Now that machine using for taxable as well. In that case, it became a common credit. GST on such capital goods became a common credit. As a result, partly I am using for taxable supply, no, I am eligible to avail ITC, no. Therefore, the lawmaker says now with effect from 1st April 2020 onwards, the law here as per rule number 43 is as follows. Now what happened? Now as per rule 43 of CGST rules that is with effect from 1st April 2020 amended provision. Now as per rule number 43 of CGST rules with effect from 1st April 2020, proportionate reversal of credit is as follows. Got the clarity, my dear sir? This will be is as follows. If that is the case, how we should be identify this means I am presenting now furthermore clarification. Look here. What is the ITC? ITC on machine A. You are aware of that. It was purchased for 1 lakh multiplied by 18%, which you are aware of that, which is rupees 18,000. Now can I avail ITC? Lawmaker said yes. On this asset, ITC allowed now. Which year? In the year 2021. That is financial year 2021. Allowed. Further, here my dear sir, from the date of invoice, this asset will be declared as 5 years life set by the amended provision. Useful life of the asset declared as a 5 years. From which period it is? From 1st April onward. 1st April 2018 onwards, because the date of purchase is on the date. So treating that it is invoice date. Purchase on 1st April, the date of invoice is 1st April. There is a meaning here we derived, having that useful life how many years? 5 years from the date of invoice. That means 5 into 12 months, 60 months. Now, this life of the asset is 60 months. From 1st April 2018 till the date of 29th July 2020, you might have been used this asset for non-taxable supply only, for exempt supply only. If so, to the extent of credit, you should consider it as if it is your output tax liability. Therefore, lawmaker said here, ITC allowed 18,000 rupees. At the same time, in the month of July month, no, they use for even taxable supply with effect from 29th July 2020. Therefore, my dear sir, what I am saying here is, in the month of July, ITC allowed now in the financial year 2021. Which month? In the month of July. July is a tax period for them here. July 2020. July 2020, ITC allowed now. Fine. In that case, further, in the month of July 2020, which is called as tax period. For the given tax period, my dear, that credit attributable prior to the date of 29th July 2020, used exclusively for exempt supply, is how much means? Here, the lawmaker said, at the rate of 5% per quarter, part of the quarter has to be full quarter, you identify how much it is coming. Here, rupees 18,000 total ITC on capital good mission A, multiply by 5%, which is derived from the rule number 43. So 5% per quarter. So how many quarters here from the date of invoice? How many quarters from the date of invoice means 1st of April 2018 onwards. So from 1st April 2018 to 28th July, because they use this asset even for taxable supply from 29th. Therefore, before the date 28th July 2020, how many quarters comes here means, if you look here, 2018, how many quarters here? 18-19 means almost all 4 quarters. 2018-19, 4 quarters. 2019-20, 4 quarters. Thereafter, 2020-21. In that, April, May, June, 1 quarter. July, August, September, 1 quarter. In the month of July. Therefore, there are almost coming how many quarters? April, May, June, and July, August, September, in the month of July. Therefore, part of the quarter is full quarter. Therefore, 2 quarters. Totally, how many quarters comes here? Almost all 10 quarters. 10 quarters coming here, my dear sir. 10 quarters. Resulting that for 10 quarters, how much it is coming here means 18,000 multiplied by 5% per quarter multiplied by 10 quarters, rupees 9,000. This 9,000 rupees should be treated as the credit pertaining to that period where that asset used exclusively for exempted supply. Therefore, credit not allowed. That should be treated as output tax liability in the month of July. So, output tax liability, output tax liability in the month of July 2020 is rupees 9,000. That much you have to pay. How much credit can be available in the month of July? Entire rupees 18,000. Entire 18,000 credit is allowed only when you paid, you consider this 9,000 as your output tax liability. Got the clarity, my dear friends? From this, what you understand here, I will say that in a simplified manner summary to you. In the month of July, my dear, 2020, which is called tax period here, ITC allowed on machine A is equal to 18,000. Is it clear, my dear? Further, in same July month, output tax liability, which is nothing but reversal of ITC, is equal to rupees 9,000. Is clear, sir? Is one of the summary statement here for your kind consideration, my dear. Is it clear, brothers? Fine. Now, further I am referring, this machine, since you are using for taxable as well as exempted supply, this machine useful life as per rule number 43 of the CA GST rules declared as 5 years. As per rule number 43 of the CA GST rules, since this machine now using taxable as well as exempted supply, declared such machine life as 5 years. 5 years means 60 months is a useful life. Is it clear, my dear sir? There I am saying here. So machine A life, machine A useful life is equal to 5 years, none other than 60 months. That you are aware of that. 60 months. Now, if so, from which period it should be count means, I will say that from the date of invoice, from 1st April 2018 to when it is going to be end means 60th month is as follows. Count start like this. In the year April, first day purchase 2018, 18-19 1 year, 18-19 1 year, 19-20 second year, 20-21 third year, 21-22 fourth year, 22-23 is fifth year. That means 31st March 2023 is the useful life. This is the 5 years time period. Is it clear, my dear friends? So, once you understand machine A useful life is 5 years, which is 60 months from the date of invoice, which ends on 31st March 2023. If so, now proportionate reversal of input tax credit on machine A. From which period count reckoned means from which month onwards you have started to use for taxable as well as exempt supply from the month of July, 29 July 2020 onwards. Therefore, the lawmaker said here, from July, in our given example, 2020 to end of the useful life, 31st March 2023. From July 2020 onwards, you have to do the proportion reversal till the end of the useful life. So, till this period, from this to this period, you should be proportionate. I will simplify manner to say that for this period, proportionate input tax credit on machine A. Proportionate input tax credit on machine A. How much towards taxable, how much towards exempt supply. For this purpose, we should know the turnover of July 2020. Assume a scenario, assume an illustrative manner, assume a scenario. In the month of July 2020, Mr. A achieved the turnover, taxable turnover, for example, my dear sir, rupees 75 lakhs, exempted turnover rupees 25 lakhs, total 1 crore. Assume a scenario. So, in the month of July, Mr. A turnover taxable 75 lakhs, exempted turnover 25 lakhs. Fine. Now, we should proportionate ITC on capital goods. First, you have to identify proportion for how many years. Proportion purpose, the number of months commencing from July to 31st of March 2023. But apportion over period of useful life. Therefore, I will say that apportion over period of useful life. So, apportion of ITC on machine A. 18,000 rupees ITC divided by 60 months. So useful life, total useful life, which comes to you how much here? 18,000 divided by 60 months. Per month how much comes here? Let us say 300 rupees. 18,000 divided by 60 months. So 300 rupees. Now such 300 rupees is constant for proportionating the credit towards taxable as exempt supply, which is commencing from July month, commencing from July 2020 to 31st March 2023. Till that time you have to going on proportionate the common credit monthly basis. So here I am presenting further ITC on machine A, ITC on machine A for July 2020 attributable towards exempted supply will be treated as output tax liability. ITC and machinery for July 2020 attributable towards exempted supply will be treated as output tax liability. If there is a case, how much in the month of July we identified here? In the month of July we identified 300 rupees. If there is a case, now rupees 300 for the month of July ITC multiply by exempted turnover, namely 25 lakhs, divided by total turnover, namely 100 lakhs, is equal to how much here comes? Means almost all it is coming here 75 rupees. That much ITC will be treated as my output tax liability, says Mr. A, for the month of July. Like that, every month thereafter, August, September, October and so on till 31st March 2023, 300 rupees will be constant because useful life will be remain same. That 300 multiply with exempted supply divided by total supply formula is maybe the value going to be changed because of the turnover changes. If the current period July 2020 turnover is not available, then you please consider the turnover of the previous tax period, namely June month 2020 turnover of exempted as tax supply you can consider. But here there is no provisional basis of reversal of credit. Is actual basis, monthly basis. Unlike of your input tax kit and input goods, input services. Here on actual basis. Is got the clarity, my dear friends? So, like this, in the month of July, 75 rupees output tax liability. In the month of August, 300 rupees multiplied by August month exempt supply divided by total supply to the extent of exempt supply, treat as a taxable output supply. Is clear, sir? Here, one more point also be there. Advanced concept. Sir, in the month of July, you avail the ITC how much? Enter 18,000, which is not earlier availed. Therefore, in the month of July 2020, you availed ITC of rupees 18,000. Good. And in the same month, you reversed how much credit? Attributable to exempt supply, how much? 75 rupees. 75 rupees is your output tax liability. Is your output tax liability. Is clear, sir? Is your output tax liability. Good. Here only I want to bring to your notice, my dear sir. Going to in the month of August 2020, what happened? Again you have to reverse the credit or not? That time I am going to present here. Furthermore, referring here, in the month of August again credit not out because you have ITC in the month of July 2020. Therefore, in the month of August I am referring now. In the month of August 2020. In the month of August 2020, what happened, my dear? As you are aware of that, proportion reversal. There we came to know that taxable turnover. How much here? Let us say 12 lakhs. For example, my dear, exempted turnover. Exempted turnover. Let us say 18 lakhs. total turnover, let us say 30 lakhs for the month of August 2020 for Mr. A. In that case, your useful life of the asset remains 5 years from the date of invoice to 5 years, 31st of March 2023. You have to now proportionate by considering the credit attributable for that month remains, this 300 remains 300. It is unchanged. It is not going to be changed. This 300 rupees, because you divide by 60 months. Entire credit divided by 60 months over period of useful life, 300 remains same, constant. What is going to be changed here in the month of August means what is the amount reversal, namely output tax liability. So in the month of August, you are not allowed to avail any ITC because already availed in the month of July. Therefore, your output tax liability, your output tax liability towards the machine A is how much means rupees 300 multiplied by a exemplary supply 18 lakhs divided by 30 lakhs. How much comes here? 300 into 18 divided by 30 lakhs. You will get rupees 180. 180 rupees your output tax liability. Here only important point I want to bring to your notice. This much of output tax liability of 180 rupees you should not avail. But I do not know, therefore availed in the month of July 2020 entire 18,000. In 18,000 rupees, this 180 rupees included. You get my point? This 180 rupees of reversal of ITC is output tax liability. You came to know in the month of August. In the month of July 2020, you availed entire 18,000 rupees credit. That time itself you should not be avail this 180 rupees. But I do not know. I availed 180 rupees. That is 18,000 rupees I availed. Repeating, I availed the credit in the month of July 2020. How much? 18,000 I availed. How much rightly I reversed in the given month of July 2020 is rupees 75. This is done perfectly. In the month of August, my output tax liability is 180, which I do not know in the month of July. But I availed entire 18,000. 18,000 credit includes this 180 rupees. I should not have been availed the ITC, but already availed. Therefore, what happened? This 180 rupees you are considering as a reversal of ITC belatedly. That means you have been availed the ITC excess of 180 rupees in the month of July, which you are rectifying in the month of August. Resulting that what happened? It is none other than the delay in payment of GST. How is delay in payment of GST is a point I will explain to you. Listen, my dear. In the month of July, you claimed excess credit of 180 rupees, which is not supposed to be claimed in the month of July itself. But I claimed, I do not know, 180 rupees in the month of August is the amount I am going to be reverse the credit. Therefore, the lawmaker said, this excess claiming of ITC in the month of July, will be treated as you have paid short payment of GST to the extent of 180 rupees. Now you are going to pay in the month of August that 180 rupees. While paying 180 rupees, you have to pay interest also at the rate of 18% per annum. How many days here, how many months here delay? 1 month delay. Because in the month of July 2020, you are going to be paid that particular GST by reducing entire 18,000 rupees by 20th of August. For the month of August, you are going to pay when? 20th of September. Therefore, exactly here 1 month delay. For 1 month delay, you have to pay interest. So, output tax liability 180 rupees towards GST, liability, as well as you have to pay now interest at the rate of 18% per annum for 1 month delay. For 1 month delay here. You get my point, my dear sir? So, in the given case, what happened? This rupees 180 multiplied by 18% interest for how many days here means 1 month. 18% per annum means 1 month. Number of days you have to compute. Day wise only have to compute. Taking into as 30 days divided by 365 days. Got the clarity, my dear friends? If that is the case, how much comes here? 180 rupees multiplied by 18% multiplied by 30 divided by 365. I have to pay interest of rupees 3, round figure. 3 rupees interest also have to pay, which is mandatory to pay. Got the clarity? Likewise, if I went to September month 2020, again 300 rupees will be constant. That you multiply with the September month exempted turnover divided by total turnover. You will get the output tax liability for the given month of September. While paying that, you have to pay again interest. For how many months? 2 months delay. Like that, if you go to October, 3 months delay till the end of the useful life. Here, 31st March 2023. Till that time, whatever amount you output as liability on which you have to pay interest rate of 18% for so many months delay. This is the law of the land, where if you use capital goods exclusively for non-taxable supply, non-business purpose, subsequently you bring that asset, that capital goods into taxable supply as well as exempt supply, then it became a common credit. That credit is allowed to avail when you bring that asset for taxable supply as well. Then prior to that period, whatever may be from the date of invoice till the date of bringing into common use, 5% per quarter or part of the quarter, full quarter, you identify that amount of a credit, that much will be a tax output liability in the month in which you convert the asset into common use. Thereafter, treating that asset as 5 years life period from the date of invoice till the date of 60th month, then from which month onwards you are going to be use that asset for common purpose, from that date to till the end of the useful life, you going on proportionate credit towards exempted supply is to taxable supply. Is clear, sir? Apportionment for 5 years, proportionate from the date of common use to till the end of the useful life of the asset. Is it clear, my dear friends? This is what they study with regard to capital goods earlier used for exclusively non-business purpose or exclusively for exempt supply, which is further converted into taxable supply as well. Therefore, it became a common asset for taxable as well as exempt supply. Thereon, GST is a common credit. Treatment is this. Now, you please neatly record, enter my explanation what I given with regard to machine A. Please make a note of this, all the points. Please record, my dear friends. Please record this neatly in the notebook. very important, my dear sir, is amended provision with effect from 1st April 2020 onwards. Please make a note of this. All of you recorded, my dear sir, what is there on the screen? What is visible from the screen? Please record. Yes, sir. Further, yes, sir. All of you got, my dear sir, up to this. What is there on the screen? Further, my dear sir, further proceeding from here. %5 per quarter, part of the quarter, also a full quarter, from the date of invoice till the point of converting the asset for taxable as well as exempt supply. Is an output tax liability. Yes, all of you completed, my dear? Further from here, sir. Further. Why I taken 1st of April here? It is, that is date of invoice. Date of invoice to 5 years is a useful life. Further. Yes, all of you regard, my dear. Proportion reversal based on the turnover of the tax period. If not available, previous tax period should be taken into account for proportionate reversal purpose turnovers. Further, yes, all of you got it, sir. Further, in the month of August, interest for 1 month in the given case. taken as average basis 30 days. Yes, all of you completed, my dear friends, up to this? Fine. If you understand up to this is with regard to a machine exclusively used as exempted supply of output, now converted into taxable as well, namely taxable as well as exempted purpose. It became a common capital goods. GST thereon common credit. How to apportioned and proportioned I explained to you by inviting latest amended provision from rule number 43 of the CGST rules with effect from 1st April 2020 onwards. Is it clear, my dear sir? Now I am going to bring to your notice one more example, example 2, where a machine which has been exclusively used so far from the date of purchase only for taxable supply, from today onwards using for exempted supply as well, resulting that it became a common capital goods for taxable as well as exempted supply. Exempted supply as well as non-business supply also. You get my point, sir? A asset so far used only for taxable supply, now converted into taxable as well as exempted supply. If so, rule number 43 speaks from 1st April 2020 onwards, amended provision for proportionate reversal of credit is as follows. Now look on the screen, my dear sir. Example 2. Mr. A is registered person in Chennai. Machine B purchased on 1st April 2018. That is called invoice date also. For rupees 10 lakhs plus GST 5% and used exclusively for taxable supply. From 1st June 2020, machine B is used commonly for taxable and exempted supplies. During June 2020, turnover of taxable supply in the state of Tamil Nadu 50 lakhs and turnover of exempted supply is 25 lakhs. Sir, now you tell me, a machine so far exclusively used for taxable supply, now using for exempted supply as well. If so, is a common capital goods which has been used for taxable as well as exempted supply. If so, rule number 43 says that proportionate reversal of ITC is warranted. With effect from 1st April 2020 onwards, amendment taken place here. How? I am explaining here. Who is our client here? Is Mr. A. So, for him in the month of June. Here explaining as follows, my dear sir. So, in the given case, what happened? Rule number 43 of CGST rules 2017 with effect from 1st April 2020, amended provision, I am bringing to a notice, amended provision from 1st April 2020. Under rule number 43 of the series rules with regard to asset used so for taxable purpose, now going to be used even for exempt supply, commonly for taxable as well as exempt supply. If so, 43 comes into picture from 1st April 2020 says that proportion reversal is as follows. Sir, you tell me, my dear friends, in the given case, you tell me the asset, namely machine A, on which GST already availed in the month of April 2018, that month itself availed, no, because they are using for taxable supply. Again, availment of credit does not arise. Therefore, ITC on machine B already availed. How much? It is 10 lakhs of rupees. Multiply with 5% GST, which comes rupees 50,000. Got the clarity? Already availed. Already availed when? In the month of April 2018 itself. Now, again ITC is not allowed to avail in the month of June 2020. Is it clear, sir? But reversal takes place. Here, in the month of June 2020, what we are doing here is proportionate reversal. For that, you should know the useful life of the asset. So here, what is the useful life of the asset? 5 years, 60 months. Therefore, I will say that here, useful life of the asset of the machine B is equal to 5 years. That is 60 months. None other than 60 months. 60 months. Is clear, my dear friends? Useful life of machine B, 5 years, that is 60 months. First you have to apportion before proportionate. Therefore, apportion of ITC on machine B, which is rupees 50,000 divided by 60 months. 60 months. How much comes here? Which rupees? Almost all. 50,000 divided by 60 is equal to 833 rupees. Got the clarity, my dear friends? Any difficulty? This 833 rupees is a constant value for the entire life of the asset. Now, what is the life of the asset here? Means 5 years. Reckon from which period? From the date of invoice, my dear. So, 1st April 2018, date of invoice in the given problem, to 5 years. When it ends means almost all on 31st March 2023. Is it clear, sir? It is the life of the asset. Useful life of machine B. Is it clear, my dear friends? In that case, further. Now proportionate this 833 rupees, proportionate in the ratio of exempted supply is to taxable supply for the month of June. How long means? Till the end of the useful life. From which date means? From the date the asset used commonly for taxable as well as exempted supply. From which month? From the month of June. Therefore we say that proportion of ITC on machine B from which period? From June 2020 to 31st March 2023. For this period you should proportion. Now I am presenting here rupees 833 for the month of June, credit, multiply by exempted supply. How much in the given problem? Exempted supply is 25 lakhs, taxable 50 lakhs. Therefore 25 lakhs rupees 25 lakh divided by rupees 75 lakh in that ratio. If so here how much comes? 833 into 25 divided by 75 lakhs, which will come to you rupees 278 rupees. This is what your output tax liability in June 2020. Got the clarity, my dear friends? This is what the output tax liability in the month of June 2020. Got the clarity? Any difficulty? Credit already availed in the month of April 2018 itself. Just you have to proportionate the credit on such capital goods, treat as output as liability to the extent of exempted supply. Now, in the given example, Mr. A also liable to pay interest for this particular delay in reversal of ITC, because in the month of April 2018 they availed the entire credit. That time they do not know this much of 278 rupees credit going to be reversed in the month of June 2020. Therefore they claimed excess credit in the month of April 2018 to the extent of 278 rupees. They have to pay interest from the due date till the date of payment for so many months. For the month of April 2018, due date is to pay the GST 20th May 2018. So from 21st May 2018 to this payment of GST for the month of June on 20th July 2020, for that period they have to pay interest at the rate of 18%. Got the clarity, my dear friends? So I will say that here by way of note. In the given case, Mr. A is also liable to pay interest at the rate of 18% per annum from per annum on rupees 278 from 21st May 2018 to the payment of June month due when 20th July 2020. Got the clarity, my dear friends? Any difficulty up to this, my dear sir? So please now kindly record this explanation which is warranted as an amended provision, my dear sir. Please record as an example 2. First, record the example 2 and explanation followed by. This is all helpful for us to work out the numerics where I have given gigantic manner problems in the workbook. Yes, all of recorded, my dear friends. Further moving from here. Please record, sir. ITC and mission B already availed. Already availed when? Already availed in April 2018 when they purchased. Now again availment is not allowed, only reversal. Shall I proceed, sir? All of you record, my dear. Further, moving further. Yes, my dear friends, all of you record, Amma. Quickly complete, my dear sir. Yes, sir. All of you record now, my dear friends. So, now I am bringing you to notice example 3. Assume our client is Mr. A, who purchased machine C. From the day when he purchased, started to use for taxable supply as well as exempted supply, commonly using the machine. In that case, rule number 43 will automatically come into apply from the day one of purchase of the machine to proportionate reversal of credit, which is as follows, explaining. Now look on the screen, my dear. Example, Mr. A is a registered person in Chennai. Machine C purchased on 1st April 2020, invoice date also 1st April 2020, for rupees 120 lakhs plus GST 5% and using commonly for taxable as well as exempted supplies. Turnover during April 2020, taxable turnover 50 lakhs, exempt turnover 25 lakhs. One example. Now, the machine C commonly using for taxable as well as exempt supply, proportionate reversal is going to be applied from the day one of the machine purchase. Therefore, first and foremost, I will say that here, stating that as per rule number 43 of CGST rules 2017, which is with effect from 1st April 2020 with amended provision, my dear sir, I am bringing to a notice here is as follows. Amended provision is as follows. Proportionate reversal of credit. First of all, what is the useful life of the asset? Useful life of machine C is equal to 5 years. Nothing but how many months? 60 months. Any difficulty, my dear sir? Fine. Once you got this machine life 5 years from invoice date, therefore from 1st April 2020 to 5 years. You get my point, my dear sir? Then the 5 years is ends here 31st March 2025. Is clear, my dear sir? Which is 5 years time period. Is it clear? Further, if so, you can avail the ITC now. Yes, because now only I purchase 1st April 2020. Therefore, full, I will say that here, ITC on machine C, ITC on machine C, fully allowed in the month of April 2020 to electronic credit ledger. How much means? Rupees 120 lakhs, 5% GST, which comes here rupees 6 lakhs. Rupees 6 lakhs. Got the clarity, my dear friends? Now, if there is a case, I will simplify manner to say that credited to electronic credit ledger, ITC, credited to electronic credit ledger 6 lakh rupees. Fine. That means to say that in the month of April 2020, 6 lakhs full amount credit allowed, 120 lakhs, 5% GST, 6 lakhs. Amount credit electronic credit ledger 6 lakhs. Good. But they are using for commonly taxable as well as exempt supply. Rule number 43 speaks here proportionate reversal. Before that, apportion over period of useful life. Over period of useful life. Here is there no? This entire useful life 5 years. Over a period of 60 months you have first apportion. Therefore, I will write here apportion of ITC on machine C. How long should be apportioned? For a period of 60 months. Therefore, here how much credit? 6 lakhs. So, credit 6 lakhs, apportion for 60 months. 60 months. How much comes per month here? Rupees 10,000. Is a constant amount considered every month over a period of 5 years from the date of invoice for proportionate reversal purpose. So, now proportionate reversal. Of ITC in the month of April. So monthly it is April 2020. How much here to be proportionate is the point. Presenting here. What is the taxable turnover, exempt turnover here? We got 25 lakhs exempted, 50 lakhs taxable, total 75 lakhs. So proportionate towards the exempt supply is equal to how much? Means rupees 10,000 multiplied by 25 lakhs divided by 75 lakhs. So 10,000, if you multiply in that ratio, you will get it. How much here? Per month, your tax here in the month of April, your output tax liability 3,333 rupees. 3,333 rupees. This much is your output tax liability. Output tax liability in April 2020. Got the clarity, my dear sir? This is the way in which you have to proportionate in the month of April. In the month of May, if you entered, that time the amount constant is how much? 10,000. That you multiply with a May month exempt supply is to taxable supply in that ratio. That portion will be output tax liability. Got the clarity, my dear sir? Fine. So up to this, any difficulty? No difficulty. Fine. So assume a scenario. In the given month, what happened in the month of April? I will give summary. In the month of April, what happened here? April 2020 summary. ITC credited to electronic credit ledger. How much here? Rupees 6 lakhs. Enter value of GST. 6 lakhs. Amount credited 6 lakhs. At the same time, output tax liability. Output tax liability, which is how much here? Means we got here how much? 3,333 rupees. Got the clarity, my dear sir? So this is what the output in the month of April. Is clearer, my dear sir, from the machine C point of view? Is it clearer? Now, assume a scenario. If we enter into May 2020, what is the situation? So, I am extending this. In the month of May 2020, we got taxable turnover. Taxable turnover. If in the month of May taxable turnover not available, refer April month turnover as a base for May month proportion purpose. Assume a scenario here. Here it is. Let us say, for example, my dear sir, let us say it is here 60 lakhs. Here 60 lakhs taxable turnover and exempted turnover. For example, exempted turnover, let us say 40 lakhs. Assume a scenario. In that case, what happened? In that given case, your useful life of the asset, machine C, from 1st April 2020 to 5 years. So here, what I referred here is the number of months, namely this particular tax period from 1st April 2020 to 31st March 2025, 5 years time period is here useful life, and such 5 years time period is also be reversal of credit takes place for the entire 60 months, because the date of invoice and date they are going to use that asset for common purpose one and same. Therefore 60 months the useful life, 60 months you have to be proportionate by applying formula. Therefore, in the month of May, we are going to be now apportioned using the formula. So, output tax liability. In the month of May, again no credit, because I already availed the credit in the month of April. So, output tax liability on machine C, because of the machine C, in the month of May, output tax liability, how much here means rupees 10,000, which is constant credit per month attributable for a proportion purpose, multiply by exempted supply. How much here? Rupees 40 lakhs divided by 100 lakhs. How much comes here? Nothing but 4,000 rupees. This 4,000 rupees is output tax liability, reversal of credit. Output tax liability, technically we'll speak, none other than reversal of credit. Output tax liability in May 2020. Got the clarity, my dear sir? Output tax liability in the month of May 2020. How much you got here? You got here almost all the 4,000 rupees. That much you have to reverse the credit. That means what? In the month of April 2020, you have claimed entire credit of 6 lakhs, which includes this 4,000. Am I right or not? That means you have claimed excess credit in the month of April. Now you are reversing. Excess claiming of credit equal to short payment of tax. Now you are going to pay 4,000 rupees in the name of output tax liability, delay payment of GST, which will attract the interest at the rate of 18% per annum. In the given case, 1 month delay. Therefore, I will say that here, therefore, in the given case, I will say note. In the given case, in the month of May 2020, Mr. A has to pay GST of rupees 4,000 plus interest at the rate of 18% per annum, 18% per annum for 1 month delay. 18% per annum, here 1 month delay. If you go to June month, take again 10,000, proportionate June month turnover exempted by total turnover, you will get reversal amount, which is output liability. On that output liability, you have to pay interest for 2 months. Like that it goes till the end of useful life of the asset. Got the clarity, my dear friends? Now, please make a note of this. I have been explaining elaboratively by writing on the screen one by one. You please make a note. These are all useful when we go for applications by inviting comprehensive problems. So please make a note of this, my dear. Quickly make a note of this example. Please record this example in your notebook. Example 3. Please make a note of this, my dear sir. Example 3. Because earlier 2 examples we covered, now therefore it is a third example. Yes, all of you recorded this example, my dear sir? Further moving here. Further, it is with effect from 1st April 2020 onwards. It is invoice date. Useful life count reckoned from 1st April 2020, which is invoice date, to 5 years. From the day one they purchase the asset using for commonly taxable as well as supply. Therefore, they have to be apportioned 60 months, and throughout the 60 months proportionate the credit in the ratio of exempted supply divided by total supply. Yes, sir. Complete all of you. Furthermore, my dear sir, yes, sir. Electronic credit ledger. Yes, all of you recorded, my dear sir. Now quickly record, my dear. Yes, sir. Furthermore, Yes, my dear friends, all of you required, amma. So, here I explain example 1. Machine A exclusively used so far exempt supply, now using for taxable as well as commonly for taxable as well as exempt supply. Followed by example 2, machine B earlier used only for taxable supply, now using for exempt supply as well, commonly taxable as well as exempt supply, namely common capital goods. Further, the example 3 where I referred machine C from the day 1 purchase using for taxable as well as exempt supply. In all the 3 cases, rule number 43 gives its own impression of explanation with amended provision with effect from 1st April 2020. I explained to you. Is it clear, my dear sir? Section 18, subsection 3, which is also very important now because of amended provision by virtue of a circular of the CBIC. Circular number 133/03/2020, which is in the month of March. CBIC issued a circular number 133, very clearly elaborately explained some clarifications of the industry, well applicable in the exam point of view, which I am going to bring to notice. Let us see first what section 18 subsection 3 speaks. Change in the constitution of a registered person on account of sale, merger, demerger, amalgamation, lease or transfer of the business. Such a change, not a supply, aware of that. Transferor liability and assets will become transferee liabilities and assets. Am I right or not? If so, the credit of the transferor will become credit of the transferee. If entire business has been shifted to the new place, that means in the case of amalgamation. In the case of demerger, what happened, my dear? One company is part of the business only transferred to a newly established company in the name of demerger. In that case, what proportion of credit should be transferred to the demerged company, a new company? There, the point of dispute arises. Repeating again, my dear sir, when you talk about sale, no problem. For example, Rafi Academy, registered person. Entire academy I sold to, let us say, Ram Academy. Rafi Academy sold to Ram Academy. Now, my assets liabilities, Rafi Academy, assets and liabilities will become assets and liabilities of Ram Academy. If so, the credit is available, unutilized credit of Rafi Academy, automatically credit of Ram Academy, no problem. In the case of especially demerger comes into picture, in the case of demerger comes into picture, problem arises. One company is part of asset, liabilities transferred to a new company in the name of demerger. The new entity, the transferee entity, how much credit is allowed from transferor company? Because entire business of the transferor is not transferred to a new entity. Only a part of the business of an existing registered person transferred to new entity in the name of demerger. In that case, how much unutilized credit of transferor will be the credit of the transferee? This has been elaborately explained by the CBIC in the month of March 2020 by issuing a new circular, circular number 133, is as follows. Now look on the screen, my dear. There are three companies, Ram Limited, Rahim Limited, Robert Limited. All the three are registered pursuant to GST law. They have their own credit unutilized with their books of accounts. Amalgamating, in the name of amalgamation, they formed a new company, RRR Limited. If that is the case, my dear, the unutilized ITC of Ram Limited, Rahim Limited, Robert Limited automatically will be the credit of RRR Limited. In the case of amalgamated company, the credit goes to amalgamated company. From amalgamating companies to amalgamated company. Namely, from transferor to transferee, where these transferors should submit. Here, they should submit one important document, namely Form GST ITC 02. They should submit. If so, transfer of credit will take place. Transfer of ITC, where RRR Limited, after amalgamation, after incorporation, accept the credit in the form GST R2 return, then they are eligible to claim ITC. Automatically, the credit of transferors will be the credit of the transferee through filing of GST ITC 02. Is it clear, my dear sir? At the same time, this particular transferor companies who transfer their credit to transferee in the case of amalgamation or sale or demerger or lease, as the case may be, is valid only when there is certificate from chartered accountant or a cost accountant is attached to this, stating that yes, I have verified the transactions, the credit transferred to the transferee by transferor in the given case is correct as per the provisions of the law. A certificate from chartered accountant or cost accountant who is in practice is required to furnish. Then ITC allowed for the transferee company. Is clear, my dear sir? Here no problem, my dear. The whole thing has been transferred. Problem arises especially demerger. As you are aware of that, one existing company, its part of assets and liabilities transferred in the name of demerger to a new entity. If that is the case, from the existing company, unutilized credit, how much should be transferred to a new entity which is emerged in the name of demerger, in the process of demerger, where we need more clarification. Now CBI is issued gigantic manner clarifications by raising issue and clarification of the various points of the industry and department has been beautifully clarified. Now I am presenting here section 18 subsection 3 of the CGST. Read with rule number 41 of the CGST rules, which talks about submission of this particular GST ITC 02 for transfer of credit, and followed by circular number 133 dated 23rd March 2020 is as follows. Look on the screen, my dear. This circular, very important, which I am referring. In the case of demerger, ITC proportionated in the ratio of value of assets. In the ratio of value of assets. What do you mean by value of assets? Refer the rule number 41 of the CGST rules. And how much should be proportionate unutilized credit of existing company should be transferred to the new entity in the name of demerger. I am presenting here, look here one by one, simplified manner. Look on the screen, my dear. X Limited, XYZ Limited, XYZ Limited, registered pursuant to GST law, total assets of XYZ Limited is 100 crores. Of course, XYZ Limited has two units. Unit A in Madhya Pradesh, MP, where the asset value is 60 crores. And Unit B in UP, Uttar Pradesh state, where 40 crores of asset. As a whole, the company has, XYZ Limited has 100 crores turnover. Now XYZ Limited is proposed for a demerger. Part of assets of A unit from Madhya Pradesh state transferred to the demerged company. Likewise, Unit B, which is located in the state of Uttar Pradesh, out of their 40 crores of asset, certain portion has been transferred to a new entity in the name of demerger. Look here, demerger. In the process of demerger, a new company has been emerged, ABC Limited, a new entity. Here, XYZ Limited will be as such. The part of asset of XYZ Limited transferred to ABC Limited, which is newly incorporated in the name of demerger. Where from Unit A, Madhya Pradesh state, out of 60 crores of the asset available in the state of Madhya Pradesh, Unit A of XYZ Limited, they transferred to ABC Limited, a new entity. Let us say 30 crores has been transferred. Likewise, from Unit B, which is located in Uttar Pradesh state, out of their 40 crores, sum of asset has been transferred. Let us say 10 crores has been transferred. Now the point arises in front of us here is unutilized credit of XYZ Limited, Unit A of Madhya Pradesh, how much to be transferred to ABC Limited? Unutilized credit of XYZ Limited of Unit B, located in the Uttar Pradesh, how much unutilized credit of Unit B should be transferred to ABC Limited? A question mark arises. Have we transferred on all India basis or unit wise, distinct person wise? If you refer here, Unit A in Madhya Pradesh, Unit B in Uttar Pradesh are the distinct persons, because XYZ Limited holding one PAN number, XYZ holding one PAN number, Unit A, Unit B in two states, we call distinct persons. As a whole, what is the total asset transferred? From Unit A, 30 crores, from Unit B, 10 crores, resulting that 40 crores out of 100 crores. If so, unutilized credit should be taken into account to transfer in the proportionate of 40 crores transferred out of 100 crores. If so, 40 crores divided by 100 crores multiplied by unutilized credit of XYZ Limited. In that proportion, by using that formula, should transfer the credit from XYZ to ABC company or state-wise, because distinct persons. If you refer state-wise, out of 60 crores of Unit A asset, 30 crores transferred. Therefore, 30 crores divided by 60 crores multiply by unutilized credit of unit A of Madhya Pradesh, that proportionate to be transferred using such a formula, or further unit B transferred out of their 40 crores, 10 crores transferred. 10 crores divided by 40 crores multiplied by unutilized credit of unit B, that proportion to transfer to ABC Limited. It is all India basis or state-wise. Clarification given by CBIC, it should be state-wise, distinct person-wise. It cannot be total credit multiplied by 40 crores divided by 100 crores. It cannot be like that. It should be unutilized credit of unit A of Madhya Pradesh multiplied by how much asset transferred? 30 crores divided by asset available in Madhya Pradesh, how much? 60 crores. In that ratio should be distributed. Likewise, unit B also, unutilized credit of unit B multiplied by asset transferred to new entity 10 crores divided by total asset 40 crores. In that proportion, using such a formula, should transfer the credit, not all India basis. It cannot be total credit of XYZ Limited multiplied by 40 crores divided by 100 crores, should not use clarification of the CBIC. Therefore, I am presenting here the simplified manner. Value of asset, Madhya Pradesh set 60 crores, asset transferred on demerger 30 crores, unutilized ITC transferred to the demerged entity is 30 crores divided by 60 crores, that is 0.5. Multiply by unutilized credit if it is there. That only you have to transfer. Likewise, Uttar Pradesh state 10 crores divided by 40 crores, which is 0.25. Multiply by unutilized credit of Uttar Pradesh state. That only transferred. Unutilized credit of Uttar Pradesh state multiply by 0.25. In that proportion, whatever unutilized credit of unit B will transfer to new entity, namely ABC Limited. But it cannot be in the following manner. It cannot be in this following manner. Got the clarity, my dear sir? It cannot be like this. It cannot be like this. Is it clear, my dear? Clarification. As per Rule 41 of the CGST rules, the value of assets of the new units is to be taken at the state level, at the level of distinct person, and not at the all India level, applicable for all types of business reorganizations. It may be a sale, it may be amalgamation, it may be demerger, it may be a lease, as the case may be. In this manner only you have to transfer. Is it clear, my dear friends? XYZ Limited transferor of credit required to submit what? GST ITC 02. Submit form GST ITC 02 for transferring the input tax credit. And not only that, XYZ Limited should also be furnished a certificate to this extent is perfectly transferred. Shown in the ITC 02 is perfect transfer of amount. They are not transferring more than what is available for transfer. Like that, a confirmation, a certificate from a practicing chartered accountant or a practicing cost accountant need to be submitted by the transferor. That should be accepted by ABC Limited. Yes, it is my credit only. Then the credit will be automatically transferred to ABC Limited. In that proportion. Got the clarity, my dear sir? Please kindly record this point. The earlier one, what I shown to you, amalgamation, simplified manner. You want to record that? Okay, fine. Record the amalgamation, which has simplified explanation. Then I given to you with circular in the name of CBIC circular with regard to demerger concept. The same concept also applicable for even in the case of amalgamation, in the case of a sale, in the case of a lease, business reorganization takes place wherever the same concept is applicable. Is it clear now, my dear friends? Fine. Before this, you record that earlier example, amalgamation, RRR Limited, followed by this example, need to be recorded because one can expect in the coming examination from this area. It is not completed here. Furthermore is there. I will explain. Up to this you please record. This part you please record quickly. Yes, all of you recorded, my dear friends. Simplified one. Once you record this, further, important one, please make a note of this. This one, please make a note of this neatly. We are in section 18, subsection 3. Read with rule number 41 of the CGST rules along with latest circular of CBIC, circular number 133, dated 23rd March 2020. Yes, all of you recorded, my dear friends. Yes, sir. Once you record this particular provision is halfway through. Once you recorded this provision, is halfway through. Circular number 133 is halfway through. Furthermore, here, especially with regard to demerger, these particular provisions are very useful, my dear friends. In the exam point of view, definitely one can expect in the examination of CA CMA CS. Further, one question I am asking here. You are aware of that submission of form GST ITC02? From there, is the transferor required to file form GST ITC02 in all states where it is registered? What is the meaning of this? Just now I refer to XYZ Limited in Madhya Pradesh and Uttar Pradesh. In Madhya Pradesh, Uttar Pradesh, they are called as transferors, transferring some of their asset. If XYZ Limited also has one more unit in Tamil Nadu, which is not transferred any part of their asset to transferee, in that case, all these states, wherever we have the place of business, required to submit the form GST ITC02, not required. Only those states where the transferor as well as transferee are located, there only you can submit this form GST ITC02. Reading. Is the transferor required to file form GST ITC02 in all states where it is registered? Answer is no. The transferor is required to file form GST ITC02 only in those states where both transferor and transferee are registered. Example, XYZ Limited in the state of Uttar Pradesh, in the state of Madhya Pradesh, they are the transferors. In the state of Uttar Pradesh, in the state of Madhya Pradesh, they should submit form GST ITC02. ABC Limited is, for example, Delhi, submit there in Delhi. Got the clarity? The transferor is required to file form GST ITC02 only in those states where both transferor and transferee are registered. Wherever transferor who are transfer their assets are registered in the state, and the state of the transferee also be required to submit. Is clear, my dear sir? Please make a note of this, my dear. This is also not in the material which I submitted to you. Therefore, neatly record in the notebook. Wantedly, I reserve that for explanation and you record. Once record equal to 5 times of reading. Please make a note of this. Repeating, XYZ Limited has 3 locations: Tamil Nadu, Madhya Pradesh, Uttar Pradesh. But unit Tamil Nadu not transferred any assets to new company. If so, Tamil Nadu state XYZ Limited not required to submit ITC02. Transferors Madhya Pradesh, Uttar Pradesh, there they should submit. If new company is registered in the Delhi, they are also required to submit form GST ITC02, because ITC want to avail the credit by transferee. Therefore, in the state of transferee where the transferee got registered, in the state submit ITC02. All of you got the regard, my dear friends? Further referring, my dear sir, from here. Section 18, subsection 3, read with rule number 41 of the CA rules. where circular given clarifications furthermore, one by one. Don't worry, I will refer this. The ratio of value of assets as prescribed under the sub-rule number 1 of rule number 41 of the CGST rules shall be applied to the total amount of unutilized input tax credit of the transferor. How to understand this? As you are aware of that, my dear, XYZ limit, for example, my dear, Unit A in Madhya Pradesh, Unit B in Uttar Pradesh. Unit A in Madhya Pradesh has CGST credit, SGST credit, IGST credit. If so, you said how much asset transferred from Madhya Pradesh to new entity and remerger, let us say 30 crores out of 60 crores. Then that credit you multiply with 30 crores divided by 60 crores. And whatever proportion attributable to new entity, transfer. How should we transfer? Headwise CGST, SGST, UTGST, headwise have transfer, a total sum together credit out of the credit should be transferred. This is what? Sum of CGST, SGST or UTGST and ITGST credit you should be considered and transfer. The said formula need not be applied separately in respect of each head of ITC. Further, the said formula shall also be applicable for apportionment of cess between the transferor and transferee. That is what? Compensation cess. GST compensation cess. Don't worry at all. This entire story I am presenting with the help of simplified numeric example. Look on the screen. One example. X Limited registered under the CGST in the state of Maharashtra. Such X Limited has the following unutilized credit: CGST 5 lakhs, SGST 5 lakhs, IGST 10 lakhs, totally 20 lakhs. Unutilized credit X Limited has. If so, when the X Limited in the name of demerger transferred pursuant to a scheme of demerger, X Limited transfers 60% of the asset of X Limited to transferee B Limited. B Limited new entity in the name of demerger. In such case, credit to be transferred to B Limited also. In that given case, shall I take 60% of the 20 lakhs total credit or 60% of the CGST, 60% of the SGST, 60% of IGST? In that proportion should be transferred. The law says 60% of asset you transfer to new company. If so, take total credit 20 lakhs on which 60%. How much comes? 12 lakhs. That alone you transferred. Lump sum amount transfer 12 lakhs. So lump sum amount transfer 12 lakhs. How the B Limited going to be bifurcate that as its CGST, SGST or IGST? Here the lawmaker said, don't worry. Hey Mr. Transferor. Who is the transferor? X Limited. You need to be submit form GST ITC 02. I need to submit, sir, to transfer the credit. If so, there you show how much you are going to be transferred out of 12 lakhs to B Limited as a CGST. How much you are going to transfer out of 12 lakhs as SGST credit to B Limited. Out of 12 lakhs, how much IGST you want to be transferred to B Limited? You decide, provided you should have to have respective value of credit as unutilized credit in your books. What proportion you want to transfer? out of 12 lakhs of rupees, towards CGST how much, towards SGST how much, towards IGST how much, left to you at your choice, set by the CBIC circular number 133 dated 23rd March 2020. The liberty given to transferor. But while transferring the credit, transfer total unutilized credit multiplied by transferred asset divided by total asset of the transferor. In that case, what credit to be transferred, we came to know 12 lakhs. Towards CGST how much, SGST how much, IGST how much is liberty of transferor. He can decide. How, sir? How it is possible, sir? Could you please explain further? Yes, I will explain to you with the help of illustrative example now. Before going for that, could you please make a note of this, please, my dear sir? Please record, my dear. Continuation of rule number, this particular circular number 133. Please record, sir. This much. What is there on the screen? Quickly compute, my dear friends. Yes, all of you record, my dear. Up to this, you have no doubt. Am I right, my dear? From here, furthermore continuation. Explanation of the CBIC. Under section 18, subsection 3. Read with rule number 41 of the CGST rules. With one example, my dear. In what proportion the transferor should transfer the credit to transferee in the case of demerger by mentioning the values in the GST ITC 02, which I am presenting here. Assume a scenario, my dear. Transferor has two units, one in the state of Delhi, other one in the state of Haryana. Transferor, two states, Delhi and Haryana. Asset transferred to new entity in the name of demerger. 70% of the asset transferred to new entity in the name of demerger by Delhi unit, and Haryana unit 40% of their asset transferred to the new entity in the name of demerger, where the transferor unit state of Delhi, transferor unit state of Delhi, unutilized credit as on the date of submission of form GST ITC 02, unutilized credit under tax head CGST 10 lakhs. SGST 10 lakhs. IGST 30 lakhs. Now they transfer the asset from Delhi unit. Asset transferred how much? 70%. So out of 100% of Delhi unit asset, 70% transferred to a transferee company. If so, out of this 50 lakhs, 70%. How much comes here? 35 lakhs. Transfer like that in a lump sum manner, not the CGST, SGST, IGST manner. Once 35 lakhs you annuities credit Delhi unit, transfer to transferee. Transferee should account or not? Under which head? Under how much CGST head? Out of 35 lakhs they will account. Out of 35 lakhs, how much under the SGST account transferee company will account as their credit? Out of 35 lakhs, how much IGST credit will account by the transferee? Means that will be decided by transferor. Delhi unit transferor, they are going to be submit in the state of Delhi form GST ITC 02. As in the date of submission of form GST ITC 02, the annuities credit is 10 lakhs, 10 lakhs and 30 lakhs. CGST, SGST, IGST respectively. If so, at the liberty of the transferor, he is mentioning the GST ITC 02 form. In the GST ITC 02 form, he is mentioning. How much he is mentioning means, he decided, okay, CGST 10 lakhs is there, 10 lakhs transfer. Is his liberty. He says, I am transferring 10 lakhs as CGST, mentioning in the ITC 02 form by transferor. SGST, okay, transfer. How much? 10 lakhs. Because maximum available, how much is there to transfer in the particular tax head? 10 lakhs. Then IGST, 30 lakhs is there. How much I can transfer? Already out of 35 lakhs, 20 lakhs exhausted. The balance how much? Only 15 lakhs. That 15 lakhs transferred as a ITC. As a result, after transferred by transferor to transferee, what is credit left over with the transferor, namely Delhi unit, means here 0, here 0, here 15 lakhs. Likewise, Haryana unit transferred how much? 40% of the asset out of 100%. If so, on 70 lakhs, on total 40% is equal to how much comes? 40% means 28 lakhs. So 28 lakhs to be transferred. Correct, my dear friends? So 70 lakhs, 40%, 28 lakhs. Now 28 lakhs total transferring. How much the transferee will be account in the name of CGST, SGST, IGST means that will be decided by transferor while filing form GST ITC 02. There he is willing to transfer, my dear sir, only 3 lakhs out of 25 lakhs of CGST. He is willing to transfer, let us say, only 3 lakhs. He is willing to transfer 3 lakhs only. Out of 28 lakhs, 3 lakh transferred in the name of CGST. In the name of SGST, he is willing to transfer, let us say, 5 lakhs. It's up to him to decide. And out of 28 lakhs, 3 lakhs CGST, 5 lakhs SGST means balance 20 lakhs. How much is available IGST? 20 lakhs. Therefore, fully I can transfer. I should have to have in my account sufficient amount to transfer. Suppose, my dear, if Haryana unit has IGST credit, unutilized credit is 18 lakhs, you cannot transfer 20 lakhs in the name of IGST. Be careful. Keeping that as a constraint, you transfer the credit. So IGST credit 20 lakhs is there, therefore 20 lakhs balance I transferred. As a result, 28 lakhs has been transferred. If so, how much left over? CGST SGST, IGST in Haryana unit after transfer to transferee here 23 lakhs. Sorry to say 25 minus 3 lakhs how much? 22 lakhs only will come here as their annualized credit in the Haryana unit. SGST 25 lakhs minus 5 lakhs only left over 20 lakhs. In the given case of IGST 20 lakhs fully gone 20 lakhs, amount left over 0. Got the clarity my dear friends? As a result, the Delhi unit has IGST credit 15 lakhs as a total and Haryana unit has almost all 42 lakhs, which is 22 lakhs of CGST, 20 lakhs of SGST in the Haryana unit after demerger. Is it clear, my dear sir? So is the way in which the computation is required to be made. So now neatly record what I explained to you this example. I'm showing on the screen. Neatly record saying that this particular transfer of credit is on total unused credit multiplied by transferred asset divided by total asset. And once you got the credit, what is the amount transferred? You apportion how much CGST, how much SGST, how much IGST left to the option of the transferor. Show in the GST ITC 02. You being an auditor, being a chartered accountant, being a cost accountant who are in full-time practice should certify yes, this is perfectly correct. You should certify it. Saying that certificate from chartered account cost accountant which is required to be furnished for transferring of this credit along with the ITC 02. Is it clear, my dear sir? So I am presenting in front of you for kind consideration this example. Neatly record. So please make a note of this, my dear sir, in your material neatly. The same what I recorded by writing, showing on the screen for a kind consideration. Please record, sir. All of you record, my dear friends. Quickly comment, my dear. Yes, all of you completed, my dear. Yes, sir. You got the clarity, my dear sir? This is what circular number 133 speaks with regard to section 18 subsection 3. Read with rule number 41 of the CGST rules. Is it clear, my dear friends? So, further continuation of amendments are as follows. Payment of tax. What amendment here taking place? Mind-blowing amendment. My dear sir, prior to this 1st August 2019, there was stringent provision where cash ledger, electronic cash ledger of GST network portal, where I deposited my money by debiting to my bank account and crediting to electronic cash ledger account of mine in the major head as well as minor head. Major head CGST, SGST, IGST, major heads. Minor head, namely the interest, penalty, fee, and so on. If I deposited the electronic cash ledger, let us say CGST major head, 10,000 rupees. Prior to 1st August 2019, the law was that electronic cash ledger I use only for that CGST payment only. Now it is not so. That major head can be adjusted against SGST major head payment. Electronic cash ledger of SGST can be utilized for payment of IGST liability, or minor head, namely interest penalty also, because it is electronic cash ledger of major head or maybe minor head, can be now used for payment of other major head or other minor head also. Is a facility granted from 1st August 2019. Got the clarity, my dear sir? Simple to say as an illustrative manner as follows. For example, I have electronic cash ledger of network portal CGST 10,000. This can be adjusted for making the payment of IGST, or this can be adjusted for making the payment of interest, or this can be used for payment of penalty, because it is electronic cash ledger, can be used. Vice versa also hold good. Is clear, my dear sir? Further, a facility was granted to OIDAR, supplier of services. You know that OIDAR services, online information database access or retrieval services provider, provide these services from outside India to a person in India who is basically non-taxable online recipient, liable to pay GST on OIDAR. Is it clear, my dear sir? Which is not an exempted supply of services, which is not a reverse charge, forward charge. OIDAR only liable to pay GST. Earlier, the facility was given to them to pay the tax through electronic accounting system in excise and service tax. This facility to pay the tax has been withdrawn now, omitted to OIDAR service providers. They have to pay through network portal. Dear friends, as you are aware of that, section 51 of the CGST talks about TDS, tax deducted at source, by drawing and disbursement offices, DDOs. Section 52 of the CGST Act also talks about tax collected at source, TCS, under the CGST Act. whatever the TDS deducted by DDOs, whatever tax collected by the e-commerce operators, that value is to be reflected in the electronic cash ledger of supplier of the goods or services. Therefore, the term Form GSTR2 generally speaks electronic credit ledger, which is not in operation. Therefore, it is now omitted simply by saying that TDS deducted by the DDOs, TCS collected by the e-commerce operators. It should be electronic cash ledger. Give the credit to supplier of the goods or services. Is it clear, my dear sir? Further, here important provision, sir. Refund of tax that has been wrongly paid or in excess by utilizing ITC. In that case, what happened, my dear sir? If I have been paid the excess of GST wrongly paid by using electronic credit ledger, and the refund if I apply subsequently, they are not giving to my electronic cash ledger. They are giving the credit to my electronic credit ledger is the concept. Will be credited to the electronic credit ledger if excess I paid, wrongly if I paid the tax by utilizing the electronic credit ledger, and the credit will be, that refund will be given to me when I apply for the want of refund where I paid excess amount or wrongly I paid, that will be given to me refund not to my electronic cash ledger but to my electronic credit ledger, since that amount I paid by utilizing electronic credit ledger. Is it clear, my dear sir? Further, my dear friends, referring to you here, a new chapter called as Tax Invoice, Credit Note, Debit Note, in which amendments? What amendment taken place here? Facility of electronic payment to recipient has been granted by the GST Council at the option of the recipient. How it is means, from 1st August 2019, GST Council stated that we will recommend specified class of registered persons who shall provide prescribed modes of electronic payment to their recipients of supply of goods or services or both may be made by him, and give option to such recipient to make payment accordingly in such manner and subject to such conditions and restrictions as may be prescribed. The law notify this. Namely, GST Council said, hey Mr. Suppliers, specified class of suppliers of goods services, you please provide to your recipients to make the payment electronic mode as their option. Who are they? We will notify. Wait and see. Is yet to be notified the class of suppliers of goods or services who supposed to give the option to the recipient for making the payment electronic mode for the supply of goods or services. Further, electronic ticket. My dear sir, generally a tax invoice should containing the certain descriptions, certain information, HSN code or SAC code, description of goods or services, quantity, value, tax shown separately in the invoice. Invoice should contain the serial number, invoice contain the date, this and all. My dear sir, when you book the ticket for movie, especially in multi-screen theaters, when you purchase ticket through online, they will issue only a reference number, contain the name of the supplier and few relevant information, that's it. It's not like tax invoice. In such case, the law of the land here says that supplier of the goods, supplier of the services, who is a registered person who supply the invoice, should be mentioned tax separately, being a registered person who supply the supply of taxable goods or services, mandatory issue the tax invoice. where especially the amount exceed rupees 200. In that case, a multi-screen theatre wala who issue the electronic e-ticket for admission to the cinema theatre, is that electronic ticket can be considered as tax invoice? Law permitted now. From 1st September 2019, e-ticket issued by the multi-screen theatres, cinema, admission to exhibition of cinema photographic film, especially multi-screen theatres, issue the e-ticket, electronic ticket, is treated as tax invoice, but certain relevant information must be there. The name of the issuer, the GST number of the issuer, certain relevant information should be there. Further, is it only applicable, this e-ticket will be treated as tax invoice only for multi-screen exhibition of cinema photography film only? It may or may not be. Even if I am running only one screen theatre, if I issue the electronic ticket to my audience who are taking the admission to cinema photographic film, I have only one screen. For me also, if I issued e-ticket, also be as if I issued tax invoice only. In the given case, clarification given by the CBIC as follows. Or by notification issued by the Government of India, it is as follows. Provided that the supplier of such services in a screen other than multi-screen may, at his option, follow the above procedure. But such service provider means service provider providing exhibition of cinema photographic film. Such service providers only issued e-ticket will be treated as tax invoice, whether you have multi-screens or single screen, as the case may be. Got the clarity, my dear sir? Furthermore, amendments referring here under the tax invoice, credit note, debit note concept, e-invoice, electronic invoice. GST Council recommended that if your turnover holding one PAN number all India basis, aggregate turnover in a financial year more than 500 crores, such a person mandatorily should be issued e-invoice, where we have the form GST INV 01 invoice. After obtaining an invoice reference number, you have to register under the GST portal separately. By moving here, you have to register and obtain invoice reference number for your e-invoices by uploading the information contained therein on common portal as a GST electronic portal in prescribed manner and subject to prescribed conditions and restrictions. And you will be get a particular reference code. You should have to have a reference code also with you for invoice, easy to trace, QR. Then issue the invoices electronically. The requirement of preparing invoices in duplicate and triplicate in the case of supply of services, in the case of supply of goods, not warranted. Physical copy, original for buyer, duplicate for transporter, triplicate for seller. Like that, 3 copies of invoice when the supply of goods takes place, now not warranted. Since you are going for e-invoice, one invoice sufficient, where you have QR, quick reference code for that separately. Likewise, for a service provider, original for buyer, duplicate for supplier of services, not warranted. In case of supply of services, only one e-invoice sufficient, electronic one invoice sufficient for supply of goods or services. This is what here the requirement says. Further, my dear friends, amended provisions furthermore referring to you for a kind consideration. Very important area. When I refer the amendments, supply, goods sent on sale or approval basis, is it Supply? Absolutely not. There, the advanced concept here. Continuation of that, in fact, I can say that. My dear sir, look on the screen is India. Delhi. Exporter exported the goods to China fellow. Goods sent for exhibition to China, which is not treated as export of goods. Reason? When I supply the goods on sale or approval basis, where it is only sent for exhibition to outside India, which is not strictly meant for sale. In fact, the goods are going to return back after completion of the exhibition. In that case, such a supplier of that goods to China not required to execute a bond or LUT, resulting that export of these goods for exhibition purpose cannot be strictly called as export of goods, but supply of goods on sale or approval basis. If that is the case, exporter required to maintain record of that such a supply to outside India for exhibition or sales promotion purpose? Yes, law of the land says, point number one, exporter shall maintain a record of such goods in his books, to whom you supplied, how much quantity you supplied outside India for exhibition or sales promotion. Should be maintained the record. Is clear, my dear sir? Further, followed by point number 2. Supply treated as on sale or approval basis. Not supply, not export of goods. 3. A delivery challan is to be issued for such supply. As per rule number 55 of the CGST rules, we have goods sent on sale or approval basis. There should be a delivery challan accompanied along with that. It is not treated as zero rated supply. Not treated as zero rated supply. Hence, no need to execute a bond or letter of undertaking, LUT. It is not export of goods. Therefore, not required to execute a LUT. Is clear, my dear sir? Further, point number 5. Not a supply if the goods are returned. If the goods are returned within 6 months, if the goods are returned within 6 months from the date of removal. Not a supply, because I supply to China for exhibition. Exhibition is completed within 1 month. All goods came back to my place from China, from the exhibition. In that case, not a supply. If the goods are returned within 6 months from the date of removal. Got the clarity, sir? Suppose what happened if the goods are not returned within 6 months from the date of dispatch or delivery challan to outside India for exhibition or sales promotion? Then, as you are aware of that, we have the section 31, section 7 of the CGST Act, invoice required to be issued. When means the first day that occurs after expiry of 6 months from the date of dispatch. Therefore, goods are sold within 6 months from the date of removal. Then, in such case, it is a supply. A tax invoice should be issued. A tax invoice should be issued. My dear sir, the point here is, when I sold the goods are where it is located. The goods are physically located outside India. When I sold this within 6 months from the date of dispatch, then I have to issue the invoice. Tax invoice should be issued. Got the clarity, sir? Now, in the given case, one should understand the procedure. When I send the goods for exhibition outside India, it is treated as sale or approval basis, not export of goods. and the goods are returned within 6 months from date of delivery challan issued by me, not a supply. If it is not returned within 6 months, it becomes a supply on first day of the expiry of 6 months from date of dispatch. If the goods are sold within 6 months from the date of delivery challan by dispatching the goods to outside India, in that case, that number of units sold outside India is a supply. I have to issue the invoice for the supply, namely tax invoice. Got the clarity, my dear sir? If that is the case, how we should understand furthermore these provisions? Furthermore provision, whether the supplier who supply the goods on sale or approval basis, assume sale taken place outside India. Even though I send the goods for exhibition, in the exhibition, some of them purchase the goods I sold. In that case, can I treat as export of goods? Can claim refund? You cannot treat is export of goods, but you can claim refund. It will be treated as inverted rate of tax. Inverted rate of tax concept. This is what he has said. It is further clarified that refund claim cannot be preferred under rule number 96 of the CGST rules, as supply is taking place at a time after the goods have already been sent, taken out of India earlier. That goods only sold. That cannot be called as goods are supplied under rule number 96 to claim refund as export of goods. You cannot do so. However, supplier can claim refund under section 54 subsection 3 of the CGST like inverted rate of tax, because the rate here will attract 0%, though it is not export of goods, because the goods sale taken place where after the good dispatched to outside India. In that case, tax invoice with what rate? 0 amount of tax. In that case, one can say that under the inverted rate of tax, one can claim the refund under section 54 subsection 3 of the CGST Act. How to understand the entire concept in a simplified manner is as follows. Then how to understand this provision is required with the help of example. I brought your notice CA final RTP May 2020 question relating to this particular amended provision or clarification provision of the CBIC in this regard. Reading as follows from page number 35 of amendment material. An international trade exhibition is going to be held in United States of America in January. Ayat Niryat Export House has participated in it. It intends to send 100 units of taxable goods manufactured by it to USA for display in the said exhibition. Ayat Niryat Export House is of the view that the activity of sending the goods out of India for exhibition is a zero-rated supply. However, its tax advisor does not concur with its view. Examine whether the view of Ayat Niryat Export House is correct. Assuming that Ayat Niryat Export House could not sell any goods at the exhibition and bringing back entire 100 units to India in February or in August. Discuss the requirement to issue invoice, if any, in each of the above independent cases. Would your answer be different if Ayat Niryat Export House sells an aggregate of 65 units of the taxable goods in USA, exhibition on different dates in January, and remaining 35 units are brought back on 31st January? The tax advisor of Ayat Niryat Export House advises advises Ayat Niryat Export House that the export of 65 units qualify as zero rated supply and you should apply for refund of the unutilized ITC in respect of the same. Examine the technical veracity of the tax advisor's advice. How to answer this? Very simple, my dear sir. Look here, this supplier, Ayat Niryat Export House, send the goods 100 units of taxable goods to USA for display in the exhibition. Such a supply treat as what? Such a supply treat as goods sent on sale or approval basis. Goods sent on sale or approval basis. Which is not a supply. You are aware of this. Is clear, my dear sir? Fine. Further, can I treat as zero rated export, zero rated supply? No, because not a supply. Question of zero rated supply does not arise. Here, not a zero rated supply. Therefore, I can say that the view of Ayat Niryat Export House is not correct. Is clear, my dear sir? Further, assuming that if the entire goods are returned within 6 months, namely February, is it supply? Not a supply. Not required to issue tax invoice. Second case, yes, required to issue tax invoice because it is invoice to be issued under section 31 section 7 of the CGST. The first day that occurs after expiry of 6 months from date of dispatch. You are aware of that? That will come into picture. Therefore, answer to this here. Point number 1. Point number 1 here. Answer. Discuss the requirement of issue of invoice in each of the above case. So, point number 1 case. Point number 1 case. Not required to issue dash tax invoice. It is sufficient to issue dash challan. Got the clarity, my dear sir? Then you talk about point number 2. Yes, time of supply is there. In requirement of issue of invoice arises. Therefore, required to issue tax invoice as per section 31 subsection 7 of CGST Act, because it is treated as dash supply, because you return after expiry of 6 months from the date of dispatch challan. Is clear, my dear sir? Further, they are asking here, would your answer be different if Ayat Niryat House sells 65 units outside? Yes, 65 units they sold is a time of supply taken place, resulting that issue the tax invoice should be issued with zero rate tax, but not export of goods, not qualify refund as you understood under this category of rule number, under the category of this. You cannot claim here under this category. under rule number 96 category, you cannot claim refund, but you can claim refund under the category of the what we can call inverted rate of tax, section 54, section 3. Therefore, you can say that for 65 units, it is supply with zero tax, If so, under section 54 subsection 3, section 54 subsection 3 of CGST Act, the Ayat Niryat export house can claim refund. Therefore, the advisor, the technical advisor, this particular, the tax advisor view is correct in this regard, because he can claim refund under inverted rate of tax. You are aware of that? Refund under the inverted rate of tax is equal to inverted rate of tax turnover for the tax period divided by total turnover for the tax period multiplied by total credit on inputs only. Whole thing, from that deduct tax payable on inverted rate of turnover. That positive amount will be the amount of refund under section 54 subsection 3, which we elaborately discuss in the regular study with the help of numeric examples. Is clear, my dear sir? Further referring to you from here, referring this to you, debit note, credit note or tax invoice where a bill of entry amendment taken place here. What they added here means up to 100 kilometers validity of a particular e-way bill is 1 day in case other than over-dimensional cargo. Earlier was there. Now inserted other than multimodal shipment in which at least one leg involves transport by ship. If it is so, not every 100 kilometers 1 day, but is every 20 kilometers 1 day. Is clear, my dear sir? In case of over-dimensional cargo or in case of multimodal shipment in which at least one leg involves transport by ship is considered, the validity of e-way bill, is not for each 100 kilometers, each 20 kilometers 1 day. How to understand this is as follows with the help of simple example. I will explain this, my dear sir, to you in a simplified manner. Look here, assume a scenario. X Limited from Chennai sold the goods to, let us say, Y Limited of, let us say, Vizag. Now the goods has to send. Agreement made here. Look here, from Chennai factory to port, from port to Vizag place. Here what happened, if you refer, in the given case, let us take into account the goods has been now moving from Chennai factory to port by road, and thereafter at Chennai port these goods has been loaded into the vessel, and that vessel carrying that goods from Chennai port to Vizag port. From Vizag port the goods reaches to the Vizag factory of the buyer. Here it is by road, it is by ship in a vessel. So transport of goods partly by road, partly by vessel in a ship, it is called as multi-modal shipment. Where at least one leg is by ship, one leg involves transport by ship. Got the clarity, my dear sir? So multimodal transshipment, at least one leg involves transport by ship. So the total distance, for example, total distance let us say 420 kilometers. For example, in that case, what is the validity of e-way bill? Means each 20 kilometers or part thereof is 1 day. Here the validity of e-way bill is each 20 kilometers. Treat as 1 day. Therefore, here 420 divided by 20 comes out 21. So 21 days is the validity of e-way bill. That means 100 kilometers per day validity is not applicable in the case of over-dimensional cargo or multimodal shipment, in which at least one leg by transport in a ship. One leg involves transport by ship. is considered 20 kilometers per day is a validity. Got the clarity, my dear sir? Or part of the 20 kilometers is 1 day. Is got the clarity? Is what the amendment taken place under the e-way bill. Further here, one more concept has been brought. Can I extend the validity period of e-way bill? Means yes. Further amended this, validity of the e-way bill can be extended within 8 hours from the time of its expiry. Within 8 hours from the time of its expiry, I can extend my validity of e-way bill. That facility is given in the given case, in the e-way bill network portal, separate portal. Further, referring to you, my dear, now, furthermore, amendments with regard to e-way bill. Restriction on the part of furnishing the information, part A of form GST EWB01. Generally, EWB01 containing part A and part B. Part A, information by supplier of goods or recipient of the goods, being a supplier consignor or being a recipient consignor, should fill up. Part A. Part B going to fill up by transporter. Here they said restriction on filling up part A under the EWB01. When means no person shall be allowed to furnish the information in part A of form GST EWB01 in respect of the following registered persons, whether as a supplier or recipient. If a person who paying the tax under the composition scheme under section 10 has not furnished the statement of payment of self-assessed tax, as you are aware of that GST CMP 08, they supposed to submit quarterly. Not submitted consecutively for 2 quarters, they are disqualified to use e-way bill, is the meaning of that. Further, a person other than composition scheme assessees who not furnish the return for consecutive period of 2 months, or otherwise a person who paying the tax under regular scheme has not furnished GSTR1 return, maybe in the case of the turnover exceeds 1.5 crores monthly, thereby for consecutively 2 months, or a turnover of a person whose turnover not exceed 1.5 crores allowed to submit quarterly, as the case may be, consecutively for 2 quarters not submitted GSTR1 return, or a person who paying normal scheme under the GST where he has not filed the GSTR1 for a period of 2 consecutive months. In that case, these assessees are disqualified to use e-way bill. That means if the value of the goods exceeds 50,000, interstate movement of the goods, e-way bill must, they are not competent. They have to be forced to file the returns. Being a composition scheme assessee should file the returns. Payment of taxes should be there if there is a payment of tax, or nil return should be submit. If 2 quarters continuously 2 quarters the composition scheme assessee not submitted their returns, payment of self-assessed tax returns, or a person other than the composition scheme not submitted 2 consecutive months returns, namely GSTR 3B, or in the case of a person who paying normal scheme may be filing the return quarterly because of turnover not exceeds 1.5 crores, or a person paying monthly filing the return, turnover exceeds 1.5 crores. If they are not filed the return consecutively for 2 months or 2 quarters, as the case may be, they are not eligible to use e-way bill. In that case, what happened? If that assessee approach the commissioner, jurisdictional commissioner, by filing the returns, by making the payment of tax wherever required, and approach the commissioner, please grant us power to use e-way bill, otherwise our goods may be liable for confiscation under section 129 of the CGST Act. Therefore, please permit us, we file the return, sir. Like that, you satisfied with the best interest of the revenue. If the commissioner is satisfied with that, then he may permit you to upload form GST EWB Part A. Got the clarity, my dear friends? Further, my dear sir, amendment with regard to interest. Sir, this entire story I will explain to you as follows. Interest. You know that interest liable to pay wherever delay payment has been taken place. Now, delay happened, my dear. Delay payment. Then interest liable to pay. Now, such payment of tax without show cause notice under section 73 or 74 or is payment of tax against show cause notice under section 73 or 74 is a point. Are you paying by your own? Yes, sir. Without notice, I myself paying the amount of GST which there is delay payment. In that case, tax amount allowed as ITC, balance net liability, balance net liability paid by electronic cash ledger. Correct? Then in that case, my dear sir, the lawmaker said interest at the rate of 18% per annum will apply on this value, but not on this value. Is it clear, my dear sir? When we talk about I am going to pay delay payment charge, payment of a GST against notice, then tax amount less ITC not allowed because you are paying the GST against show cause notice. Therefore, the balance. This is by electronic cash ledger. If so, interest at the rate of 18% per annum should be on this value without deducting ITC. Got the clarity, my dear? Further, returns under the GST. Returns under the GST. What amendment here taken place means, you know, GST 9 annual return. Who required to not submit annual return? You are aware of that. A person of ISD, inputs tax distributor, TDS, TCS wala, casual taxable person, non-resident taxable person not required to submit GSTR 9. Now, GSTR 9 also be not required to submit by a person who is basically OIDAR supplier, supplied the services of OIDR nature to non-taxable online recipient. Then who liable to pay GST? OIDR wala liable to pay GST. If so, he got registered in GST to pay the GST. Such a OIDR wala, since he provides the services of OIDR nature to non-taxable online recipient, got registered to pay the tax, not required to submit annual return. A OIDR supplier of service supplied the services to non-taxable online recipient. In that case, OIDR wala liable to pay tax. Such a OIDR wala not required to submit annual return, namely GSTR 9. Practically, it is acceptable. Is clear, my dear sir? Further, amendments in the returns. Very good amendment here made. When TDS wala deducting the TDS amount under the GST under section 51 of the CGST, or TCS collector who deducting the TCS under section 52 of the CGST, they should be submit the return, and the details of deduction of TDS or TCS should be made available electronically to the deductees. Thereby, the deductee can claim that TDS or TCS in their electronic cash ledger for further reduction of their tax liability. That means GSTR, where the GSTR 7 TDS wala submitted, GSTR 8 the TCS wala submitting deduction of TDS or TCS respectively should be made available electronically, details of the deduction to the deductees or to the collectee. Got the clarity, sir? Further, referring to you, a clarification given by the CBIC by way of notification Government of India issued upon the recommendation of GST Council. GSTR 3B actually a payment challan. Now it should be treated as return. Since GSTR 3 not in place, GSTR 3B itself treated as return. So GSTR 3B, it is no longer a challan, it is a return. Got the clarity, my dear sir? Further, annual return is optional. Very good, big relaxation. For whom means whose aggregate turnover in the financial year not exceed 2 crores, those assessees not required to submit the annual return. For them, on the due date, shall be deemed to have been submitted, even though not submitted. If I submitted, up to you, no problem. Very good, goodbye, go ahead. Turnover of a assessee less than 2 crores, submission of GSTR 9 annual return is made optional. If you submit, very good. Even if not submitted, we will be considered as if you deemed to have been submitted by the due dates. Thereby, penalty for late filing of annual return, non-filing of annual return does not arise for you, provided the turnover of a such person should be less than or equal to 2 crores. Less than or equal to 2 crores. Is clear, my dear sir? Further, refund of tax chapter. Amendment provision is taken place. Amendment. What amendment here taken place? The amendment is as follows. Now listen, my dear friends. Actually, at international airport or at port, international ports, there are passengers, outgoing passengers especially, used to buy certain commodities in the airport hall. After the immigration, they entered inside by waiting for the boarding. They used to shop over there. In that international airport, after immigration, I have duty-free shop where tax is free. Tax-free goods are available, but you have to pay the money against foreign currency. That means consideration should be against foreign currency. In that case, such duty-free shops supplying that goods against the foreign currency, earner of foreign currency. If so, their supply to outgoing passengers after immigration at international airport especially not attract GST. But these duty-free shops, being a recipient from others in India, purchase the goods, procure the goods by payment of GST. What happened input tax credit? No problem. Such input tax credit can ask for refund. Refund will be given to such international airport shops, namely duty-free shops located at international airport after immigration. Because they are the earner of foreign currency, this is one of the main reason they qualify to claim refund of their input tax credit. Got the clarity, my dear sir? Further, this refund I will explain to you with some example. Sir, in India, as you are aware of that, if you supply the goods to approved international organizations, let us say one of the unit of United Nations, for example, supplier supply the goods to United Nations organization in India. Supplier from India supply the goods, then value, let us say 1 lakh, and IGST, for example, 18% will attract 1,18,000. Is clear, my dear friends? Who suffered the GST here? United Nations organization located in India. They can claim refund of IGST under section 54. Is clear, sir? Of CGST Act. Is clear, sir? If that is the case, if such United Nations organization import of goods by such organization liable to pay IGST under section 3, subsection 7 of Customs Tariff Act 1975. You are aware of that? Yes. If so, such IGST, are they eligible to claim refund? Yes. This IGST allowed as refund to such United Nations organizations to have parity between the GST claiming refund in India. If they import the goods by payment of IGST to Department of Customs, that also can claim refund to have the level playing field, parity. Got the clarity? This is what this particular entire story of this particular refund is allowed here, especially instead of here the refund will be allowed under section 55 of the CGST Act. 54 general refund, for special refund for the international organizations is under section 55. Is clear, my dear sir? Further, one amendment here under the refund is this, a procedural amendment it is from the department side. Earlier, when we ask for refund, if it's found correct, they used to issue payment advice. Now, should issue payment order, not the payment advice. Payment advice should be renamed now as payment order. Is it clear, my dear sir? When you ask for refund, if found correct, payment order they will issue by granting to you the refund. Further, my dear friends, referring here, a recent post amendment here. You are aware of that zero rated supply, export of goods especially are supplied to SEZ units or developer of SEZ units, where section 16 of IGST speaks zero rated supply, where we have a formula under section 16 section 3 of the IGST to claim refund, which is equal to the net credit for the given tax period multiplied by export turnover of goods or services divided by total turnover. That proportion input tax credit qualify for refund. This ITC should be inputs plus input services, unutilized credit for the tax period, for the period for which you export the goods or services. Here what happened? Exported goods turnover of zero rated supply of goods has been amended by saying that that value should be 1.5 times of domestic clearances of such goods or the invoice value shown at the time of export, among the two, whichever is less. Sir, understandably not understand, sir. No problem. Presenting here for a kind consideration the entire story as follows. For formula purpose only I am telling. This is only for formula purpose to claim refund. Under this particular rule number 89 sub rule number 4, read with formula here, section 16 subsection 3 refund claim formula purpose. This numerator only I am talking, is as follows. Zero rated supply of goods as shown in the GST invoice of export of goods or 1.5 times of like goods supplied in domestic tariff area. Among the two, whichever is less should be considered as a numerator. For example, my dear sir, example 1 you take here. GST invoice value 1 lakh, case 1. GST, case A. GST invoice value 1 lakh, export value of goods. Value like goods supplied domestically 90,000. You multiply this with 1.5 times is equal to 1 lakh 35,000. 1 lakh 35,000. Is clear, my dear sir? 1 lakh 35,000. So 1 lakh or 1 lakh 35,000, whichever is less, which is less here is 1 lakh is the less. So is the value should be considered for formula purpose, numerator. Likewise, case B, GST invoice value 2 lakhs, which is exported value of goods, locally cleared the goods, such a type of goods, supply locally rupees 60,000. Multiply with 1.5 times is equal to 90,000. So 2 lakhs or 90,000, whichever is less, which is less 90,000. This will be considered as a numerator for formula purpose to claim refund. What for it is has been brought into force, you know, my dear sir, this amendment. Our Indians are boosting the values, fictitious values are showing and exporting 2 lakh worth of the goods showing as 20 lakhs as exports and claiming refund of input tax credit. To avoid that, this cap has been imposed. Now, I am bringing to notice a classical example in this regard. Example 2. X Limited exported furniture for rupees 8 lakhs under LUT without payment of tax in the month of April. Similar furniture also sold in India by X Limited for rupees 2 lakhs in the month of April. Input tax credit on inputs during that April month is 3,50,000. Find the input tax credit, find the refund of input tax credit. Find the refund of input tax credit. Easy. Now, I will say that here. Refund is equal to input tax credit. How much is there? 3,50,000 multiplied by numerator export turnover. Export turnover here is should have working note. Should have to have working note. Here, let us have one working note. First, saying that what is the value of exports? Rupees 8 lakhs. Rupees 8 lakh. Or point number 2. What is the value of domestic clearances? 2 lakhs. Multiply by 1.5 times. So I will say that 2 lakhs multiplied by 1.5 times is nothing but 3 lakhs. For formula purpose, whichever is less, which is less here, 3 lakhs is the lesser value. So that will be considered as a numerator. For rupees, the numerator export turnover value is 3 lakhs, not the 2 lakhs, not the 8 lakhs. So 3 lakhs divided by total turnover. How much here? 8 lakhs plus 2 lakhs. So 10 lakhs. So you have to consider like this. Then 3,50,000 multiplied by 3 lakhs divided by 10 lakhs is equal to 1,05,000 is the amount of refund. Got the clarity, my dear friends? So 1.5 times of domestic clearance of such goods or the export value of the goods under LUT, among the two, whichever is less will be the numerator, is an amendment. Is clear, my dear sir? This is applicable only when the goods are exported under LUT concept. Got the clarity, my dear sir? Without payment of tax. Letter of undertaking, LUT means. Further, we have been covered all the points here. One important point need to be covered here, my dear sir, is this. While computing, this export turnover should not include the turnover of your supplies under the rule number 89, sub rule number 4A, sub number 4B. Means what you know that, sir? Sir, I supply the goods to a holder of advance authorization where I am charging is just, let us say, 0.5% CGST, 0.5% SGST, effectively 1% of GST. That amount I charge on my output supply to advance authorization holder. For example, in that case, my supply called deemed export. In that case, the tax what I charge, I can, with that amount can be claimed as a refund. Such a clearances, such a supplies turnover is a deemed export. That should not be considered in the given case of numerator formula. Numerator in this formula, you should not be considered that value. Is it clear, my dear friends? Further, referring to you here. Further referring to you on refund to be granted both in cash and in credit based on original mode of payment. Rule number 92, sub rule number 1, capital A. What this provision speaks, I will refer to you with the illustrative example is as follows, my dear friends. Look here example, my dear sir. X Limited, their liability 10 lakhs of GST for a given month, paid 4 lakhs by utilizing electronic credit ledger, followed by 6 lakhs they paid by utilizing electronic cash ledger. Electronic credit ledger 4 lakhs they paid, electronic cash ledger 6 lakhs they paid. Total 10 lakhs they paid for a given month. Assume for the month of April, for a given month of April, they paid 10 lakhs of their liability. In the month of May, they came to know that out of this 10 lakhs, they mistakenly paid 2 lakhs paid mistakenly. 2 lakhs paid mistakenly. Can claim refund? Yes. In the month of May, they are claiming for refund. Claiming refund of 2 lakhs which has been paid mistakenly. Be careful. Or paid wrongly. This type of case only covered here. If there is a case, this 2 lakh rupees can ask for refund. In the month of May, applied for refund of rupees 2 lakhs. Department will grant to you refund of 2 lakhs in the proportion of, here you see here, 6:4. Simplified manner to say that 6 lakhs paid by cash, 4 lakhs of GST paid by electronic credit ledger. Therefore, in that ratio, you make simplify further also like this. In the ratio of 3:2. In that case, my dear sir, when you apply for refund, found is in order, in that case, department will grant to you refund of rupees so much by electronic cash ledger, by giving the credit to you, the electronic cash ledger. Balance proportion attributable for this 2/5 is to your electronic credit ledger. Refund of rupees, if you refer here, 2 lakhs multiplied by 3/5, 2 lakhs multiplied by 3/5, 1,20,000 by credit to electronic cash ledger, followed by the refund claim further. Refund of rupees 2 lakh multiplied by 2/5. How much comes here? The balance amount of rupees 80,000. Am I right, sir? 80,000 by giving credit to electronic credit ledger. In this manner, now the department is providing to you the refund. If you paid the tax by mistakenly or by whatever may be, overestimated values were not required to pay, you paid the tax. In such cases, the refund, if you ask, refund will be given to you by giving proportionately to your electronic credit ledger as well as to electronic cash ledger, where you paid the tax by utilizing electronic credit ledger. Got the clarity, my dear sir? Is the way in which you have to understand the subject of this entire procedural aspects. Got the clarity, my dear sir? Refund to be granted both in cash as well as in credit based on the original mode of payment. What is the original mode of payment? Look here. Come and look here. Where you have here the X Limited 10 lakhs liability in the month of April, which has been paid 4 lakhs by electronic credit ledger, 6 lakhs by electronic cash ledger. In that proportion, namely 3:2, you can ask for refund. If you found out of 10 lakhs, 2 lakhs has been paid mistakenly, then ask for refund of 2 lakhs. In that case, refund will be granted to you in the ratio of 3:2. 3/5 multiplied by 2 lakhs 1.2 lakhs by giving the credit to electronic cash ledger, and 2 lakhs multiplied by 2 by 5 by giving the credit to electronic credit ledger. In that manner, refund will be granted. Is it clear, my dear friends? Shall we proceed, my dear sir? Likewise, proportionately providing refund to your electronic credit ledger, to your electronic cash ledger is not applicable in the case where you export the goods which is zero rated supply. If you refer, my dear sir, here, the above provision shall not apply to the refund of tax paid on zero rated supplies. Zero rated supplies or deemed exports. In such case, refund whatever may be will be given to you by electronic cash ledger only. Got the clarity, my dear friends? Not by giving the credit to electronic credit ledger. In fact, these exporters will get the payment by giving the credit to their bank account itself. Got the clarity, my dear sir? Furthermore, referring to you here, my dear friends, provisions with regard to amendments under refund. Here, excellent explanation under rule number 96 sub rule number 10 clause B inserted by saying that they lay down now an embargo. Embargo means ban on the refund claim. Ban on refund claim by a person seeking refund of IGST paid on export of goods or services. The restriction is that such person should not have availed the benefit of exemption from IGST and compensation cess for goods imported by EOUs or advance authorization holder or EPCG scheme holder, namely export promotion capital goods scheme holders. How to understand this? Simple. I am presenting that is as follows. Look on the screen, my dear sir. Basically here, if you refer, X Limited is a holder of advance authorization, imported the goods without payment of BCD, basic custom duty, without payment of IGST, without payment of compensation cess, he imported the goods. After manufacture, being a manufacturer, he exported the goods by payment of IGST. Such a IGST payment not allowed as a refund. Not allowed as a refund. IGST paid on export of goods, that amount can ask for refund. One option is there. That is not allowed. If you are holder of advance authorization or a holder of the EPCG license, or you are a UOU unit, imported the goods without payment of taxes under the customs, namely BCD, IGST, compensation is not paid, imported, and after manufacturing, exporting, while exporting you paid the tax for obvious reasons, that IGST paid on export not allowed as a refund. Is it clear, my dear sir? Further, I am referring here, one para is given here. An explanation has been inserted to this clause which clarifies that the benefit of the notifications mentioned therein shall not be considered to have been availed only where the registered person has paid IGST and compensation cess on inputs and has availed exemption only on basic custom duty under the said notification. Simple, my dear. You are aware of that DFIA scheme, duty free import authorization scheme, where that license is given to you only after export, post export. Now, using the DFIA, I import the goods, where exemption only from basic custom duty, but I have to pay IGST as well as compensation cess. But I got the benefit of not required to pay basic custom duty to the extent of my license value, to the extent of my DFIA value. Good. That goods, if I manufacture, exported by payment of IGST, that IGST I can ask for refund. Yes, this is what they says here. An explanation has been inserted by saying that the benefit of the notification mentioned therein shall not be considered to have been availed in the case where I imported by payment of IGST, by payment of compensation cess, but exemption from BCD is possible only when I have DFIA, duty free import authorization, which is post export benefit given to me. If I import the goods under that DFIA without payment of BCD, after manufacturing export the goods by payment of IGST, that I can ask for refund. Yes. Further, my dear friends, referring to here, refund. An excellent issue it is. Rule 96B of the CGST rules, which says that recovery of refund of unutilized input tax credit or integrated tax paid on export of goods where export proceeds not realized. Now, my dear sir, the GST comes very keen on that particular exports which you made on credit basis. Thereafter, applying the formula of claiming refund, exported turnover by total turnover multiplied by input tax credit, and you claiming refund. Refund is given with the intention you are going to be getting foreign currency. Am I right? Going on, you are exporting the goods. After few years, going on writing in the books of accounts bad debts. In the meantime, you availed input tax credit as a refund. Fraud case. Therefore, the government of India said, upon the recommendation of GST Council, hey Mr. Exporter, if you export the goods under LUT without payment of tax, fine. Or you might have been export the goods by payment of IGST. Okay. Those taxes, if you claim refund, it is your responsibility to ensure that payment for your exports should be realized within the specified period of time as specified by FEMA, Foreign Exchange Management Act. You should be realized the payment within the time period given by FEMA, or otherwise within further time period extended by RBI to realize the payment. Within that period you have to get the sale proceeds. If you not receive the sale proceeds of your exports, but already availed GST paid by you as a refund, in that case that refund amount should be returned back to the department within 30 days. Within 30 days, with the interest should be returned back to the department, that refund amount of the expiry of the said period, or as the case may be, extended period. That means, for example, within 180 days from the date of export, you have to get the sale proceeds set by FEMA. 180 days has been expired. In the meantime, I taken away refund of my tax by applying the formula. For example, my dear, in that case, Reserve Bank of India not given any extension time period. In that case, after 180th day, within 30 days from the date, after expiry of 180 days, within 30 days, I should pay my refund amount to the department with the interest, which is 18% per annum. If not, department will issue show cause notice under section 73 will recover from me. Or section 74, in the case of fraudulently, if I avail the refund, they will use section 73 other than fraud show cause notice, or 74 fraud, as the case may be. By using such show cause notices, they will recover from me if I have not paid within 30 days from the date of expiry of the time period given by FEMA, or extended period of time given by Reserve Bank of India. If I have not paid after expiry of the time period within 30 days, they will recover from me. the refund amount by using section 73 or 74 show cause notice as the case may be. Got the clarity? Further, my dear friends, there may be sometimes Reserve Bank of India may write it off. The sale process is not going to be realized. For example, after your goods landed at importer country port, for example, tsunami came over there. Port, bank, importer washed it away. Then how the payment will be realized? Knowing the fact that Reserve Bank of India in India write it off, that sale price is not going to be realized. In that case, no problem. Then whatever refund you claim on those export of goods, you availed only, not required to return back. Further, at a later date, after expiry of time period given by FEMA or extension time period of RBI, after expiry of time period, after the refund you return back to department with the interest, at a later date, assume 250th day, the payment realized. In that case, the refund what you have been returned back can avail now? Yes. Provided within 3 months from the date of realization of the sale proceeds, you inform the department, sir, I got the payment now. Anyhow, after expiry of the time period, sir, given by FEMA, now please allow me my refund what I returned back to you. Now, please allow me to claim. Like that, you can apply to the proper officer. Then the proper officer, by satisfying, found all in order, he permit you refund. But you have to apply within 3 months from the date of realization of sale proceeds by submission of proof of document of realization, FIRC, foreign inward remittance certificate, generally issued by banker, where your payment realized, sale process realized. Is it clear, my dear sir? Further, my dear sir, at another important amended provision here it is. Further amendments under refund, one by one is as follows. Here, determination of refundable amount in case of refund of unutilized input tax credit on account of export without payment of tax, supplies made to special economic zone units or developer without payment of tax, or accumulation due to inverted tax structure clarified by CBIC. Master circular has been issued in the recent past is as follows. Very important on the part of refund claim. My dear sir, they mentioned here export of goods under LUT without payment of tax. Input tax credit can ask for refund by applying the formula. As you are aware of that formula, rule number 89, sub number 4 of the CGST rules, where exported turnover divided by total turnover multiplied by input tax credit. Or rule number 89, sub number 5, refund claim in case of inverted rate of tax formula, which is equal to, refund amount is equal to, under the inverted rate of tax, inverted rate of tax turnover divided by total turnover multiplied by total input tax credit on inputs. From that, deduct tax payable on output supply of inverted rate of tax. If the value positive, that amount claim refund. It was earlier. Now, such a blanket claim of exemption by applying the formula now has to compare with the following 3 items. Among the 3, list of the following alone should be considered. Point number 1, the maximum amount of refund under LUT, export of goods under LUT, or supply of goods to SEZ, or inverted rate of tax. How much refund is coming? Assume refund amount coming here, let us say, for example, 1,25,000 is a refund amount under this particular formula. Further, Point number B says the balance in electronic credit ledger of the applicant at the end of the tax period for which you are claiming for refund. For example, for the month of May, they are claiming the refund is, let us say, the credit applicant is there in the electronic credit ledger of that applicant is, let us say, 1 lakh rupee. For example, I am telling you. The balance credit, point number C, the balance credit electronic credit ledger of the applicant at the time of filing refund claim. How much? Let us say rupees 1,75,000. Like that, we have the values, refund amount by applying the formula in case of export of goods or inverted of tax. The credit available in the electronic credit ledger, at the time of closing of the tax period for which I am claiming for refund, or at the time of applying the application for the want of refund in my electronic credit ledger account is 1,75,000. 1,75,000. Got the clarity, my dear sir? Now, among the three values, which value is lower? The lower value is this. The lower value is 1 lakh. Choose that value. Only will be given as a refund. Is clear, my dear sir? Is an amended provision. Further, if there is a case, they are given here. After calculating the list of the above three amounts as detailed above, the equivalent amount is to be debited from the electronic credit ledger of the applicant by giving the first priority to IGST credit ledger, followed by CGST, SGST or UTGST equally. Any shortfall can be adjusted from other account also. How to understand this? Don't worry, I am presenting here. This much you understand, no sir? Among the three, A, B, C, lower is, we identified here 1 lakh. This 1 lakh is the refund amount. Fine. How to grant that refund by the department means is as follows. Now look on the screen. Electronic credit ledger of the applicant who applied for the refund of his 1 lakh. Found correct? Department want to grant. Provided you should not claim credit on inputs as input tax credit. But I have the credit in my books also shown in the GSTR 3B return for the month of May for tax period, my credit. Refund will be granted of my input tax credit. I should not claim as input tax credit. GST on inputs, I can ask for refund. I eligible to claim refund 1 lakh. If so, my credit is no longer is a credit if I go for refund. As a result, refund granted 1 lakh. Law says debit to electronic credit ledger. Now I am debiting. Debit the refund amount. First IGST fully 20,000. Out of 1 lakh, 20,000 gone. Balance how much is there? 80,000. That 80,000 equally wipe it out your credit. Here, for example, here 80,000 balance 40,000 and here 40,000. I am going to be debit electronic credit ledger because the credit not allowed for me since I am going for refund. In that case, law says here, my dear friends, look carefully. My electronic credit ledger IGST nil. Here what happened? CGST shortfall, still 5,000 rupees excess credit is there. Here, if you refer carefully, I have here with me the refund amount excess even after mitigating my electronic credit ledger credit of SGST. Still I have excess how much? Here 5,000. This 5,000 excess is not the credit, is a refund amount. This excess of refund, I should set off shortfall of my CGST also, thereby furthermore debit to CGST by taking that amount from SGST. This amount not credit amount, refund amount. Therefore, my credit left over to me is as follows. Here, this credit will be furthermore nil, here nil, and here also nil. That means what? My refund amount of 1 lakh is allowed to me by debiting to my electronic credit ledger balances. Because if I claim that credit and the refund also 1 lakh is undue benefit. That's what the clarification has been given in the given case. If you refer these 2 points, you will understand my explanation. The explanation of these 2 is this. Got the clarity, my dear friends? Further come back, my dear sir. Continuation of refund amendments. What is this amended provision here? Latest one. Circular issued by CBIC. Bunching of refund claim across financial year permitted. Financial years permitted. Across the financial years. Earlier, my dear sir, it was not so. Tax paid wise, you have to claim the refund. Now, for example, I am claiming refund quarterly for the financial year. Let us say financial year 2021, 22. Here there are 4 quarters and here also 4 quarters. Put together I can claim for 8 quarters. 2 years together I can claim for refund. Bunching of refund is allowed across the financial years. Therefore, 4 quarters, 8 quarters refund claim I can submit at a time. Is a procedural relaxation. Amended provision. Further referring, my dear friends. Refund of accumulated input tax credit on account of reduction in the GST rate on goods not available. You know that section 54 subsection 3 inverted rate of tax means what? My inward supply suffered 5% GST. My outward supply is, let us say, 18% GST, which is not called as inverted rate of tax. Then what is the inverted rate of tax? My inward supply suffered 18% GST, for example. My outwards suffering 5% GST. It is called as inverted rate of tax. Repeating, my inward supplies of goods suffered 18% GST. My outward supply suffering only 5% GST. It is called inverted rate of tax. That can be asked for refund by applying the formula. Refund formula under the inverted rate of tax is equal to inverted rate of tax turnover divided by total turnover multiplied by total credit. Whatever output comes from that deduct tax payable on inverted rate of tax turnover. If the value positive, that amount refund. Now, here what happened, clarification given by CBIC stating that, hey Mr. Registered person with GST, are you a manufacturer or a trader? Sir, I am just a trader, sir, buying the goods, selling the goods, buying the goods, selling the goods. What I purchase, same I am selling, sir. Fine. For you, this inverted rate of tax, refund claim not allowed. What do you mean that? I purchased HP laptop, for example, Hewlett Packard laptops, I am buying and selling. I am a trader. When I purchase, 18% GST I paid. When I am going to be sell that HP laptops, rate of GST reduced by GST Council to 12%. Can I claim that differential by applying the inverted rate of tax formula under section 54, subsection 3, refund not allowed. Then for whom allowed means, if you are a manufacturer, you buying the raw material by paying 18% GST, after manufacture you produce the finished goods, that finished goods attract 12% GST, then inverted rate of tax, input tax credit allowed as a refund by applying section 54, subsection 3 of the CGST Act, refund claim. That means make in India, make in India concept is one of the flagship program of the government of India, make in India. For a manufacturer, inverted rate of tax, credit, refund allowed. For a trader, not allowed. As simple as this, the entire story. Got the clarity, my dear sir? I can say that thus the refund accumulated ITSA under the said clause would not be applicable in case where the inputs and output supplies are the same. Means for a trader, this particular refund not applicable. Is clear, sir? Further, here, what is this amended provision? Section 54, subsection 3 speaks, refund of ITC restricted to the extent of credit reflected in the GST 2A return. Means what? Are you aware of that? The input tax credit allowed, which is restricted to the extent of invoices uploaded in the GSTR 1 written by suppliers, that credit allowed. For the invoices which is not uploaded in the GSTR 1 written, on which input tax credit not allowed. You are aware of that, no sir? In that case, maximum amount of credit is equal to invoices uploaded in the GSTR return 1 on which credit plus 10% thereon, compare with the credit on invoices which is not uploaded, among the two whichever is less will be the maximum amount of input as credit. Such a restriction is given here if you claim refund under section 54 subsection 3 in the case of inverted rate of tax refund, which is restricted to the extent of invoices which are uploaded in the GSTR 1 written by suppliers reflecting in the recipient's GSTR 2A, that much only credit allowed. Even though you claim the refund, much more than that, restricted to that much only. Example simple. So, as per section 54 subsection 3, you are claiming refund of rupees, let us say 50,000, but the GSTR 2A return shows ITC, let us say, for example, ITC, let us say 22,000. Then refund claim restricted to 22,000 only, not the entire value of 50,000. Is it clear, my dear friends? The balance you want to claim refund only when the suppliers upload into their GSTR 1 return and reflecting in your GSTR 2A return, that time only the balance credit can be claimed as a refund. Is clear? Furthermore, my dear sir, Clarifications of the CBS. Very simple, my dear. Though it may be a circular of the CBS in the recent past, what is it is means very simple. Many times I told you in the regular class, sir, if Rafi Academy, you take Rafi Academy. Rafi Academy is a supplier of service provider, and the time of supply will be the date of completion of supply of service or date of payment received, whichever is earlier. You are aware of that. Now, Rafi Academy received the payment from the student in advance. Today itself I got a payment from the student for the service which I am going to be render in the month of October 2023. I got the fees today itself. I have to pay the GST for the current month, time of supply arises. Now, current month what? Let us say September, due date is 20th of October, I paid the tax. And to my recipient of service, I issued the bill, namely tax invoice I issued. Tax invoice issued against the advance payment, and I paid the tax on before the due date. What happened after the payment of the tax and after issuance of tax invoice to my recipient of service? At a later date, the student came to me, sir, I am going to USA permanently along with my family. We are shifting to USA. Now I am going to be study CPA course. Therefore, please refund my money. Rafi Academy honestly paid the entire amount of his fees as a refund, paid, and he gone away. In meantime, what happened? Rafi Academy paid the GST on such advance payment, and such a transaction has not been taken place subsequently. In that case, whatever I paid the tax, can I claim refund? Or it can be adjusted against my tax liability in the future period? That is the question. That is the issue. That is the issue raised here. Point number 1. Clarification you may see by saying that, hey Mr. Rafi Academy, you paid the GST and advances by issuing the invoice to the recipient. At the same time, your recipient not in a position to avail input tax credit. Good. In that case, before rendering services, such a service got cancelled. But after payment of GST, after issuance of invoice, in such case, that should be refund adjusted against your future liability only. It cannot be refunded by way of cash to you. The tax liability shall be adjusted in the return subject to the condition of section 34 of the CGST. Section 34, you know that I should issue the credit note for the given case on or before 30th September of the succeeding financial year, or before filing annual return, whichever is earlier, I should issue the credit note for that amount, and I should adjust by showing the returns, subsequent return, I should show that amount as a credit note, show in the return, and adjust against the subsequent liabilities, but not refund to claim. Is clearer? Sir, what happened if the subsequent liability does not arise? Rafi Academy, due to corona, there is no students, for example, my dear, and no liability in the future period. In that case, that tax what I paid can ask for refund. Yes, excess payment of tax, if any, can be claimed refund. Got the clarity under the GST RFD 01? Got the clarity? Same way is in the case of supply of service, correct? Same way is in the case of supply of goods, where goods has been dispatched to the buyer and invoice also be issued on credit basis. Subsequently, I paid the tax. After payment of the tax, those goods are returned back to me, entire goods returned back to me, my buyer. In that case, I should issue the credit note, same should be reflected in the return, and I can adjust in the subsequent liability by following strictly section 34 of the CGST. If there is no subsequent liability, then only I can ask for refund. Got the clarity, my dear sir? What about this point number 2? Point number 2 is here. Here, in the case of advance payment received by a service provider and issued voucher, receipt voucher, issued what? Receipt voucher, not the invoice. Advance received and issued to them advance voucher, receipt voucher only issued, but not invoice. In that case, since I received the advance being a supplier of service, I pay the GST before the due date. Before providing services, but after payment of the GST, that service got cancelled. In that case, I should issue, not credit note, I should issue the refund voucher. I should issue the refund voucher. In that case, the GST, whatever I paid earlier, I can ask directly refund, not adjustment of against liability. No summarizing. In case of services, where I receive the payment in advance and issue the invoice, pay the GST. Subsequently, that particular service before rendering got cancelled, but I already paid the tax. I should issue credit note and show in the returns, strictly following section 34 provision of the CGST, and the subsequent liability I can adjust this excess payment of tax. If there is no subsequent liability, then only I can ask for refund. Same manner in case of supply of goods, I deliver the goods to my buyer, I issue the invoice also, but the goods delivered, issue the invoice on credit basis. Subsequently, I paid the GST thereon. At a later date, that fellow returned back the goods to me. In that case, I should issue the credit note to him, and the same should be reflected in the returns by following section 34 of the CGST Act. Thereafter, I can adjust that excess payment of GST against subsequent liability. If there is no subsequent liability, then only I can claim for refund. In the case of supplier of service, in the given case, second point, in the case of supplier of service, received the advance but issued receipt voucher but not invoice. In such case, law of the land says that I paid the GST thereon. Before rendering such services, the service got cancelled. Excess payment of GST on advance, I can ask for directly a refund. By issuing to my person who gave to me the advance, I had to issue to him, when he cancelled this particular contract, I should issue refund voucher. A receipt voucher when I received the advance, I paid the tax. Before rendering services, it got cancelled. I should issue refund voucher. In that case, the tax what I paid excess, directly I can ask for refund. Is clear? Is this circular speaks? My dear, as simple as that. Now referring to you, my dear sir, assessment followed by audit also. Standard operating procedure to be followed in case of non-filers of return. Standard operating procedure should be followed uniformly to all assessees who are under the non-filers of returns category. Issuance of show cause notice, namely section 46, followed by assessment of the non-filers of the returns of the assessees, section 62 will apply. What procedure should be followed? Here so much is mentioned, my dear, spread in 2 pages, almost all here, so many points. 7 points are there. Further information also is here. I will explain to you simplified manner. Look and understand. Listen and understand. Dear friends, explaining this standard operating procedure to be followed for non-filers of returns. Sir, assume a scenario. Rafi Academy registered person under GST. Not file the return. Or maybe BLT file the return. Here, should be followed now to all assets uniformly. First and foremost, gently, a particular touch. Just, hey, due date of filing the return is ahead. Like that, a particular nudge, namely a gentle touch to inform by message 3 days before the due date of filing the return. Department informed to all assessors 3 days before the due date of filing the return, informing them due date of return is so and so date. File the return if not filed so far, rather than to file before the date or on the day, that time server may be not in a position to accept. Therefore, take precaution. Like that, gently a touch by informing the assessee. Department informed to the Rafi Academy. They got the message, SMS, due date 3 days, still there. Today we got message, file the return if not file. Fine. Rafi Academy not file the return. Department came to know that, system came to know that, as on the due date as referred under section 39 of the CGST, not filed the return. GST 1 not filed. Department, server, GST network portal came to know that. System generated mail should be sent, SMS should be sent to such non-filer of returns immediately after the expiry of the due date, stating that please file the return, which is not filed by you, is a second point. Further, third point, if Rafi Academy even not respond to the mail also, not file the return for a period of 5 days from the due date of filing the return, not file the return, then department should issue notice under section 46 of the CGST stating that, hey Rafi Academy, you not file the return even after 5 days of due date. Now you please file the return within 15 days from the date of servicing of this particular notice under section 46. Notice has been served from the date of service of notice of 46. I should file the return within 15 days. Department issued the notice. Rafi Academy received the notice under section 46 of the CGST, not file the return even for a period of 15 days from the service of the notice. In that case, department officer should use his best of knowledge and gather the information from his earlier GST 1 returns, GST 2A returns, e-way bill of the assessee, or if need arises as per section 71 of the CGST, accessing the premises of the assessee, finalize the amount by following the best judgment assessment, and arrive the value under section 62 of the CGST and say that, hey Mr. Rafi Academy, you liable to pay 2 crores GST. Department gather information, issue the assessment order under section 62 for non-filers of return. Rafi Academy got tense with that. Sir, what is 2 crores, sir? It is too big amount, sir. No, sir. I am going to file the return, sir. What are the returns I have not filed? I filed now. Within 30 days of passing the assessment order under section 62, this Rafi Academy filed all the returns and the dues, whatever may be, paid and approached the Commissioner of Central Tax. Sir, I'm a good boy, sir. I filed the return, sir. In such case, Commissioner of Central Tax, proper officer, considering my request, withdraw the assessment order issued under section 62 and go with the normal procedure. If Rafi Academy, even after assessment order issued to me, not responded to the department within a period of 30 days from the date of passing the assessment order, within 30 days I have not responded. Who will respond to department? Like that, Rafi Academy, where Mr. Rafi is sleeping. Even after expiry of 30 days, after passing the assessment order. In that case, department officer is empowered to issue section 78, recovery proceedings. Section 79, manner of recovery. Even Commissioner of Central Tax is in a position to protect the revenue of the interest of the revenue. To protect the interest of the revenue, Commissioner may also say that attach the property of such assessee who's not responded even for a period of 30 days after passing the order of section 62, assessee not responded, attach his properties. Attachment of property also takes place. And he's not filed the returns. Consequently, for a period of 6 months, in the case of a composition assessee, for a period of 3 consecutive tax periods, not filed the returns. Other than the composition scheme assessee, for a 6 months period consecutively, not filed the returns. In that case, department, after protecting the interest of the revenue, they may proceed further to cancel the registration also. This is what the standard procedure which has been incorporated by way of circular for non-filers of return, issue the notice under section 46, read with passing the assessment order section 62 of the CGST. Got the clarity, my dear friends? Further referring to you from here, important mind-blowing amendment taken place, anti-profiteering. Anti-profiteering, how to understand this? In your page number 45, this presenting here, minute amendments. Anti-profiteering. My dear sir, when application received by state level screening committee, there was no time limit to complete the process of further to reject or to send for the standing committee. There was no time limit for state level screening committee. Now the time limit has been inserted. Within a period of 2 months or further can be extended further 1 month from the date of receipt of a written application from the applicant should finalize whether satisfied with there is a profiteering taken place or not satisfied. Finalized within 2 months from the date of written application received. If not, furthermore 1 month can be extended. Over a period of 3 months, state level screening committee should finalize whether to take up proceeding further or not to take up. There was no time limit earlier. Now is added. Is one amendment. Further, standing committee within a period of 2 months should satisfy further course of action whether the anti-profiteering taking place or not to decide by standing committee within a period of 2 months. Now they can have further extension period of 1 month is an amendment. Standing committee shall within a period of 2 months, now amendment, extended further period of 1 month from the date of the receipt of the written application. If they satisfied, go further course of action. If not satisfied, reject the application, close the file. Further, if they satisfied, it goes to Director General of Anti-Profiteering shall complete the investigation whether profiteering taken place or not within a period of, earlier there was 3 months, now has been replaced as 6 months. If not sufficient, furthermore 3 months can be extended. What is amendment? 3 months time period was there with the Director General of Anti-Profiteering to investigate the matter, to complete the proceedings. Now has been replaced to 6 months is amendment. If not sufficient 6 months, further 3 months time period can be extended to complete the investigation by the Director General of Anti-Profiteering, whether profiteering taken place or not. Further, National Anti-Profiteering Authority will further take a course of action decision within earlier 3 months, now has been replaced as 6 months. Decision of National Anti-Profiteering Authority within 6 months from the date of receipt of the report from the Director General of Investigation, namely Anti-Profiteering Investigation, whether there is profiteering taken place or not, such a decision should be taken by the National Anti-Profiteering Authority. If they satisfied, yes, there is a profiteering taken place, then proceed further. Or if National Anti-Profiteering Authority decided, Director General, what you submitted the report is not satisfactory, there won't be any profiteering taken place, in that case the matter will be closed. If it is National Anti-Profiteering feels that yes, there is a profiteering, Director General report is valid, then within 6 months they take the decision to take further course of action. What type of actions? As follows. Rejection, namely reduction in the price should take place, taken place or not, action should take to reduce the prices. Where that anti-profiteering aspect point of view, where there is a reduction in the tax rates, where there is a benefit of it, input tax credit should be passed on to the end user. If not, is a profiteering, then reduce the prices. Further, return to the amount excess collected from the customers, return to the customers. If not returned, the amount will be sent to consumer welfare account. That means if the hotel industry says that, sir, the rate of GST 18% was there, my 2 idlis 20 rupees. Even now, rate of GST 5%, rate of GST for 2 idlis 5%, but my rate of 2 idlis remains 20 rupees, as was earlier when 18%, same price I am charging now, means anti-profiteering. But I could not able to return the money from whom I collected, sir, because my customers are not identifiable, sir. In that case, that excess what you collected, benefit is profited by you, should be deposit in the consumer welfare account. With the interest now, the amendment taken place. Further, imposition of the penalty also takes place if there is a profiteering taken place by National Anti-Profiteering Authority, or cancellation of registration also takes place. So, action, further course of action on the person who has been profited, he is liable to repay to the customer from whom is collected with the interest, otherwise deposit to the consumer welfare account with the interest at the rate of 18%. Such a person registration may be liable for cancellation also. Further, this entire story is what? Just now I said, if you are not able to refund the money excess what you collected, deposit in consumer welfare account, central consumer welfare account 50%, state consumer welfare account is balance 50%, central 50%, state 50%. Along with the interest at the rate of 18% from the date of collection of the higher amount till the date of deposit of such amount in the consumer welfare account, you have to pay the rate of 18% interest per annum from the date of collection of the excess payment. Further, state means the state in which the anti-profit authority located. Further, what is this entire story talks about here? This entire story. Sir, I will tell you the entire story of this, my dear sir. Director General of Anti-Profiting submitted the report to National Anti-Profiting Authority. They verified. Hey, Mr. DG, anti-profiting, there are some points not addressed. Now investigate. Like that, first investigation can be ordered by National Anti-Profiting Authority to Director General Anti-Profiting within a period of 6 months. It is a fresh investigation start further. Further, such National Anti-Profiting Authority is actually this particular anti-profiting time period is life is 2 years from the appointed date. From the date of chairman enters upon his office is for 2 years only life period. Now this anti-profiting authority life period has been further extended from 2 years to 4 years. 4 years time period from the time of chairman enters, from the date on which the chairman enters upon his office for a period of 4 years from the date of commencing the operations. 2 years has been extended to 4 years. Is clear, my dear sir? Is one of the amendment. Further, demand and adjudications. What amendment taken place here is important point. Sir, department officer should not issue just because of notice non-payment of GST straight away show cause notice 73, 74. That fellow will cry. First intimate him. Hey, Mr. SSC, you not pay the tax. Can you check and tell me? Intimation. And the assessor is good boy. In that case, he will come back. Yes, sir, I have not paid, sir. You take the amount of tax and interest. Thereby, what happened? Non-fraud cases, assessee not required to pay penalty. Fraud cases, he can pay penalty. What is the reduced penalty? 15% of the tax amount. Namely, maximum penalty. 15% of the maximum penalty as a reduced penalty he can pay in case of fraud cases, where if you intimated being officer to the assessee about his non-payment, in case of fraud, he paid all taxes and interest and penalty only 15% of the maximum penalty. Thereby, it is to the extent beneficial to the assessee. Therefore, assessee do not tempt to issue upfront show cause notice under 73 or 74. First intimate, assessor goodbye. He is definitely going to be paid to you the taxes. If you notice department asking to pay, definitely assessee will pay off. With that intention, the government GST Council has been introduced this particular intimation before issuance of show cause notice as a beneficial to the assessee, where in the case other than the fraud, such assessee can pay off because of intimation given by the officer, not payment taking place, then I can pay tax interest, not required to pay penalty. Further, this point here as follows. What is this means? If the assessee paid the full amount or the assessee paid part amount of whatever intimated by officer, and assessee submitting his stand by way of a submission of documents for which acknowledgement should be issued by the officer as full payment you paid, acknowledgement, or part payment you paid as, or documents are required to submit it. Like that, acknowledgement should be issued to the assessee by the officer if the assessee replied to your intimation. Further amendments, special procedure has been brought into force in the recent past for corporate debtors. For corporate debtors undergoing the corporate insolvency resolution process under the Insolvency and Bankruptcy Code 2016, where generally what happened, the company unable to pay the debts and all, and the liability is huge beyond the threshold limit, which falls under the bankruptcy, namely insolvency. In that case, in generally, this particular case of corporate insolvency resolution process started, where that company might be under bankruptcy insolvency case. In that case, there might be appointment of interim resolution professionals, IRP, or resolution professionals, namely RP, in the case of insolvency taken place. Under the Insolvency and Bankruptcy Code, it is mandatory to appoint this particular interim resolution professionals or resolution professionals. In that case, what happened? No, my dear sir, in that case, that particular person of the resolution professional is responsible to pay the GST liability. A new provision has been brought into force under GST under section 148 of the CGST, where the lawmaker said that in the case where, for example, X Limited undergone for insolvency, where the Insolvency and Bankruptcy Code applied, in that case, if X Limited has 3 locations, head office in Chennai, branch office 1 in Hyderabad, branch office 2, let us say, in Mumbai. In that case, having the same PAN number only, PAN number remains same, 1 PAN number, 3 locations. These 3 locations will be treated as distinct persons, where the liability of the GST should be remitted by the particular resolution professional to the department. In that case, all the 3 should be got separate registration as a distinct person is warranted within a period of 30 days from the date of appointed of resolution professional. Should be separate registration in addition to normal GST IN registration. Since that company undergone for insolvency, in that case, these 3 locations will be treated as distinct persons. Separate should be registered. Separate registration is required within 30 days from the appointment of this particular resolution professionals, IPs, and pay the GST liability to the department. Is what the provision has been brought into force in the recent past by inviting the Insolvency and Bankruptcy Code. And this particular management which undergo for insolvency should be treated as, in particular, the corporate debtor, namely here very clearly mentioned, will be treated them as corporate debtors, will be treated as distinct persons. Is clear, my dear sir? And the insolvency professional, or otherwise we can say that the interim resolution professionals should be liable to pay to department the GST liability of that particular company. Is it clear, my dear sir? Further referring to you here, appeals and revision. What amendment here taken place means, under section 108, revisionary authority earlier only the principal commissioner or commissioner of central tax or state tax. Below his rank authorities orders can be revised. He is a revision authority. Now that has been bifurcated in 2 parts. Superintendent orders Deputy or Assistant Commissioner orders can be revised by Additional or Joint Commissioner is a new provision. Further, Additional Joint Commissioner orders can be revised by Principal Commissioner or Commissioner of Central Tax or State Tax. We call them as revisionary authorities. Superintendent orders, Assistant Commissioner, Deputy Commissioner orders can be revised by Additional Commissioner or Joint Commissioners. Therefore, we call the Additional Commissioner, Joint Commissioner with amended provision as revisionary authority. Likewise, Joint Commissioner, Additional Commissioner orders can be revised by Commissioner or Principal Commissioner. Therefore, we call them revisionary authority. Is an amendment taken place here. Furthermore, my dear friend, finally we reached under the GST advanced ruling concept. Yes. I have given so much, my dear sir, but it is not amendment, in fact. A procedure I given. In what are the cases one can go for authority for advanced ruling and first go to AAR, authority for advanced ruling. From there you go to AAR, appellate authority for advanced ruling. This and all normal case, no amendment, you are aware of that. I explained elaborately in the regular class. What is amendment taking place means when the matter went to AAR, appellate authority for advanced ruling. There only what output came out from AAR. Sir, AAR of Tamil Nadu given the ruling to Rafi Academy, which is different from AAR ruling given by Telangana state of the Rafi Academy. You get my point, sir? Rafi Academy has single PAN number to multiple registrations in the state of Tamil Nadu, in the state of Telangana. This matter, one of the dispute went to AAR. Telangana AAR given ruling to Rafi Academy is different from AAR given the ruling to Rafi Academy Tamil Nadu. Conflict judgments. What Rafi Academy should do, where he can go and get the further solution means now such assessee who got two different judgments from AAR of two different states should knock the doors of the National Appellate Authority, appeal to National Appellate Authority, appeal to National Appellate Authority. Got the clarity, my dear sir? Likewise, suppose a case where authority for the appellate authority for advanced ruling AAR, while delivering the judgment, the members of AAR are expressed different opinions. In that case, what happened, no sir? As if there is no appeal to AAR. There is no appeal to appellate authority for advanced ruling. In that case, if the members of AAR are differ from their opinion, or otherwise AAR of one state given the judgment differently than that of AAR of the other state for a given assessee, in such situations, in these two situations, the person can go to National Appellate Authority. It may be a department, it may be the assessee, as the case may be. National Appellate Authority is an amended provision newly inserted under the CGST Act under section 101 capital B of the CGST Act from 1st August 2019 is an amended provision. Now, National Appellate Authority time period to go for National Appellate Authority is within 30 days from the date of the judgment delivered by the different judgments given by AAR or the members of the AAR differ their opinion. They dispose of the case as if not appealed for. From the date, within 30 days, the assessee can go for National Appellate Authority. In the case of departmental appeal, it is 90 days time period from the date of the order of AAR. Delay in filing the appeal can be condoned by National Appellate Authority for a period of not exceeding 30 days. The order shall be passed as far as possible within 90 days of the receipt of the appeal. They can come out with the judgment by National Appellate Authority, which is binding on the applicant and the department. If members of the National Appellate Authority differs from their opinion, then the judgment will be delivered based on the majority. Majority of members' decision will be prevail. Is clearer, my dear sir? Is an amendment in the authority for advanced ruling concept. Got the clarity, sir? One more amendment here under the miscellaneous provisions. Section 168 capital A of the CGST Act, where central government has issued Taxation and Other Laws Relaxation of Certain Provisions Ordinance 2020 on 31st March 2020. What type of power it is? Ordinance is inserted by saying that under the CGST Act, government is empowered to extend the due date of filing the return, and such a power to extend the due date of filing the return may be retrospective period also, where the matter, where the need arises to extend the due date is, here they stated that force measure means war, epidemic, flood, drought, fire, cyclone, earthquake, or any other calamity caused by nature affecting the implementation of the provision of the GST Act. In that case, one can say corona, due to which extension of due date of filing the return has been taken place. One of the best classical example. Such a power is now with the government under section 168 A of the CGST Act to extend the due dates of filing the return, which may be retrospective period also. Is clear, my dear sir? With this, the GST amendments has been concluded. Now referring to the foreign trade policy, prior to that customs amendment provisions as well as foreign trade policy 2015 to 2020 amendments applicable for your coming exam of November 2020 onwards. One by one is as follows, my dear friends. Now listen, my dear friends. This clarification of the CBIC issued by the Government of India by notification stating that IGST is exempted on your imports. What type of imports IGST exempted is very clearly mentioned here. If we imported temporarily aircraft engines, spare parts, such import were covered under Schedule 2 of the CGST Act, point number 1B, transfer of right without transfer of title is a service. Schedule 2, point number 5, subpoint F, which talks about transfer of right to use any asset for any purpose for cash or deferred payment as consideration, is also supply of service. In such case, if you import aircraft, even vessels also, other than the motor vehicles, spare parts of aircraft or engine of aircraft, you imported to use temporarily in India and returning back to the person from whom you imported. In such case of import of such goods, exempted from IGST. I will tell you by showing the picture here as follows. Look on the screen. Import of aircraft. Now also be added here, even vessel also, but not vehicles. Motor vehicles not allowed here. So import of aircraft, vessels, or engine, aircraft engine, or aircraft spare parts. If we imported, which is covered under Schedule 2 of CGST, point number 1B as well as point number 5F, then exempt from import duty, namely IGST exempted. Goods imported temporarily basis, aircraft, aircraft engines and other aircraft parts imported into India under a transaction covered by item number 1B of Schedule 2, namely transfer of right in goods without transfer of title, or Schedule 2, point number 5, subpoint F, namely here we can say that is nothing but transfer of the right to use any goods for any purpose for cash, deferred payment or other valuable consideration. We refer to, sir, a financial list concept, supply of service. Schedule 2, point number 5, F, talks about transfer of right on goods where cash or deferred payment you are going to make as a consideration, especially lease, where ownership not going to transfer. Such a transaction falls under that transaction. You import the aircraft, aircraft engine, aircraft spare parts, which are exempted from IGST. Those goods are exempted from IGST, provided you should satisfy conditions. Here they add one more point. You are also allowed to import under this Schedule 2, point number 1B or Schedule 2, point number 5F transaction, which is purest form of service, nature, transaction. Title not transferred, right only transferred to use asset. Like that, if you imported the goods, including vessels, qualify from exemption from IGST under the Customs Act, provided you should satisfy certain conditions. Here, you can also allow to import vessel also, but not allowed to import vehicle. If you import the vehicle, even temporarily basis, you have to pay IGST on such value of vehicle. So this notification apply only for aircraft, spare parts of aircraft, engine of aircraft or vessel. Further they said, exemption from IGST and the customs allowed, provided you satisfy the conditions. I will refer the conditions now. Further, they said, if goods imported temporarily basis, rigs and ancillary items imported for oil rig or gas exploration and production imported into India under a lease, These and all parts of the rig for the rig purpose imported on a lease basis also be exempted from IGST, provided you should satisfy the conditions. What are the conditions one should satisfy given in your material neatly for a kind consideration, my dear sir? I have been given neatly in your material stating that importer should execute a bond. Importer should execute a bond in the office of Commissioner of Customs. Wherever required surety or security for the bond should be provided. Further, the imported items of this or these items, including vessel, excluding motor vehicle, should be covered under Schedule 2, point number 1B or Schedule 2, point number 5F of CGST Act. It's a supply of service nature, transfer of right without transfer of title. In that transaction, you have to import these goods. And further point, condition number 2, not to sell any part of this part in India without the prior permission of the Commissioner of Customs. 3, these imported goods, you should be exported back within 3 months from the date of import. That is very important. And the 4th point, you bound yourself to pay IGST wherever, whenever default taken place on account of demand of department. I bound to pay IGST. Such undertaking you have to give in addition to the bond. So 4 conditions, my dear sir. These goods are imported by you. These goods are imported by you, which also includes vessel, but not include motor vehicle, exempted from IGST, provided 4 conditions satisfy. All the 4 conditions as follows. First of all, you have to execute a bond in the office of Commissioner of Customs for import the goods without payment of IGST. Bond executed. Then further conditions. Condition number 1. These imported goods should be covered under Schedule 2, point number 1B or Schedule 2, point number 5F. Temporary import. 2. Condition number 2. Importer should not sell these goods because he is not the owner of the goods. He has a right to use but not the right to sell. So he should not sell these goods without the prior permission of the Commissioner of Customs. 3. That imported goods should be exported back to the person from whom you imported temporarily within 3 months from the date of import. You have to return back. And 4th condition, agree to pay whenever department demands the IGST on such goods. You have to give undertaking letter. Then all the 4 conditions satisfied, these goods on account of import is exempted from payment of IGST under the customs. This is what this notification speaks. This notification speaks. Notification number 34/2019 dated 30th September 2019. Clarification regarding tax liability of imported goods imported under the lease. 4 conditions should be satisfied to claim exemption on import of these goods from IGST. Further, my dear friends, this point already referred elaboratively. If the goods are exported, namely goods sent outside India for exhibition or sales promotion, which are intended to return within 6 months from the outside India, is an import. Such import does not carry import duty because not a supply, not a sale. Got the clarity, sir? Further, nowadays we are calling, in the given case, the export general manifest as a departure manifest. Import general manifest we called as arrival manifest. This departure manifest or arrival manifest submitted by the in charge of the conveyance in the office of customs. If he is misuse of that particular departure manifest or the arrival manifest. In the case of arrival manifest, you should have been submit before arrival of the vessel or aircraft in the office of customs. In the case of departure manifest, submit the departure manifest, get the out of the entry outward to the conveyance and departure from the port to outside India. In the case of goods coming by land route in a vehicle, the arrival manifest, namely import report, should be submitted by the vehicle in charge driver within 12 hours from the time of arrival. If so, if there is not meeting the requirements, then penalty imposed on such person up to rupees 50,000 rupees. Penalty for improper handling of departure manifest or arrival manifest, as the case may be. Further, verification or authentication. Verification or authentication of a person by the department, yes, for the safety reasons. Commissioner or principal commissioner of customs says, Mr. Officer of Customs, Superintendent, you authenticate so and so person, he is valid person or not, whether he is genuine person or not, whether he has a valid IE code or not. Then such an officer authorized by the principal commissioner of customs or commissioner of customs is empowered to authenticate a person, show your bona fideness. Are you the genuine person to deal with import and export of goods with the best interest of the revenue? The officer of customs can ask authentication of a person. Verification of identity and compliances. Show your identity. Mr. Rafi, you imported the goods, exported the goods, show your identity. You are belongs to which state, you are holding which type of documentary evidences. Show your authentication, means your identity. The officer of customs can ask with the best interest of the revenue to prevent especially smuggling activities. Further, my dear sir, entering into the last segment of amendments, foreign trade policy 2015 to 2020. There is no much amendment except a small amendment taken place here. Earlier what happened here is deemed export, basic custom duty allowed as a drawback refund in the case of brand rate of duty drawback, alone claim as a refund for a deemed exporter. Now what happened? For a deemed exporter, he can ask the refund of all industry duty drawback rate applicable product also. That means all industry rate duty drawback can ask for refund by a deemed exporter. You know deemed exporter concept as referred under section 147 of the CGST. I supply the goods to an exporter for facilitating him to export the goods. Then my supply is called deemed export, covered under 147 of the CGST. If I have my inputs which suffered basic custom duty, where I can ask for all industry duty drawback, that can ask for refund. Earlier, if I have been suffered the basic custom duty, I can ask duty drawback of brand rate as a refund. Now brand rate as well as all industry duty drawback rate allowed as a refund for a deemed exporter is the amendment. Is clear, my dear sir? Furthermore amendments, foreign trade policy here, import of goods as gift prohibited except for life-saving drugs, medicines and Rafi, but not gifts related to Rafi. Meaning what? how to understand this? Sir, Government of India, namely Director General of Foreign Trade, said that you allowed to bring and as a gift only Rocky. Only Rocky. But not any gift relating to Rocky. Meaning what? Sweets, chocolates, clothes, not allowed. Only Rocky. Or life-saving drugs, bring as gift. If you are bringing other than this as a gift, that will be with prior permission of the DGFT. Is clear, my dear friends? Further referring to you, my dear sir. Dear friends, this exemption is extension from 31st March 2020 to 31st March 2020 for those who are advance authorization holders, export promotion capital goods EPCG license holders, export oriented units, electronic hardware technology park EHTPs, STP software technology parks or BTP biotechnology park units who are procuring the goods from outside India by way of import, free from IGST, free from compensation cess, was granted up to 31st March 2020. Now further extended to 31st March 2021. Not only that import but also local purchases. If they purchase from locally, also be not liable to pay IGST or compensation cess till 31st March 2021 by these assessees, EOUs, EHTP, STP, BTP or otherwise the advance authorization holders. Is it clear, my dear sir? Further, social welfare surcharge cannot be paid by utilizing MEIS, Merchandise Export from India scheme or SCIS, Services Export from India scheme. That duty credit scheme cannot be utilized for payment of the social welfare surcharge under the customs. Last but not the least, duration of the foreign trade policy originally concluded by 31st March 2020. Now what happened because of the coronavirus and all, it has been now extended, the same foreign trade policy 2015 to 2020 further extended till 31st March 2021, same policy will be continued. Is it clear, my dear friends? With this, my dear, we have been completed the entire amendment provisions which are applicable for your CA CMA CS examination of November 2020 or December 2020 examinations. All the best, my dear friends. Revision is important. Go for revision and number of times as possible. That is only in your hands, Vajrayudham, to answer within 3 hours the all questions asked by the examiner. All the best. Thank you, one and all.